and welcome to the Federal Reserve. My name is Amanda Roberts, and I am a member of the Community Bank Supervision team, as well as one of the conference organizers. Before we get started, I have to briefly go over some housekeeping items. So the first thing, probably most importantly, is if you haven't found them already, the bathrooms are down the hall and to the right. Second, please silence your cell phones. Third, this is a reminder that today's event is being live streamed on the board's YouTube channel. If you ask a question during Q&A, please wait for a microphone and identify yourself. Lastly, as I'm sure you've already discovered, the Federal Reserve is a secure facility. We ask that you please keep your security name tag on all day long, with, of course, the exception of panelists up on stage. You can take it off for that. If you need to step out of the building, or you need a quiet place for a phone call, or you have any other questions, please see one of the board employees sitting right outside the door here at the desk. We are now going to begin our conference with welcoming remarks from the Chair of the Federal Reserve, Jerome Powell.
Good morning and welcome to the Federal Reserve Board. I'm sorry that I'm traveling today and could not be with you. Thank you to Vice Chair for Supervision, Mickey Bowman, for hosting this conference. Thank you also to all the board staff that made this event possible. Community banks play a vital role in the U.S. financial system because they have strong links to the people and businesses they serve, and direct knowledge of local economic conditions. These close ties allow community bankers to better understand their customers and the ensuing products and services for those they serve. I saw this clearly when I led the board's Community and Regional Bank Subcommittee as a governor. I have also seen the critical role of community banks in the communities where I've lived, including as a community bank customer. Today's event is a helpful opportunity for Fed leaders to hear from community bankers and learn more about the issues you face. We're committed to understanding these issues, and we have long been committed to tailoring our supervisory practices as appropriate for community banks to reduce unnecessary burden, while still ensuring that community banks continue to operate in a safe and sound manner. Thank you so much for being here today to share your knowledge and experience. And thanks for being such a vital part of the communities that you serve.
Well, thank you to Chair Powell for opening our conference this morning. It's so wonderful to see all of you here in Washington, again with us, to discuss and celebrate community banking and to talk about what the future is going to look like. Good morning, Secretary. So it's a privilege for us to be here today and for me to be here with you at the Federal Reserve Board with so many of our nation's bank CEOs, community bank CEOs. I want to start by thanking our bankers for the essential work that you do every day, serving your communities, supporting small businesses and families, and keeping local economies strong and growing. Today's event provides us an opportunity to come together to discuss the future of community banking. This great nation hosts the largest and most efficient financial system in the world, efficient and effective financial system in the world, ensuring that capital flows to those who need it and can put it to productive use. I think of community banks as the foundation of our financial system. You are often the first call for small businesses seeking to grow, for families looking to buy homes, and for anyone seeking to achieve their financial goals. At a time of rapid technological change, a shifting regulatory landscape, and evolving consumer expectations, your work has never been more vital or more challenging. So the purpose of this conference is about looking ahead at the opportunities, the risks, and the innovations that will shape the future of community banking. It's also about telling the community bank story, not only the services that you provide and the impact that you have in your communities, but also the value of having strong, profitable, well-managed companies as the foundation of the banking system. There's a story to tell here, and we want to ensure that community banks tell it and that you create your own narrative. This conference today brings together more than 100 community bank CEOs in person and many more. Our panels include CEOs from across our diverse financial system. And I look forward to hearing directly from these leaders to share what they are seeing, emerging trends, economic shifts, and innovations that are shaping the financial system, including the impact of AI and fraud that will likely affect all of your businesses going forward. This conference also brings together a broader perspective, from our Treasury Secretary, Scott Bessent, to new technologies, with Paxos CEO Chad Cascarilla discussing new technologies, to private credit and the global outlook with Blackstone CEO Stephen Schwartzman. And we'll hear about consumer digital platforms from Robinhood CEO Vlad Tenev. These leaders will help us think more broadly about how economic and industry developments intersect with community banking. Another special guest joining us today is CNBC host Jim Cramer, who will moderate a panel of experienced community bank CEOs with a combined century of banking leadership. Today, we will showcase how community bankers have consistently adapted, innovated, and outperformed while staying true to their mission. These efforts don't necessarily make the headlines on the front page of the business section, but they should. And there's no one better to help elevate the community bank narrative and amplify the value community banks bring to America's economy than CNBC's Jim Cramer. Finally, we will host a traditional policy panel that features community bank CEOs discussing capital and liquidity regulation. This session will provide an opportunity for a thoughtful, candid discussion about how our regulatory frameworks affect your institutions and your ability to serve your communities. These conversations are essential to help shape our thinking and inform how we as regulators can ensure that our supervisory and our regulatory policies are effective, fair, and balanced. The goal and theme running through all of today's panels is clear. There is tremendous support from the public and the private sector for a strong, resilient, thriving community banking industry. Each of our sessions today reflects a shared belief in the importance of community banks to America's economic future. Thank you for being here with us today, both in person and virtually. So now I would like to thank our Treasury Secretary, Scott Bessent, for taking time from his busy schedule to join us here today to discuss community banking. And I'll invite you to share your insights with us now. So thank you, Mr. Secretary.
Good morning. It's an honor to be with you today. Unfortunately, the government is still shut down because members of the Senate refused to support the Clean Government Funding Bill, which was passed by the House weeks ago. Across the Trump administration, we are eager to get the government reopened so agencies can continue to work for the American people. Glad to see all of you were able to continue your work today. This morning, I wish to focus on how we can better serve the American people and the important role community banks play in that effort. To begin, I'd like to express my appreciation to Vice Chair Bowman for arranging this conference. She and I are committed to protecting the role of community banks in our financial system. This conference is a testament to that commitment. As you all know, better than most, regulation has gradually suffocated the banks that are closest to the men and women who work the jobs, pay the bills, and take out the loans that fuel growth in small-town America. Banks that not only know their customers by name, but also their financial hopes and dreams. In other words, banks like yours. To reverse course, earlier this year, I called for a fundamental reset of financial regulation. No longer will regulation serve to entrench big banks and empower Washington bureaucrats to the detriment of community banks and the clients they serve. President Trump and this administration have charted a new course for our economy, one that strengthens both the shop floor and the trading floor. This is what I call the era of parallel prosperity, where Main Street and Wall Street grow together. Who will turn this vision into reality? the men and women in this room. Community bankers are laying the foundation for America's golden age, one loan, one family, and one small business at a time. My job as Treasury Secretary is to make it easier for you to do your job. To that end, we have worked hard for the first 8 months of this administration to empower community banks to take back control of their own future. This morning, I will discuss why the Trump administration has sought to empower community banks, how we have done it, and where we will go from here. First, why? Community banks are essential to America's heartland. They provide the capital that binds small towns together. Community banks make the charitable contribution for the new playground. They make the loans for small businesses, farmers, and first-time homebuyers. They employ local leaders and teach financial literacy in our schools. Parallel prosperity, as I mentioned before, is the idea that Main Street and Wall Street can grow together, and community banks play an instrumental role in driving growth on the Main Street side of the ledger. To expand opportunities for all Americans, the banks that serve Main Street must have the same chance to succeed as the banks that serve Wall Street. But the post-crisis regulatory framework has instead become a threat to the community bank model. Since 2010, we've lost 3,600 community banks, a reduction of over 45%. Community banks' share of bank assets have fallen from 23% to 15%. Their share of outstanding bank loans has fallen from 27% to 20%. Their share of outstanding bank CRE loans has fallen from 52% to 41%. This represents an acceleration of trends that predate the 2008 financial crisis. And in a disturbing new development, de novo chartering has dropped precipitously, averaging just 6 new banks per year since 2010. For comparison, in the years prior to 2008, there were 100+ new banks chartered each year. The post-crisis framework has left a trail of destruction in its wake by reinforcing the larger economic dynamics that have hollowed out the American heartland while enriching the money centers in coastal cities. To be clear, the financial crisis underscored the need for new regulations. The purpose of Dodd-Frank was to end too big to fail, but it ended up creating too small to succeed. These new regulations entrench the dominance of the largest banks by rewarding economies of scale and necessitating effective lobbying operations here in Washington. What followed was a community bank bottleneck that left America's hometowns reeling. President Trump and this administration have seen what the heavy hand of government has done to community banks and the families you all serve, and he has set out to fix it. Why? Because we know that the Main Street revival starts with a community bank comeback. How will we position community banks to succeed? Let's start with the early wins. Just days after President Trump was sworn into office, the administration began rolling back the regulatory excesses of the Biden years. The regulators ended the politicized use of reputation risk and supervision. They proposed to rescind an embarrassing, complicated 60,000-word Community Reinvestment Act rule, and they retracted a merger policy statement that was both bad policy and bad law. The previous administration pushed for rules and guidance that micromanaged corporate governance, entangled the bank regulators in climate risk management, unduly restricted brokered deposits, precluded responsible bank innovation in crypto and other blockchain technologies, and imposed arbitrary restrictions on incentive compensation. These Biden-era proposals were bad for banks, bad for business, and bad for America, especially Main Street. So President Trump slashed all of them. To restore the strength of community banks, the new administration has replaced this draconian agenda with a new, more constructive agenda. The FDIC, for example, has recommitted to tailoring by proposing to raise and index asset thresholds. It has streamlined examination procedures and branch applications. It has started work to reestablish a supervisory appeals body. Not to be outdone, the OCC has implemented its own reforms. Controller Gould has been on the job for only 12 weeks, but he has already reduced assessments on small banks by 30%, reversed the plan to merge community bank supervision into large bank supervision, and replaced community banks' formulaic examination schedules with a more risk-based approach. Vice Chair Bowman, meanwhile, has long advocated for revisiting the community bank leverage ratio. I expect that effort will soon culminate in a proposed reduction in the community bank leverage ratio. The CFPB, for its part, has started to revamp the Section 1071 reporting requirements and reconsider the open banking rule. And it has withdrawn more than 60 interpretive rules and other guidance documents. Following the administration's example, Congress has also taken up the effort. It has nullified the CFPB's overdraft rule and prohibited the furnishing of mortgage-related trigger leads. The House Financial Service Committee has likewise advanced 24 important reforms to community bank regulation, while the Senate Banking Committee held a hearing and hopefully will soon mark up an expansion of FDIC insurance on non-interest-bearing transaction accounts. There is still much to look forward to on the regulatory front. This includes 2 new proposals that will reset the culture of supervision. 2 days ago, the FDIC and the OCC proposed a rule that would codify the recently adopted prohibition on using reputation risk as a basis for supervisory criticism. The FDIC and the OCC also proposed a rule that would define unsafe or unsound practice or condition. While simply defining a term might sound like a small thing, it marks a big step forward. Only in the world of unaccountable regulators could a key concept have gone unidentified for so long. The past failure to define this term led to supervisory criticisms focused on process or documentation related to governance, model management, and third-party risk management. In other words, topics that often had little or nothing to do with a bank's actual financial condition. This regulatory myopia was the driving force behind the spring of 2020-23 bank failures. Once finalized, a clear focus on material financial risk will put an end to this nonsense. I'm also optimistic about AML-CFT reform. In my meetings with community bankers, they list CTR filings, structuring SARs, and process-focused examinations among their top concerns. Today, FinCEN released FAQs to address pain points on some of these issues, including triggers for restructuring SARs, continuing activity reviews, and the absence of any requirement to document a decision not to file a SAR. These are common sense, yet consequential reforms that will ease regulatory burdens without undermining law enforcement efforts. As part of our broader campaign to modernize illicit finance regulation, FinCEN and the bank regulators are hard at work on a new rule to define the requirements for an effective AML-CFT program. My expectation is that a proposal will recenter supervision where it should be, on the effectiveness of a bank's AML-CFT program. I likewise expect that proposal will position FinCEN as a gatekeeper for AML-CFT enforcement. This will be a significant departure from the past with its zero-tolerance focus on process, documentation, and wide latitude for supervisory expectations and judgments that are not always consistent with the law or our national security priorities. A focus on higher value activities will also better serve our law enforcement and national security objectives. These are all important victories, to be sure, but much work remains to be done. Where do we go from here? Going forward, Treasury will continue to drive reforms to improve regulatory tailoring, refocus the culture of supervision, and modernize our illicit finance regulation. Specific priorities will include reforms to the rating system, new processes for monitoring examiners' compliance with supervisory policy, mechanism for independent appeals of supervisory criticisms, coordination to avoid duplicative examinations by different regulators, and review of the core platform providers, including contract terms that prevent community banks from innovating for the future. For community banks to go back in the offensive, we need to take a closer look at the dynamics that have undermined the community bank model and work to fix them. To that end, as I have said before, Treasury is focused on ensuring that modernization of our capital framework ends the capital arbitrage that drives bank lending to non-banks. This will likely entail reduced capital requirements for large banks on mortgage loans, investment-grade corporate loans, and some other important exposures. We must therefore ensure parity by giving smaller banks at least the option to benefit from these reduced requirements. Treasury has also supported congressional efforts to modernize the deposit insurance framework. I'm encouraged to see emerging bipartisan support for increasing FDIC insurance limits on non-interest-bearing transaction accounts. In addition to these efforts, Treasury has taken an informed and careful approach to Fannie Mae and Freddie Mac. Any actions on the GSEs must not increase borrowing costs and must preserve what works in the current system. That includes the prohibition on volume-based discounts for large lenders, as well as the cash window and other features that preserve equal secondary market access for small lenders. Now, allow me to close with a call for action. Before President Trump took office, community banks spent decades on the defense. But under President Trump's leadership, the game has changed. The playing field will be even more even. The ball is in your hands again. What happens next is up to you. So my advice, go on the offense, retake market share, chase after customers, champion technology, leverage the new regulatory landscape to your advantage, and expand your role in the American economy. The community bank comeback will help pave the way for America's golden age. Recognize the outsized role you play in this effort and embrace it. Because if you lead the way, Main Street will follow. Thank you.
Thank you, Secretary Besant. It's wonderful to hear a Treasury Secretary. I'm not sure I've ever heard a Treasury Secretary talk about community banking and the importance of community banks in the United States and for the U.S. economy in my lifetime. So it's really refreshing to hear you engaging on things that are so important to areas like where I'm from and rural communities across this country, and how important community banking is for the foundation of our economy and the economic system. So if you don't mind, we'll start with a question, and thank you for joining me for a fireside chat this morning. But as Treasury Secretary, you oversee U.S. fiscal and macroeconomic policy. So I know every banker in this room is interested to see how you think about how the economy is going to develop over the next 12 to 24 months, and what key risks and opportunities should they be thinking about and looking out for as they're thinking about how to shape their businesses going forward.
Well, I come with some good news this morning, and Treasury, because of the Schumer shutdown, will not be able to release the exact numbers, but the CBO jumped the gun a bit, and it was on Bloomberg this morning that the deficit for this fiscal year, ending September 30th, will be slightly lower. When I went to see President Trump and more importantly, the deficit to GDP now has a 5 in front of it. So according to the CBO numbers, and we don't have the Treasury numbers yet, the deficit to GDP will have fallen from about 6.5%, which was the highest when we weren't at war or weren't in a recession in U.S. history, to 5.9%. When I went to see President Trump approximately 2 years ago to tell him that I'd like to come out from behind my desk and get involved with the campaign, not going to repeat many private conversations, but this was particularly notable. He looked at me, first thing he said, Scott, how are we going to get the debt and deficits down and not cause a recession? And we're on our way. I think we saw that today. So I think the president's economic policy, as many of you would have seen me say before, is a three-legged stool: trade, tax, and deregulation. The tax bill, the one big beautiful bill, has incentives for both corporate America in terms of full expensing for plant property and equipment, and the plant part is new. In the Tax Cuts and Job Act 2017, there was full expensing for equipment, but we have added structures for both industrial structures and, importantly, agricultural structures. So, secondly, on the other side of the ledger, it also includes the president's tax policies or campaign promises for working Americans: no tax on tips, no tax on overtime, low tax on Social Security, and interest deductibility if you buy an American car. I think one of the things that we are seeing now, most taxpayers have not changed their withholding stance to reflect this. So we expect to see substantial tax refunds beginning of next year, which I think will be accrued to lower end consumers for the bottom 50% who need the relief. And concurrently, they will change their withholding schedule, so their real take-home pay will be higher next year. On the trade deals, I think one of the underreported aspects of the trade deals is not only are we taking in substantial tariff revenue for our American exporters, we have brought down non-tariff trade barriers and brought down tariffs across the board. So with many of the deals that we have gone from high tariff levels, and I tell you, like, for instance, Indonesia was very good about bringing down their tariff levels, but when they showed you the list of 9,000 tariffs that they had, you couldn't believe it. So, and like President Trump said, I don't blame the Indonesians for doing it. You blame the folks who were sitting at the Resolute desk for letting it happen. So on trade, we're landing the trade deals. That will increase certainty. And then finally, on deregulation, we've talked a lot about financial deregulation, but we're also talking about energy and industrial deregulation. We're trying to make it easy to build things here again in America, whether it's permitting for factories, for pipelines, for the electric grid. So I think I'm very optimistic that 2026 could be a very good year across the corporate and the consumer economy.
Well, thank you for that. You've been very busy since you got started earlier this year. So thank you for sharing that. And I think that's a very optimistic view about how the economy will be evolving, I think, in the relatively near future. Thinking about that, community banks are critical in providing local and regional credit throughout their communities, through small towns, through rural areas, and in underserved markets especially. So you talked a little bit about what some of the initiatives are that Treasury's been working on with the prudential regulators. Are there other areas that you'd like to focus on or to share with us today that might be helpful for bankers to know?
Well, as you said earlier, I may be one of the few, if not the only Treasury Secretary who's given this much emphasis to community banks, probably the only Treasury Secretary since the 17 or 1800s who lives, well, there wouldn't have been farm radio, but is also a farmer. So I remember listening to farm radio right after the Silicon Valley debacle or the three-bank debacle, and they were talking about the risks to community banks that were happening, that could be happening here. And I was just struck by what the presenter was saying. He said, the big banks, they're going to come in, they're going to buy up our banks. They don't play Little League Baseball with your son. They don't play softball with your daughter. They don't go to your place of worship. They don't know you from the Rotary Club. What are we going to do? And so we are committed, as I said. I'd like to see us getting back to de novo banks. Again, it's a sign that when you see creation of something, it's a sign that the ecosystem's healthy. So we want to get back to de novo. We want to get back to leveling the playing field. I think these transaction accounts are very important. We try at Treasury, we try to meet with dozens of community banks, whether it's one-on-one or in groups every month. And one of the main asks that we got was increasing the non-interest bearing transaction account. So we've been working very closely with Senator Tim Scott on that. And I think we haven't landed the exact amount yet, but I think that legislation is going to move through.
Well, it's wonderful to hear some progress in some of these areas that have been a topic of conversation for a number of years. So thank you for your support in working towards some solutions in that regard. Later today, we're going to have a panel of community bankers to talk about capital and liquidity regulations. So I wondered if you might be willing to share your views and thoughts about how we could appropriately calibrate those capital and liquidity levels, especially for community banks, but maybe more broadly across the banking system to be more effective for economic growth and how to support the economy going forward.
I think if we take a step back, we could see that the substantial amount of credit that is being grown outside of the regulated banking system tells you that the regulatory framework that was developed post-Dodd-Frank is too tight, and that there is this substantial arbitrage to be done, whether it's vis-a-vis big banks, whether it's small banks. Why do we have private credit that is bundling loans and then receiving lines of credit from banks? Let's get back to the primary lending function. Let's make capital more risk-based. Let's understand that there's a lot of work to do in terms of bringing this back down to common sense levels. In terms of knowing your client, in terms of releasing what I would say is this regulatory straitjacket. And famous last words, I think private credit is a dynamic new aspect that increases the depth and breadth of the U.S. financial system, but it can't be to the detriment of the regulated system, because my real worry with private credit is everyone in this room, all the bankers, and look, I met a lot of banks who've been going since the 1800s. And if you've been going since the 1800s, you know a lot about risk management. You know how capital works. You know how your clients are. My worry with private credit is it could be very pro-cyclical, that without stable deposits, in terms of if there were a downturn, the way Treasury and Federal Reserve would work together would be with window guidance, would be with regulatory lessening the regulatory parameters, and to restart the economy in a counter-cyclical basis. So we also want to look at that. And again, too, a lot of the things we want to do, we want to make it easier to operate. We had a small community bank from South Carolina a couple weeks ago in one of our panels. I think it was 185 million of assets, 17 employees. I think 5 were for compliance. So, and no one is more focused right now on financial crimes. Our FinCEN department is 24/7 in terms of what we are trying to work on. but we're also trying to add a common sense layer. Can we do geographic targeting? If we see that a huge amount of the narco finance is along the border, should we lower SARs there and raise them everywhere else to avoid all this regulatory expense?
Well, I think that's a very important topic for many community bankers as they think about some of the regulatory burden and requirements that they're not sure what happens to once they send it forward. One thing I want to just pull a thread on is you mentioned the importance of ensuring that we have the ability as regulators and bankers are not disincentivized from participating in different types of activities. One thing I would point to, and I have many times over the years, is to talk about how important it is that we're pulling some of these activities back into the regulated financial system, especially real estate lending and mortgage servicing and things of that nature. So I know many of these bankers in the room are hopeful that we'll be able to think about that differently. So when you discuss the regulatory perimeter, I think that's a very positive path for discussion, and we'll look forward to engaging on that.
And look, I mean, no one knows when you talk about real estate, no one knows the real estate landscape like local bankers.
Absolutely.
It's maybe there's some banks around the Ozarks who like lending down in Florida, but I hope they're successful. But I will tell you that community banks. I'm sure all of you read all the news reports. Oh, community banks hold all the small community banks. It's going to be a debacle. They hold all these CRE loans, and for 15 or 20 years, initial 15 or 20 years of my career, I was a banks and insurance analyst. So I know how banks work. I may seem exciting, but I used to read state insurance call reports.
Those are fascinating.
Gripping is the only word. But I can tell you that to the extent I was successful was being fact-based and not narrative-based. And as we dug down on what was supposed to be a CRE wipeout for community banks, it turned out that they really weren't CRE loans, that they were business loans. And we just went out and talked to small and community bankers. They were business loans where the business person put up their building as collateral. So you didn't have a loan on a part of a strip mall. You didn't have a loan on a pod. It was an accounting firm that was financed. You had a loan to an accounting firm. You had a loan to a law firm. You had a loan to a medical practice. So, and only community banks know that.
Well, it's refreshing, again, to hear the Treasury Secretary talk about community banking in a way that helps us recognize that you do have a background in it and that you're serious about the words that you're saying in support of community banking. So thank you for your commitment to that and for sharing that with everyone here today. One thing everybody's a little bit concerned about going forward is the shift in the technological landscape. And banks for a long time have been innovating. It's been a hallmark of the community banking framework and their survival since the 1800s, which I have to say thank you for mentioning banks that were founded in 1800s, because my family's bank was chartered in 1882. So that's a little peace of mind here that you think that they understand their risks. So I'll have to share that with my cousin. But on innovation, banks have been partnering with fintechs for a number of years now, and we continue to add more and more requirements about third-party risk management, and oftentimes they don't make sense, or they conflict with each other, or they contradict what the requirements are. As we're thinking about how the landscape with technology, with AI, with stable coins and other types of new business services and activities are being brought forward through the sponsorship of legislation and new regulatory frameworks for stablecoins and things like that. Today we have the Robinhood CEO and also the Paxos CEO to share their views on how community banks can engage or think about how that will look going forward. But how do you see the role of technology evolving in the banking sector, and what policy levers do you think that we could use to help ensure that community banks can compete effectively in the new technology environment?
I think it was very important. If I look, and one of the biggest regulatory changes from the Biden administration to the Trump administration, there have been a lot of them, is our emphasis on AI and digital assets. AI in the Biden administration was governed by diffusion. They were going to treat it somewhat like the nuclear program, keep it in a box. They were going to hand it to Google, Microsoft, Meta, and that was life. On the other side, digital assets had a near extinction event with Wells notices going out to many companies, banks prohibited from opening accounts. And I think the fact that we're creating, the term is sandbox, where there's a lot of experimentation, where there are a lot more offerings, and for community banks not to be locked in, that they have to use like one of 3 dominant service providers, that for a wider range, supply will push down price, choice will inform. Community bankers are, and the owners, whether they're family-owned banks, whether the shareholders are usually in the vicinity, and I think that they will be laser focused on the new technologies. And just like with the credit card companies, I think that new payment rails will exist, and I think we have to make sure that it's open for everybody. JP Morgan, Bank of America may have their own stable coin, but I think it's very easy, and you'll hear, you have 2 great participants, that you will hear that for community bankers to join together, whether it's in some kind of a cooperative program, whether, but you can private label these under your own name, and it doesn't necessarily have to increase deposit beta. The other thing we're going to do, because we value community banks, we are going to make sure that any new regulation is done in a safe, sound, and not abrupt manner. That there will be a transition, and everyone will be able to understand it and participate in it.
Great. Well, I think that's wonderful news for all of our CEOs in the room and everyone listening virtually. I think it's important, as you said, that all banks can participate in this new economic environment, and that we're creating a framework that will allow for safe and sound engagement, as well as ensuring that whatever customers are interested in doing, that banks have that opportunity through a sandbox. That's an excellent idea, and it's great to go back to those ideas from the first Trump administration, where we were actively engaging with office hours, where we would bring in fintechs and bankers to talk about how they wanted to expand businesses in a way that was appropriate and met our expectations.
And I also think too, how many people in this room's first savings account was a Christmas club at the local bank? Right. So are we going to develop the new kind of crypto Christmas club? I like that.
That's an interesting idea, yeah.
CCC, Crypto Christmas Club. and because I do think one of the great things about crypto is it's bringing young people into the markets, into the financial industry, and I think that community banks, they will be at the front line of providing that. You have a natural advantage in terms of going into the schools, in terms of financial education, in terms of financial literacy. I think Mickey's heard me tell the story. My deep, dark secret is that, and a lot of people from South Carolina have it, I have a Dr. Pepper every morning for breakfast. I'm not allowed to do it at home, so which used to take me to the Circle K on Meeting Street in Charleston, South Carolina. And in there'd be a lot of young construction workers getting ready to go to work. They'd see me dressed like this, and they'd be playing the lottery. They'd say, "Mister, when I win the lottery, will you manage my money?" I said, "Well, the first thing you can do is not play the lottery." But imagine if that group that were involved in digital assets, if they've been putting that $20 of their hard-earned money from construction work, from their blue-collar jobs into digital assets over this time, and it's going to be community banks that do it. It's not going to be the big national banks. So I think that to be able to cater to that audience is going to really provide opportunity for a lot of growth.
Well, I got to say that my theory has always been you can't win if you don't play. So, whatever venue that is, I look forward to seeing how all of those things evolve over the next 10, 20 years, maybe even sooner. But before I ask you the last question about the future of community banking, I want to just touch on some of the legislative proposals that are being considered. There's a big groundswell of discussion about asset thresholds, potentially changing when and how certain regulatory requirements will apply to community banks and other banks of other sizes, including regional banks. How's Treasury thinking about those proposals, and what principles should guide those thresholds as legislators and as regulators are thinking about those going forward?
Well, I think we should think about it in two ways. One, we always think about it inflation adjustments, whether it's for Social Security, sometimes for capital gains. There's probably a big catch-up to do in terms of asset thresholds. Just the economy's grown, the asset size has grown for bank lending, and like I said, we want to bring it back into the regulated system. So I think that it will be natural to raise many of these thresholds. But then I think you also have to look at what's your book of business, how risky, in terms of how have you grown your balance sheet. Does it look like something like Silicon Valley Bank, with a lot of deposit beta? So yeah, I think it's those two, but I definitely believe that we do need a substantial increase in terms of the regulatory levels, and maybe even an increase from the 10 billion. When does the Fed get involved?
I think those are really great topics of conversation. And I think more and more I'm having discussions, as I'm sure you are too, with regional banks who are being frozen at a certain asset level size so that they're not crossing that $100 billion threshold, or a community banker that's being frozen just below 10 billion in assets, simply because so many different thresholds of many kinds and different regulations and statutes bite.
Or one of the banks
point.
we had come in, and you would think that if a longstanding big customer came in and put a big deposit in at the end of the year, you'd be excited, but they would, no, we can't take it because it's going to push us over 500 million,
Right.
and then the trigger there. So we want to make sure that you're able to grow without setting off these regulatory tripwires.
Well, I look forward to chatting with you about that going forward and seeing how all of us as in the regulatory space can think about how we can more effectively allow banks to manage for their growth and their size, especially when they're not changing their business model. But finally, on the topic of the future of community banking, over the next 5 to 10 years, how do you see the biggest structural shifts occurring, and how do you think community banks will evolve to meet those challenges in the future? One of the questions that we're asking all of our keynote speakers today is, what does the community bank of 2025 look like?
2025 or 2035?
Oh, sorry, 2035, sorry. I don't have my glasses on. Yes, 2035. It is already 2025.
So the ones that make it through the next 10 years will have embraced technology, have embraced financial modernization, and as I said earlier, I think we'll have brought along a whole new generation of young people into the financial world. Because look, there's a whole group just because of the bad calendar. And they lived through the GFC, they lived through COVID, but when I interact with them, they're curious, They want to be part of the system, and it will have been that. And I think that we will see I don't know if the branch model is as big as it was. We'll see with that, but I think it's all going to center around technology. And so that's the importance of low-cost technological alternatives for the next 10 years,
Not just for 2025.
not just for 2025.
Yeah, I think one of the wonderful experiences that we've seen over the past throughout COVID and the Paycheck Protection Program was that we have an amazing industry of community banks that are willing to bend over backwards to ensure that they can support their communities. And I look forward to seeing, hopefully we won't have another experience like COVID where we're asking banks to be, the sole provider of fiscal support or loans for their small businesses to keep their economies running and people employed. But I think it's a wonderful recognition of everything that community banks have done over the past at least 5 years to keep our economy running, to keep our people employed in rural communities and in urban communities as well. But thank you for the support that you've provided.
Yeah, and I think that the other big opportunity is going to be what I saw in the local market in Charleston, South Carolina, was when Boeing came in. Boeing doesn't need, other than people in this building, they don't need to bank with anyone in this room. But when Boeing's second largest production facility came in, there was an ecosystem of more than 200 small factories that sprung up. And the small and community banks, some of the small regionals all moved into Charleston, and they bank every one of those small factories. Some of the factories, some of these startup businesses that have 50, 100, 200 employees. So with this administration's effort to bring manufacturing back to the U.S., I would say when we see, we're talking about bringing back the semiconductor industry, they need 500 companies around them to do that. When we see this precision manufacturing, when you see a multinational company set up, they are going to need a big ecosystem. And the ecosystem, JP Morgan's not interested in the ecosystem, and I think everybody in this room should be.
That's wonderful. Thank you so much for sharing your perspective with us and celebrating the agility and flexibility of community banks to solve problems and to meet needs where they arise quickly. And we look forward to the rest of our day today, and we really appreciate your time this morning. Thank you, Secretary Bessent.
Thank you.
Community Banks. Take it away.
All right, good morning. I know there's going to be an exciting panel coming up next. Jim just gave us a pep talk, so you're all going to have a lot of fun. I thought I'd give a little bit of introduction on myself. My name is Charles Cascarella. I'm the CEO and co-founder of Paxos, which is a blockchain infrastructure company. We issue stablecoins, and we also provide infrastructure for generally large institutions, but also small ones. And I do have one or two similarities to the prior speaker in that I spent my career as an analyst covering financial institutions, and I can say I read some call reports in my day, and they are definitely illuminating, though not always entertaining. Best when they're not entertaining, actually. And you know, I've been able to look at small institutions and large institutions, and I think this is going to be a really interesting talk around how community banks are both important to the economy, but also how innovation can enable them to actually have an even more important place as we move forward. Maybe, Jeff, you could give a little bit of your background.
Well, thank you, and it's an honor to be here with everybody. We are, I think, planning on having some Q&A at the end as well, so looking forward to that. I'm Jeff Sennett. I'm the president and CEO of Vantage Bank. First, let me say that I'm very passionate about technology. I'm very passionate about community banks, and that sometimes leads to me talking very quickly. So if somebody can just give me the slow down signal if I start to do that, I'd appreciate that. So I'm, as I mentioned, I'm the CEO of Vantage Bank. I did not come through the traditional community bank CEO channels. I started my career as a software engineer, working on the model banking program for Nations Bank. And that was the program where, you know, Nations Bank had acquired all these banks. They were bringing it together under one platform. And I worked on the platform systems. And I worked on something that was called home banking at the time. So I'd carry around a box of about 500 floppies. And if I got it out of order, I had to start over. Technology's come a long way. From there, I went to Barnett Bank. And when Barnett Bank, which was an incredible bank out of Florida, was sold to Nations Bank, I took that opportunity to go with some friends to start a software company. And during that time, I struck a relationship with a community bank, a community banker in Fort Worth, Summit Bank, Phil Norwood. And as we were growing that software company, I saw how important a community bank was to small businesses. Ultimately, that software company sold, and when that happened, Phil Norwood reached out to me and said, where are you going next? And I said, I think I might go to Bank of America. And he said, no. Come to community banks, and you can see how you can put together the technology you've been working on at a small software company with the community bank and really make an impact, just as we did, but we can turbocharge that with technology. And so I took him up on that. I became his CIO. That bank ultimately sold to Frost, and I've been in the community bank space ever since. I'm a huge believer in what technology and community bank can do, not only for the community bank itself, but for the customers, the prospects, the communities of community banks. Vantage Bank, the current iteration of Vantage is about 6 years old. We brought together a few banks and really set forward a path to set this bridge between traditional community banking and what we feel is modern community banking. We put that path in motion intentionally. And one of the first things we did was a risk assessment in terms of what are we going to face in the future. Vantage Bank is designed to be a multi-generational bank. We're 100% family and employee owned, and we really want to take a long game approach. And part of that risk assessment was around AI, was around stablecoin, tokenization, tokenized deposits. And so we set a path. We're a very decentralized bank as designed. All of our employees are spread across the state. We have a digital backbone that connects us all. We spent a tremendous amount of time on data modeling and a tremendous amount of time preparing for this transformation that's occurring right now.
Thanks, Jeff, and obviously a very innovative approach to banking that you've taken over your career. Maybe you could spend a little time talking about how community banks can offer their customers different types of products or different services than big banks, and how you feel like you're able to be competitive against them.
So community banks, all of us pride ourselves on really understanding what our customers are asking for. How do we structure solutions, products, and services in order to make an impact for them? We can be ultra responsive, and part of that responsiveness is data. But another part of that is really taking control of that innovation. We just heard in the last panel your opinion on the big three. That's something that I think what we're going to talk a lot about today untethers us from. So for us at Vantage, we spent a lot of time putting a layer on top of our core provider in order to take more control of that, in order to provide differentiated services and products. That's worked out very well for Vantage. We were $1.6 billion 6 years ago. We're knocking on the door of $5 billion now. And so when you put together that accountability that you build with your customers, your thoughtfulness in terms of what your customers are trying to accomplish with ultra responsive products and services that help them be competitive, community banks are a natural place where they're going to turn.
Yeah, it's a very impressive deposit growth, 25 or 30% probably annualized, trying to do the math quickly in my head, which is, obviously significantly faster than what the market's growing. And what do you think is primarily driving that growth? When you think about, is it the technology that you're being able to offer, the different ways in which you can differentiate yourself from banks where there might be a more homogeneous offering when they're large and they're big?
So our largest deposit growth year was the 9 months after Silicon Valley Bank failed. Our deposits grew over 33% that year. But I think that what that signal is it's a signal of when there's times of uncertainty, people turn to who they trust, who's committed to them. Our growth really started to explode right after COVID and PPP. We actually had rolled out a program ahead of the PPP program, and we modified a third of our customers' loans in 5 days using technology. What that turned into, though, was this sense of trust, and they became our biggest net promoters. They became evangelists of Vantage Bank and community banks. And we're facing that again. We're facing a time of uncertainty. This time it's not a pandemic. This time it's not a bank failure. This time it's a transformation of technology and uncertainty around technology with tokenization, stablecoins, tokenized deposits. And again, I think community banks are where your customers and prospects on Main Street are going to turn because we have that trust. They know that commitment. And so it's an opportunity to leverage that and to provide solutions to them in a way that we've never been able to do before. And I'll talk more about that in just a bit.
Obviously things have changed in terms of the administration's willingness to enable stablecoins and blockchain technology into the financial services industry. Obviously the Genius Act has also been a very important piece of legislation that is enabling stablecoins with legal certainty in a way that hasn't existed before. And certainly that's been something that you have experimented with. And I think when we were talking ahead of this conversation, I was really surprised and interested to hear in the ways that you're using both blockchain and stablecoins to change the products and services, the way in which your bank can offer your customers a new experience, and also how it can even change the cost curve. So both in a way of changing your revenues, but changing your expenses. And I think that would be really helpful for everyone to hear about.
Absolutely. And I know I have probably some of my regulators in this room, so this is all meant with absolute respect.
Very interesting caveat.
So Vantage, we have been methodically moving down this path, like I mentioned, for 6 years. And we've been pushing on the fences with some regulators during that time. And so one of the very first things Vantage did was we offered a Bitcoin savings plan. So our employees could put up to just 6%, up to 6% of their salary into Bitcoin. Eventually we had to shut that down. I still have employees point out to me all the time what that cost them when we had to shut that program down. 5 years ago, we started putting our loans on the blockchain. So when Vantage originates loans, we have a proprietary loan origination system that we built. We actually then originate them on our core system, and we send them to the blockchain. And that's positioning for a day of tokenization around those assets so that we can have a much more effective way to manage our balance sheet. It provides us accessibility into the biggest asset managers of the world, but also provides us a very easy way to sell and manage loans and participate and syndicate between banks. We can also sell any part of that asset to any of you or one of our customers. That's the power of tokenization. So that's another example of Vantage positioning for this. In terms of stablecoin and tokenized deposits, Vantage started down this road really 2 years ago. We went to our regulators and we presented to them what we wanted to accomplish along this front. That was supposed to be a fairly short meeting. The very first question I got, and they may be in this room, was, why are you doing this? And you're a healthy, safe bank. And the answer was, we're not doing this to take on risk. We're doing this to manage risk. We know this is going to be an important part of the banking system in the future. It's going to be an important part of community banks. And it doesn't have to be Vantage. You pick any community bank and work closely with them along this path. And that meeting turned into a full day and then some follow-up meetings. And eventually our regulators, both on the state side and the Fed side, reached out and said, we do want to partner and we want to learn more. And you be completely transparent with us. You present your risk assessments of what you're trying to accomplish, and we'll work with you. And we've been meeting with our regulators every other week now for almost 2 years. And through that, we've been pushing forward on some proof of concepts with tokenized deposits and stablecoins. The first one we did was earlier this year. Vantage Bank, working with our partner Custodia, did the very first tokenized deposit U.S. bank release on a public blockchain. We since have pushed that proof of concept forward, and this gets to that differentiation where one of our customers is a trucking company, and we asked that trucking company, what's one of your biggest challenges? And this is where this technology should resonate with every community banker, because for the first time, we have an unbelievable opportunity to actually help our customers in a way we've never had before compete and win in their most crucial workflows or some of the most strategic challenges. So our trucking company said, one of my biggest challenges is the continuity of good drivers. I need the ability to know I can count on my best drivers. And I asked him, what would do that? What would help you have that? And he said, they all want to get paid when their route is complete. And so we said, okay, so when that truck drives into the warehouse, if we could recognize that and pay your truck driver, would that do that? Would that be that differentiator? And he said, that's a game changer. So our second proof of concept did exactly that. We paid when the truck went into the warehouse, and that's the kind of things that you can do with stablecoin, tokenized deposits, and the smart contracts, the programmability around that. So when you expand that to what community banks do, all of us want to understand how can we help our customers be successful. And we can do things on the credit structure side, and we can do some on liquidity management, but we've always been somewhat handcuffed in terms of what we can absolutely do to impact them. And now we can work outside of some of those handcuffs, some of our core providers, some of the other gatekeepers, and we can work directly in this technology and directly with our customers to understand how can we help them differentiate, how can we help them have a competitive advantage. And so now we're working on a proof of concept with a large commercial builder. That commercial builder wants to pay his most important subcontractors on that inspection flow at the construction desk. We'll be able to enable that. I will say that after that proof of concept with the trucking company, we got a call from a very large car manufacturer asking if there was an ability to do something like that with their chip supplier after it got QA'd. And of course, the answer is yes, you can do that on those type of events. Now, this large car manufacturer, Bank of America, Chase, they're going to listen to them. But all those companies on Main Street that are looking for that competitive advantage, that's where community banks can step in and really do something to impact them in very significant ways.
It's really interesting. A couple of things. When you think about the blockchain, the whole point is that it's decentralized and that it actually can allow there to be fragmentation, yet for there to be consistency in how things move, which is obviously, potentially bringing everyone closer to the customer. and for people who are already close to the customer, like community banks, that can actually be a real advantage. And I know that you were maybe describing some examples where you have customers and they need to be able to operate, even though they're a local customer, they have the need to operate either cross-border or even across the country. And so you now have a way of being able to operate in a much wider geography while staying local. Were there maybe one or two examples that you could go into around even cross-border, because it's really very interesting?
Yes, I think it's a very important aspect of this as well. It opens up avenues and markets to community banks where, we may not have had access to in the past, but even if we did, there was a lot of middle parties involved that would make it less of the ability for us to do that at margins that made sense. But with the blockchain, with tokenized deposits and stablecoin, we have the ability to do that. So Advantage, we're setting up an ecosystem. Sandbox was mentioned earlier. We're going to release a sandbox later this month, and we're going to invite other community banks to participate in this as well. And we want other community banks to. That sandbox will enable to do some of these proof of concept pieces. But one of the things that Advantage is, about a third of our customers operate in the U.S. and outside of the U.S. One of the banks that we brought together was International Bank into Vantage. And so it's very important for us to be able to operate effectively, and safely, quickly, and with good margins across border. So the trucking company I mentioned earlier actually was a trucking company out of Mexico. And just to give you a little more, insight into this technology and its capability, it's our thesis at Vantage that, in terms of tokenized deposits, and we can talk about a little bit about stablecoins, tokenized deposits, if that makes sense. But in terms of tokenized deposits, we're ready to do that today. We've shown that with the current oversight, all the rules around monitoring, AML, it falls under all customer dispute, all regulatory oversight. We can do that today. It's even more transparent than other payment rails. And a good example of that is when we did that proof of concept with the trucking company, our risk monitoring software flagged it when we kicked that transaction off. And it flagged it because the trucking company, the CFO, had moved one penny from his wallet to the Mexican CoinDesk exchange. And so our software stopped it. We reached out to the CFO and we said, our software has stopped this transaction because you've done an interaction with a party that has been on some questionable transactions. And he's like, well, hold on. He goes, I just moved one penny or 1 peso from my wallet to the Mexican CoinDesk just to make sure I could test it and it was live. But that's insight you would never have before. And so from a regulatory perspective, or from a bank perspective, you truly have true real-time traceability across these wallets like you never had before. So when we're talking to the regulators about these proof of concepts, they're asking us how we're monitoring it, our answer is, you can sit in on that. You can do it real time. So that tells you about, one, the use cases internationally. I'll also say that transaction, and this I think gets to your point as well, again, this was an international transaction, flipping between tokenized deposit and a stable coin, cost us 28 cents. And that's obviously a very significant difference than the model today, where you're bouncing across correspondent banks. It's taking a while for that to settle, and you're paying components of that transaction along the entire path with every one of those hops.
And what would the cost be instead of 28 cents? What do you think it would be for that same transaction using normal rails?
So using a normal rail for Vantage, let's say international wire, that typically costs us all in about $6.78. So significant difference between the two.
Yeah, I mean, that's an unbelievable difference in costs. Plus now you're able to unlock new revenue opportunities. And I think that's probably something that you could dig into in a whole number of different ways. But it occurs to me that because of the legislation that's happened, everyone is trying to think, well, what do we do with stablecoins? What's the strategy going to be? How does tokenized deposits happen? Obviously, large institutions have big budgets. They have big IT and engineering teams. They have the capacity to be able to fund these things. And when you're a smaller institution, it's just harder. And there's just a certain amount of capital you need to have. And that's a reality that every small company faces. When you think about how much do you want to be able to build internally, how much do you utilize external service providers, it could be Custodia or Paxos or someone, how do you think about how you can be able to make sure that you're able to offer the right type of technology and have it be competitive in a way that will unlock opportunities for you?
Yeah, great question. And I think this is a very important part of this technology itself. So all community banks, we all have to punch above our weight. But for the first time ever, we can work directly with each other, and we should, and work directly with partners like Paxos on the infrastructure side, and we should. And that's exactly what Vantage is doing. So we're working with key partners to build these solutions. We're inviting other community banks to participate in this, not only for capital reasons, but also for the margins itself. We have the ability to do this directly, which is very important. Probably for all community bankers out there, we do this all the time at Vantage. We ask ourselves when we fall short, we hold a retrospective and we understand why we fell short and how we fell short. Quite often, we fall short when we lose control of that experience. So when we're passing that experience off to a party that we don't have control over, quite often for us, that's the core provider, something isn't as good as we would want it to be. The customer experience, whether that's an employee customer or an outside customer, isn't as good. But now, for the first time, we have the ability to work directly with infrastructure companies such as Paxos, such as Custodia, such as Infinite, the ones that are actually carrying those rails directly in a relationship between them and between all of us without having to pay tribute or without having to lose control. And I think that is a model that should be extremely exciting to every community bank. It's extremely exciting to us.
Yeah, because it creates a direct movement, whereas you might have to be going up and through different correspondent banks or other banks, and certainly, I think deposits are such an important element of how banking works, and there's a lot of questions around. Well, will deposits continue to have the same beta? Will they have the same duration? Could it shrink or will it increase? Like, how will stablecoins and tokenized deposits change those funding mechanisms? But one of the things that occurs to me is that, when you have an asset, but you can go do things with it, you can move it, you can do other activities, you're actually more willing to hold it in some ways. And it seems like in your experience, that's what you've noticed. Maybe you could talk a little bit about how stablecoins and tokenized deposits are playing out and how you're thinking strategically for the bank and what are the opportunities for them and where maybe are they in opposition, if at all?
Yeah. So our thesis on this front is it is an opportunity for the golden era of community banking. And that goes right back to that impact you can have with your customers and in your community that we haven't been able to accomplish to the extent that we've wanted to in the past. So for us, one of the things we're doing at Vantage Bank is we're sending all of our employees through a design thinking methodology. And I don't know if anybody in here has ever been exposed to that methodology. But the reason we're doing that, it's about understanding problems, opportunities, and how to build a solution. And our thesis around that is that'll be a new treasury management, new treasury analyst role, where you'll be going out to your customers. You'll be learning about different industries. You'll be sitting down and understanding how can we help you be more competitive? What are the things around payments will help you? How can we actually be part of your core workflows? How can we implement agentic solutions, meaning we combine blockchain and AI in your core workflow into a competitive advantage for your company? When you do those things, you are not only putting yourself in a position you never had before, but you're creating true value and you're creating stickiness. And so for us, community banks are in those customers. We know how they operate. We know what their vision is. And when you're going to actually help them fulfill that vision, let them have those victories along the way, those deposits are not only going to stay, they're going to grow. So we see that we'll have our commercial customers, our consumer customers will have their accounts at Vantage Bank. A percentage of those dollars will be held in tokenized deposits, and they'll be held in stablecoin. And the difference between the two will be kind of what they're trying to accomplish with those different money movements. So we think it's an incredible opportunity. And again, we just need to make sure that community banks understand that they have this opportunity to work directly with each other and do this in a way that we can impact our customers unlike we ever have before in the past.
change can be hard. I know in our own company, trying to use AI more on an everyday basis is not easy to do. You're trying to build new habits, and you have current habits, and it allows you to be able to do things a certain way. If you had to give an example or a piece of advice of how a community bank could begin to use this technology or begin to experiment with it, what would that be? What would be the easy way to elucidate that for your peers?
Yeah, first thing I would say is bring in a cross-functional team that carries different perspectives to the table. Break it down into small bites. Partner with people that you trust around this world, around this ecosystem, and that's what we've done. That's extremely important, and educate. So at Vantage Bank, we've partnered with the Texas Bankers Association. We're doing education for both customers and bankers every other week. We're holding lunch and learns for customers and prospects in our community, and education is a huge part of that. And then as you start to get that education in place, put together a cross-functional team that's going to champion some proofs of concepts, and again, work with those partners that you trust. And we're happy to help you with that, but just take small steps. It's important to take small steps. I've been talking about this now for a few years, and for a long time, I didn't have much attention on these conversations. And now, like I mentioned, we're on calls with banks many times each week, and I think that's an important step forward. But there are so many use cases. There are so many possibilities and opportunities. Again, it's an exciting time, and I truly believe it has the potential of being a golden era for community banks.
And another way of thinking about a stablecoin is really it's a rail. It can be an account in certain cases, but it's also a rail that's 24/7, instantaneous, programmable, transparent, very cheap, as you were laying out how it can significantly change cost curves. But of course, everything new also has advantages. It also has risks. Nothing is for free. You were laying out some ways in which compliance could actually be done programmatically, and that could potentially also change costs. But are there risks that you've come across that people should be aware of too?
Yeah, so as I mentioned, we always start with risk assessments and understanding the risk as much as we possibly can. And of course, we revisit that all the time. As I mentioned, tokenized deposits is really a modern rail following all of the oversight that the banking system has today. And so the risk around that are very similar to any other rail that you have in place. All the things you do with any other money movement, you do really the same things, maybe in a bit more modern way, a little less overhead. But when you move outside of that, and as these things continue to merge, there's several risks that we have our eye on. One is around smart contracts, the programmability of the blockchain itself. This will be interesting to see how it plays out. We're going to take a very methodical and bite-sized approach to that, but eventually there's a lot of power there. And where those smart contracts sit, we feel like they should be part of the blockchain protocol itself. There's other solutions that have those outside. We think that there's a lot of education, understanding, and potentially risk around that piece, but ultimately something we got to continue to advance forward. Counterparty risk is something that needs to also be considered. When you get to tokenized deposits within the banking system, the counterparty risk are banks. So that's obviously proven to be very safe. No deposit customers ever lost $1 in a U.S. bank. But when you move outside of that and you start working more globally, the counterparty risk, the understanding of potential depegging of that stable asset is something that we have to monitor. And of course, there's a lot of oversight that'll come with that after the Genius Act was passed. Beyond that, the monitoring piece of it, as well as the blockchain technologies themselves. So there's going to be a lot of fragmentation around blockchain technologies themselves, both private networks, public networks. Some of them are going to be much larger than others. The technology itself being decentralized counts on having these large networks working in a decentralized manner. So I think it's very important that we pick the right blockchain protocols for this to be successful.
And there are ways in which you were describing earlier how you've experimented with blockchain technology aside from the movement of money, stable coins or deposits, et cetera, but actually the movement of assets. potentially how you could tokenize different types of either loans or assets that your customers have. Maybe describe one or two examples of that.
So a really good example, and again, this I think is a good example to understand how this can expand the offerings that we have at community banks. So we started tokenizing assets several years ago, but about a year ago, we saw an opportunity to bring a lot of different fragmented origination systems from fintechs together into our origination system and then tokenize that onto our partner that we work with there. It's called Alpha Ledger. And what that accomplishes is it allows us to have access into all these different assets, alternative assets that we never had reach into before. But it also allows these fintechs to come in and have a bank participate in the underwriting of those assets, which is very important to the big asset managers. And then we've had these conversations with the largest asset managers in the world who never have had access to these high-yielding, fragmented alternate assets before, and now they're coming through a bank. Everybody gets the same information at the same time. It's all extremely efficient, very little overhead for us. So you have a fintech origination system automatically flow into our origination system, go through the bank's underwriting, get originated, and flow into the Alpha Ledger market. And now you have the biggest asset managers have access to this. And you can then extrapolate that in terms of what that does in terms of bringing accessibility to a lot of people that haven't had the opportunity to be in the banking ecosystem before. So it lowers those barriers and it provides avenues that we've never had before in ways that make sense for the first time. So that I think is a really good example of one, increasing the availability of both deposits and dollars to people that haven't participated in the system before, doing it at lower overhead, doing it at less cost, doing it at less risk, and bringing these things together in an efficient way that open up markets that were never open before.
Yeah, I mean, real world assets are still quite a small percentage of on-chain assets. It's basically a rounding error. Most of it's either crypto assets or it's tokenized dollars, actually. And then after that, you're kind of still in very early stages. But as you get more and more dollars, I can really imagine you're going to end up in a place where having that settlement capacity can then create the operational benefits for other assets to come on. Certainly that's been our thesis over time. One of the important elements that was in the Genius Act and also has created some consternation is the capacity for yield to be passed on to distributors in the stablecoin bill. That was part of the Genius Act. And I know there's been some concern of, well, is that going to actually end up creating competition for banks? Because right now they have a specialized position in how they're able to offer interest on deposits. What type of difficulties might that create because there's other ways to get yield? Or how much is that actually similar to, for instance, money market funds? There's $8 trillion of them. How do you look at the rewards-based distribution that Genius enables?
Great question. There's, I think, a few different ways that this can be addressed, and we're not sure exactly what direction this will go at the moment. But there's a few things with that question. I think it's important to protect the moats of banking. So when we talk about a tokenized deposit, that's within the banking ecosystem. So interest can be paid. FDIC insurance is in play. It can be used as collateral. We can lend on it. And then you move more into the stablecoin side, and I do think that rewards are going to play a role on the stablecoin side. And there could be different participants in that. There could be rewards. Let me back up for a second. I think the main concern about where stablecoins are and rewards is because the stablecoin issuer is deciding where those deposit funds go. And so that concerns a lot of us in the community banking industry is if they're going to select just the largest banks, is that going to cause a deposit flight? So I think one way to address this is to provide ways to do rewards to FIs and have some fair participation amongst the network of banks that are participating around this. But there'll also be rewards directly to customers themselves. I think those will take more of the play of loyalty points or those type of rewards. There's a lot of different ways to address this. But ultimately, we feel like as a financial institution, where we expect to be carrying a certain part of our balance sheet in stablecoins, there should be a yield back to that, even if we weren't the issuer, but we're participating in that network.
That makes sense. Now, I know we're getting close to time, and we wanted to make sure that this could be a little interactive. So we're going to open it up here and see if there's any questions for Jeff, or even myself, I guess. Happy to answer them and see if we can maybe answer 2 or 3 from the audience. Anybody interested? Any takers? Jackie. We can get her microphone. She's right over here.
Hi, I'll just stand up. I would love to hear from you, Chad, because you run one of the biggest stablecoin companies in the world. Like, how do you work with banks, and what kind of infrastructure do you have that could add value to people in this room?
Thanks, Jackie. So the question was, Paxos as an issuer of stablecoins, how do we work with institutions? And we're somewhat unique. We are neutral infrastructure. So we don't issue our own stablecoins. We issue them on behalf of other institutions. So for instance, we issue the PayPal stablecoin, which is the ticker symbol is PYUSD. It's about $2.4 billion now. And we've been issuing it for the last several years. And we don't do it for ourselves. We also issue something called the Global Dollar, and we issue that on behalf of the Global Dollar Network, which is actually almost 90 institutions. And there's several hundred more that are looking to join, and anybody can join it, and everyone can participate. And so our view is that we're going to be the infrastructure that enables firms to go out and issue stablecoins. I think ultimately there's probably only 2 to 5 really big stablecoins that can act as a rail. But there's going to be thousands of probably stable coins, and they can be issued by institutions. We see that today, PayPal being an example, but lots of small institutions now are issuing stable coins for their particular communities and their particular user base. You see that for different chains. You see it for different applications. You see it for different traditional institutions as well. And I think one of the biggest things that shifted is the Genius Act, and the administration have made it possible for there to be like a real experimentation phase. But because they're all working through blockchain technology, while you're getting a lot of experimentation, it is actually keeping a way of having a consistent interoperability, which I think is important. You don't want to have fragmentation without interoperability. Fragmentation with interoperability actually can be very healthy because it allows experimentation and it allows competition to happen. And it certainly you'll have large institutions, and I'm sure some of the large banks will issue stablecoins, and we've seen that. But we've also seen quite a few smaller institutions do it as well, and that's the exciting moment that we're at. And Paxos as infrastructure provider is here to make that possible, so that it's not something that someone has to go build and manage themselves entirely, because that can be quite an investment to make and a lot of time and learnings, which we've been able to do. We've been issuing stablecoins now for over 7 years. So we've been doing it quite a while. We do it through a New York trust. We're converting it into an OCC trust. So we're regulated just like a bank as the infrastructure provider, which is also unique. Thanks, Jackie.
Kim DeVore from Jonah Bank of Wyoming, and I have a question for Jeff. So when you speak about the infrastructure for community banks to put in place in order to operate on these rails, what type of, is there a de minimis level of volume that you need to be able to have in your portfolio before you actually recognize the savings from $6.78 to a 78-cent level? That if you're not a $5 billion institution and maybe you're a $570 million institution, how do you make that happen?
Great question. So I mentioned Vantage Bank is working to provide this infrastructure to other community banks. And we're doing that in a way that would be accretive with very low volumes, because we know that we have to lower those barriers for community banks. And so we have a model. We can walk you through exactly what that looks like. We believe that this will compound quite a bit over time. So we're willing to provide that model for community banks to grow over the next 5-7 years amongst that. Our model assumes that a $500 million bank with just 10% of their transactions that are on wires today go through in a year, it'll be accretive for you. So, and so we'll be happy to walk through that on a call. But we know that those barriers need to be low in order to get adoption and for community banks to work directly together. And we don't want to miss that opportunity.
Great. Right here. Sorry, right here. Thank you.
Hi, Congressman Foster. I'm the lead Dem on the Financial Institutions Committee in the House. One of the big challenges that everyone faces here is identity fraud and KYC and that whole nexus of things. And other countries are moving very rapidly towards having the ability to prove you are who you say you are in an online transaction by basically getting out their cell phone, doing the biometric login, and presenting what would be in the U.S. a real ID digital driver's license. And I think now the EU is going to have that by the end of the year. England just announced they're going to have it. It's been in place in Asia for a long time. And so this really avoids all kinds of things and potentially lowers the compliance cost for this. I was wondering where you see, is that something we should really make a push? I was just, when the Biden administration, of course, promised initially that they were going to make progress and they didn't do anything. Do you have any thoughts on that and how that could really make life easier for just automated KYC?
Well, look, I think one of the exciting things about being on chain is that it's transparent. So you're able to see how things are moving, and you can use a variety of on-chain analytical tools to be able to monitor transactions, to be able to freeze transactions, to seize transactions, and to build compliance tools that operate in an automated way that can actually lower your costs on a per transaction basis, as Jeff was describing. And there's different ways to be able to do that, including adding identity in as, say, an attachment to a transaction as it moves. There's different industry standards around being a VASP, virtual asset service provider, that require you to be able to understand where funds came from and where they're going to. And so I think there are a lot of these in place. They're not maybe quite as prescriptive as in other jurisdictions, but it's something that we expect and very much have like the frameworks for but they are evolving.
Yeah, I'll just add to that. So I mentioned earlier that we feel like tokenized deposits can get out the door very, very soon. We'd like to get out the door now. But that's between banks within the banking ecosystem where KYC, and all that is actually already occurred, and it's actually occurring on the transaction itself on the blockchain. When you move over to stablecoin, you're moving more into some non-bank areas and non-bank customers. There absolutely would like to see the U.S. move that direction. At Vantage Bank, we're using technology similar to that, like with Intersect, in order to do those kind of things. Again, we have about a third of our transactions internationally. So we would like the U.S. to have a standard component on that. Again, as mentioned, the blockchain allows us to do that in a way much more effective, much more efficient than we've ever had the opportunity to do before.
Question in the back.
Yeah. Hi, how are you? Carlos Garcia from Nave Bank in Puerto Rico. One question for you. What are your thoughts in terms of using FedNow as a payment rail for small businesses?
So we were a FedNow beta bank. We've had some challenges with adoption there. Again, I mean this with all respect, but our feeling is tokenized deposits is a better solution. It's 24/7. You're really just transferring the liability between two banks on the behalf of a customer. And so, our energy and efforts are really focused on the tokenized deposit side for us. We do offer FedNow. We just haven't been able to get much adoption there. Again, we feel like tokenized deposits will be a more effective rail, and then you can add the programmability to that, and that's what will start to compound over time.
Great. I think we might have time for one more question. Great.
Hi, Jeff, you mentioned rewards on stablecoin, and whether that's between providers and even rewards that would ultimately go to customers. And you also mentioned as a community bank CEO, the concern about deposit flight, maybe deposits leaking from community banks to the large banks. And I have the same concern about that. But when does a reward become interest, and which obviously is barred by this Genius Act? And how do you navigate that, between just deposit flight for community banks and rewards, interest, that whole spectrum?
Yeah, there needs to be much more work around rewards when it comes to stablecoins. Again, tokenized deposits can pay interest just as a deposit. And I think there's a variety of ways to address it. The way that I was speaking towards was, there being a consortium of participants, FIs, within the stablecoin participants, and their ability to get a reward that could be passed on to their direct customers is one way to address that. I think that is an important way that protects banks and also allows customers to participate in a reward program. You're effectively paying interest from that bank because the interest is first being paid to that institution. Yeah, that's personally the way I would like to see the oversight go, but there still needs to be a lot of work there. Other ways of doing it, of course, is just more on the loyalty point side. Things can get a bit blurry there in terms of, is that really an interest payment versus a reward? I think that's an area there's going to have to be a lot of focus and oversight. Again, where I lean always is go back through the financial institutions and allow them to participate with the stablecoin providers and do that in a way that's based off of the volumes. And again, I feel like community banks can protect those volumes because of the relationships we have with those customers and the impact we can make working with those customers within their core workflows of their business themselves.
All right. I know there's no doubt an endless number of questions, and we could spend all day talking about this. It's so fascinating, but our time is up. And so, Jeff, it was really great to spend some time with you. Thank you so much.
Thank you.
And thanks to the audience. Thanks.
Thank you very much. I'm going to let this panel introduce themselves. I feel like some people may need no introduction. So we're going to get started with winning strategies for community banks. Take it.
I'm Jim Cramer from CBC.
I'm Chip Mahan, sitting next to Jim Cramer from CBC.
I'm Tom Broughton. I'm Scott Deeser with First Financial Bank Shares in Abilene, Texas. Home of AI right now.
Well, first I'm going to thank Madam Chair, Vice Chairperson for this panel. There you are, which is amazing, and I'm honored, deeply honored to be here with the backbone of America and the people who make things happen, and that you put this together is incredible. It's a reminder that there are people in government who want this unified to go forward, and I thank you. It's terrific. All right, I'm going to start a little age traditional. I'm actually going to ask someone to tell me something good that's happened in their area right now. Just give me 200 words about something that's good.
Well, I can talk about the AI plant. We have the largest AI plant in the world being built in Abilene, Texas by Oracle. And it's amazing. We have 6,000 workers out there. They're spending $500 billion on it. It's amazing. And so Abilene is just booming right now. So
Fantastic.
That's a positive.
You bet it is.
Well, I think in my world, the short-term interest rates coming down is most helpful to the
No
community
question.
bank space, because all of us, a positive yield curve is going to help everybody in this room. And we don't have to make another sale. We don't have to do anything. We can just watch our margins go up every day. And so that would be very helpful to us, and it's happening a little bit. We could use more.
Peggy and I moved to Wilmington, North Carolina from Atlanta. And in Wilmington, North Carolina, we're growing like a weed. And most of my people in a town of 125,000 are highly upset that there's a 3-light delay at the corner of College.
There you go.
Yeah, that's it.
Well, okay, not stablecoin at the local university.
No, sir.
Okay, fair enough, to be sure. All right, so I thought that Vice Chairperson raised an incredible point, and so did the Treasury Secretary, which is that government right now is a threat to their business, that your business is being held hostage. And I thought there's a lot of good points about the government maybe suffocating. But I want to know, what do you think, and I want it to be a little more of a conversation rather than just a one-on-one, that I ask you. What are the biggest impediments to growth in your area for a small business person and for a small bank?
I say interest rate and regulation. I mean,
No question, regulation, and especially in rural areas, we've got to have sizing. When we went over 10 billion, and we did that during the pandemic because we grew $4 billion during the pandemic because we stayed open. And the deposits that moved over, all of a sudden we were 10 billion. I did not plan to be 10 billion. We were not prepared to be 10 billion, but all of a sudden the regulators expected us to act like a big bank. And I will tell you, it wasn't easy. Just in debit card transactions, we lost $18 billion a year. And so, and then all the people we had to hire, all the things we had to do, those of you that have not gone over it, take time and be prepared because it is very costly.
No, I want to tell before Chip starts, Chip is the largest small business administration lender in the country, so I don't want to call you a small bank because you are a large bank that happens to be located in Wilmington. How's that?
That is correct.
So what do you think about the impediments? Because in some ways, I think that you have been able to transcend by being a bank that is a technology bank, been able to transcend some of the things that have suffocated our country and our banks because of the technology you use.
Well, fundamentally, we reverse engineered this whole thing. Because if you think about my friends at the FDIC down the street, right? So we applied to charter this bank in 2007. Like Tom, I had started 2 other community banks in Lexington and Louisville, Kentucky, and we got them approved like almost overnight. So we basically hit for the cycle on this one. So making loans to veterinarians in all 50 states. So no core deposits, so we're going to pay up for deposits. All of our loans are out of area, and it's concentrated in veterinarians. But you have to unpack the business of our business, right? So if you think about an SBA loan, see if you can follow this bouncing ball. It's $1 million loan, $750,000 guaranteed by the U.S. government. Package that, sell it in an active secondary market, put 75 grand in your pocket. The SBA allows you to sell down to 10%. So if I'm making a loan to a veterinarian and she is 750 credit score, 221 debt service coverage ratio, I can sell 150 of the 250 at par to any bank in the country. So that leaves me with $100,000. I made 75 on the first trade, get a 1% servicing fee on the 750, so that's 7.5 points on the 100 you got left. And you put all that in your pipe and smoke it, and you basically end up with a 35% return on capital. So that's what we did in the very early days. And
now
then
you
if
have 40 verticals now. How do you find the eye of the tiger of 40 verticals?
Yeah, I mean, that's a really, really good question. So in the early days, it was very difficult to get information from the SBA. So under the Freedom of Information Act, we said, don't be a dumbass. Let's figure out who can pay their loans back, right? So of the 1,100 industries, we started going one by one by one. And in order to help the guys in the credit department, we said we are going to find someone who has actually run one of those businesses to advise the guys that are at the door of the vault. So we moved from veterinarians to pharmacists to chicken farmers. That's a whole nother long story. And it's worked out pretty well.
Yeah. All right, Scott, I want to go back to something you said, which is really important. We basically have 2 economies right now. We've got an economy that I think, I'm not going to use the word desperate, but must have rates go lower, must, in order to be able to be creative, in order to be able to grow, because right now they're too high. But then you talked about the notion of Oracle coming in. That's a second economy. And I like that economy, and it doesn't put people out of business. It creates businesses. But is that sustainable? Sustainable meaning, can it do what we talked about earlier, which is then create 200 small businesses around it, or is it just one and done? Because we know when we're done with the data center, 6 people operate a data center. But I would like to think that we do have that an effect that makes it so that whole area does benefit.
Well, they came to Abilene because we have the wind farms, and so green energy. But they've had to, that plant will use more than the whole city does. So you got to look at, you got to look at that. So they're building, there's lots of energy going in. They're building their own gas plant for energy. They're doing a lot of things like that. So you're going to see all those area businesses, but think about what it will do for technology, for us to be able to hire. We're going to be a technology area. For us to be able to hire better technology people to come to Abilene because they've got a whole fraternity there. And all the different businesses that will go with this, I think it's really a watershed that's going to hit us and help grow Abilene.
Well, I'm glad. I mean, other than Nucor, the great steel company, people are reluctant to build, or have been reluctant to build, in areas like some of the parts of Texas that you're talking about. And it's a shame because they don't. How do you get good schools? How do you get? I was in Harrisburg, Kentucky, to see what Apple and Corning are doing, and they've created a town that is just going to be one of the great towns in Kentucky because of all the different businesses that come from it. Tom, you are in the fastest growing area of the country, and also the area of the country that I think is the biggest reshoring area. Now, we hear about reshoring quite a bit. Is it dross? Is it political? Or is there reshoring in your area?
There is reshoring, but it's very difficult to make things in the United States.
Yes,
you need an infrastructure of a lot of part suppliers that just have all disappeared from our country, and I appreciate the effort, and I think we can over time, but it's not going to be overnight, I don't think, to bring back manufacturing back to the U.S. I mean, we talk about putting tariffs on furniture. Our area of Alabama, where North Alabama, has a fair amount of furniture manufacturing that's all disappeared and gone overseas. So they're making all the furniture overseas now, the nice stuff.
Right.
Or in Europe, but nice stuff's in Europe.
I think there's a lot of nostalgia by the president for High Point, but that's not where anyone makes even upholstery anymore.
It used to be.
It was king.
Yeah, right.
It was king. Wasn't that great?
That was.
I wish we could think of a way other than punitive. Maybe I don't want to have the government do more incentives because we don't want the government, I think, that much involved. But to get the schools to focus on trades and then get the government to focus on the schools, is that a way to do it? And I know that that's a neophyte's way to do it, and I'm with professionals. But where does it start that we can reshore successfully and not just from punitive behavior?
Yeah, I'll jump in the state. We're headquartered in Alabama, in Birmingham, and our governor, we have a very strong community college system that is emphasizing the old-fashioned trade schools now. They are building them. They're building them in partnership with manufacturers. Aircraft manufacturer in Mobile is sponsoring a trade school down in Bowman County, Alabama. So there are a lot of opportunities for new trades, and we do need to, college is not for everybody.
No, that's great. I mean, Tim Cook's from Mobile, and when I was doing some work on his biography, I was shocked that every business had left Mobile. There was nothing left from when he grew up there. Other than nostalgia, I had nothing to talk about. Now, I'm conscious, but vice chairperson right now is thinking, what are they doing? They're too far-ranging discussions. So let's talk about
Jim, I want to go back to education.
Sure,
Absolutely. This is something, we don't have enough good bankers. If you're out in the market looking for bankers, you can't find the level that you need, and it's all about education. So I was the catalyst to start the Excellence in Banking program at Tech, which is about 6 years old. And it was bankers coming in with the academics and saying, this is what we need to train. And so the curriculum is what we want, and it's 100% hire rate out of that program. We have not had one student not be hired. And not only are they hired, but they're hired normally a year before they're out. They know where they're going because they're in an internship program, and it's just an amazing program that they hit the bank and they're ready to work.
See, we need to tell these stories. So these are stories that aren't told. We know what kinds of stories are told. Now, maybe you could say that I'm a cockeyed optimist and I want to hear just only constructive things. Or maybe I want to hear empirical, realistic things. And yours empirical and realistic and I believe can be replicated in other parts of the country. But we have to have the fortitude to realize that it's not done overnight, but it can be done. You just described it.
And the other industries are seeing the success of this. Now, insurance is going in with tech, doing the same thing. Real estate is going in with tech, doing this similar program, because they want people ready to go to work and not what professors want to teach, but what we need taught.
Well, let's talk about bankers and finding the right banker, because all of you have been passionate about finding the right people, because if you can find the best bankers in your area, then you'll be able to grow better than everyone else. Is it an opportunity when a Fifth Third merges with Comerica to get bankers? Or is that just something where they become stronger in your communities?
It's absolutely a huge opportunity for many people. I mean,
Especially community banks.
every time there's a merger, many times we hire people, the teams we hire are people that have built and sold a community bank to a larger regional bank. And, for one reason or another, some of them don't like being in that system. And so they find our culture more to their liking and more entrepreneurial. So I think, all of us profit from hiring people from, larger banks. And the larger banks become, the more the community banks, we all consider ourselves community banks, right? Not regional.
No, we're
not
not.
regional, but we're a series of
Community
we're
banks.
11 Service First is 11 community banks.
But Chip, do you regard yourself as a community national bank?
I do. We're in all 50 states.
Right.
But you're a community bank.
Absolutely, absolutely.
And where do you
That's what I
find
love.
your people? You basically have a campus. You have people that who need to be both technology oriented and business oriented. Hard to find?
Yeah, we have spent about $150+ million on our campus in Wilmington, North Carolina. And I have lunch every other week with all the new hires. And typically, they say to me, I tried 4 times. I tried 8 times to become part of what your bank is. If you treat folks the way you want to be treated, they want to work for you. And we come to work too, so we started that very early days. So if you want to work at our bank, you need to show up.
Okay. Do you find, any of you find that it's difficult in a world where a firm or an upstart, a Klarna, the buy now, pay later folks want so much of your business? A Robinhood will be speaking later. They want your business. Can they get it?
I think they cause problems and some more, the people like Cabbage that we'd have a loan to a.
They wrote that one off.
Yeah, well, that's good. We'd have a loan to a small business. We had a $100,000 line of credit. We tell them, look, we can't loan any more money. You need to do this, this, and this. So the next thing we know, we find out that some lender like that has loaned them another $50,000 at a rate of 35% interest. And so the business fails. And of course, they're a general creditor just like we are, and they cause the failure. So I think those are lenders are more, I don't know, you disagree?
No, today, even, I see it especially in the mortgage market. These younger group, they were never taught financial, how to financially go through. They're not teaching that in high school today. And so they don't know that. So they really want to sit down with somebody. Yeah, it's easier to do it on the computer, but they want to talk through it with somebody and really know what they're doing. And that's where we have the advantage in banks, is sitting down and walking through that contract with them, helping them make good decisions, because the computer's not going to do that in that type of transaction. They need to know what to do and how to do it, and they want to do it right. And they learn a lot from it.
But at the same time, Chip, I think your customers, some of them want the merchant cash advances. That's good business for you, and they think it's good business for them. How's that going?
I think they're charlatan lenders, and I can't stand them.
All right, I'm glad you said that, because I know that's the word they use in your campus, and I was hoping you'd use that word right here.
Yeah, I want to take them out, which is what we do.
Can you? Because they are I'd say they're toxic. They're a poison to small business.
So we have partnered with a new company in the Silicon Valley, right? And so I watched a demo the other day where one of our lending officers is talking to a lady that owns a grease trap company. And this agent that they created called Sarah is listening to this conversation. And she has borrowed money from one of these charlatan lenders. So we now have the ability with OCR technology to go in there and create on the fly an automated credit memo. So on the first pass, it's 0.73. On the second pass, when you get rid of the 40% loan and you actually do some global add backs, you get the 150 debt service coverage ratio. So we can make that loan. Then we talk to the agent live who's watching all of this and say, create a commitment letter. Then I look at it and say, no, it's too long, cut it in half, instantly. So that is, I think, where this business is ultimately going.
All right, that's good. It's smart. Any of you using, I'm going out to, by reference, going out to Salesforce next week for Dreamforce. Their big push this year is going to be for Agentics. Is anyone using Agentics, and how are you doing to prevent fraud prevention with Agentics?
We're not using it yet.
We're using it the way that I just described.
Right. I mean, it works for you.
Yeah.
Yeah, I don't know. I mean, I'm concerned that you can hack them. And CrowdStrike's concerned, and Palo Alto's concerned. So if they're concerned, I'm concerned too. At the same time, I think that all of us want to benefit from the use of technology to get that efficiency ratio down. And if there's something that you can share that you've been doing, I know, Chip, you're the king of this in a lot of ways, but some of the let's say of a brick and mortar, what do you have to offer that you've been finding that is good about technology that is making so you get the efficiency ratio down?
Well, we're using AI in our phone center, and it's amazing. The bot is so smart, and frankly, people will choose him over, they get their choice. You get a person or you get the bot. And the bot's name is Finn, F-F-I-N. And so, but I was at the phone center 3 days ago and sat down and listened to all the calls. And our whole deal is get the customer, get them taken care of right there, and get their answer done. And that saves us time, it saves them time, everybody's happier. You know, that's efficiency ratio there. But Finn is just like a person. You can't tell that you're not talking to a person. And these 3 ladies that are programming him are putting all the personal comments in there, all the things that we do for customer service first, they're putting it in there. And I'm like, this is great. But, you know, it's amazing. Plus, voice recognition, where we do voice recognition. It's a software we use that immediately when they call in, we know it's them. And we also can tell that it's not AI calling in, it's them. And so you don't have all the verification, you don't all the stuff. We sign people up, they're ready to go. And it was so cool. The guy answering the phone that I was listening to literally, you know, knew exactly who it was, that was the person, and he could start giving them information. Another thing, to be efficient for them and for us, and the more people we sign up on voice recognition, the faster things go, and the better service we get.
I'll tell you, one of the big 3, I won't mention their name, took out their cell phone at a cocktail party I went to recently. He said, do you know that we will in 2 years have voice recognition? It's right here. I think that maybe we should go to Abilene for it, not New York City. You may have a better handle on things.
It's wonderful.
I do want to talk about what's going on in terms of, like, let's start with you, but you talk about 1 bank, 8 regions concept, but everybody seems to want to have decentralized bankers on the ground in their different territories. At the same time, you want to have central on some aspects. How do you figure out what should be decentralized and what needs and what can go back to where to have an asset light and then come back to headquarters?
At one point, we had 12 separately chartered banks. Some were state, some were, you know, national banks. We had a little bit of everything. That doesn't work, you know. And so we centralized, we put them all together, but everybody still wanted their turf. And so we kept their turf for 2 reasons. One, to make them feel better. And all backroom came in, and it was all centralized. Which the efficiency was huge at that. But what we did is we have 8 regions today. Each of those regions look like an independent bank. They have a board, they have a president, and they can make their own decisions up into a certain amount, you know, of course. And what it does is put that decision-making process closer to the customer, We look at what does the customer want. They want quick decisions. A quick yes or a quick no is much better than a long no or a long yes. And so we do that. And then these boards are made up of the movers and shakers of that community, the businessmen and that and women in that
These are
community.
the non-legal boards that you.
They are advisory board members, but we treat them, they are insured and everything else just like a board member because they sit on loan committees. And let me tell you, that is why our loans portfolio is so strong. If they don't approve it, it doesn't come up the ladder. But they know who to loan to, they know the people, they know the economy, and each of those regions has a separate identity. They look like the community they serve. And so that's what's cool about that board is it keeps it focused on that community like that community.
And Tom, you've got a regional CEO model that I thought was brilliant.
Very close to what Scott is talking about. We have 12 regions, counting our correspondent division. We have a chief credit officer in each of these regions. We have a regional CEO, and you know, they can make decisions. Now, we do have a fairly sizable credit staff in Birmingham, as you might imagine, and we have centralized operations, but not call centers. We do not have a call center because we're primarily a commercial and correspondent bank. Our correspondent has a centralized because we clear for about 200 correspondent banks at the Fed every day. But what I think, we also have a board, and we treat them like they're legal. We call them non-legal directors. And you know, in my first life, my cousin and I chartered some de novo banks, and we had a board, and we had a charters, and we had a controller, and everything. It was very, you know, and then we finally have gotten people away from that system. And for years, you know, when you couldn't start a new bank, which has been most of the last 20 years, we've been going to people and saying, look, don't start your own bank. Just join us, and we'll be your back office. You don't want to fool with the back office. You're not, if you're a good commercial banker, you're not good at that kind of thing. So that very, very similar system.
Now, can I just say, Chip, before you, I want you to address this, and you've got your own view of this, but you do talk about in some of your literature that you want lenders to sit down and see the customer to see if they have, and I've mentioned this before, the eye of the tiger. Now, that's something very, very local, but at the same time, you've got a very tough central division that makes it so that your default rate is ridiculously low.
We have about 170 lenders, and it is required that they sit down with a customer face-to-face. And what you're really trying to determine when things go bump in the night, because if it's an SBA loan, by definition, you don't have capital. So rates go up 350 basis points, you have a challenge. So a quick example of that would be hurricane in Live Oak, Florida. We have a chicken farmer there, the Ortega family. They lost multiple chicken houses, no insurance in Florida. So we then helped them extend payments. They sold all their cattle. They sold a 1963 Corvette. The Cuban community around them, they're Cuban American, put those houses back in a matter of weeks. But we picked them, and they have the eye of the tiger. And each lending officer has to basically prove that they have a relationship. When the going gets tough, you're gonna be victorious.
I love stories like that. When I was a Tallahassee Democrat, I only covered crime in Live Oak. I think maybe Live Oak's moved to a better situation when I lived down there. So we talked at the beginning for Vice Chairperson talked about, and Secretary Besson talked about what the administration is doing very quickly to try to change things. What would you, Secretary Besson, we didn't get a chance to speak to him directly, but what are some of the things that he should be thinking about beyond what he may have said today? I know the Vice Chairperson will relate what you say here.
Well, you know, it was such a positive interview, and he said so many positive things that really I'm coming out of this just, you know, I didn't come to talk, I came to learn. And I learned a lot. And where we're going is the right direction. We've got to get the regulations off of these smaller banks because they cannot take the amount of regulation. You know, he talked about loan servicing. We quit loan servicing years ago because of regulations. You know what? That wasn't good for the customer, wasn't good for the banking industry. But it's so, those are things that we got to think about and get that stuff off so that we can go back and do business and serve our customers the way we need to be serving them. And it's all in sizing too. You can't expect a $10 billion bank to look like a $100 billion bank. We're not. And so we got to go back and put that in place. And I will tell you, the fabric of this company is on our rural community banks. And let me tell you, they're taking the brunt of this. And I am scared to death one of these days we'll wake up and we won't have them. And that's a real problem. The diversity in this industry and the number of banks in this industry are so important because it diversifies that risk. And so, we got to keep what we got. We got to get de novos. We got to keep going. And we need to stand up for ourselves. And it was great hearing, I love Mickey, and I know, I tell you, she couldn't be at a better place for us. And you talk about somebody that knows banking and knows what she's talking about and tells the truth. And the Cent said so many things that are so true too. So we're headed the right direction.
Well, the de novo banks, they don't have a higher default rate than any other bank. And so why is it so hard to start a de novo bank? I mean, I'm very selfish because we serve de novo banks in our correspondent division, so that's very selfish on my part. But, when 1985, when I was starting our first bank, it was really pretty straightforward. I mean, you remember how easy it was?
It was.
I mean, and I know there's a group in a small town in North Alabama. Somebody told me yesterday that they're trying to raise $28 million. That's what the regulators want them to raise, and that's a lot of capital and a little.
28 million to start?
To start.
Jeez.
I think it's the state of Alabama. I think is requiring that amount of capital. I don't know to be for sure, but in any event, our people, they're not going to loan money to a body shop. I mean, our people try and hit home runs. I'll be honest about it. We hire people in our private banking department, and then they turn into want to be home run hitters, so everybody wants to, swing for the fences. So, we need de novo banks to loan money to, the body shop down the street, that kind of thing. I'm kind of passionate about it, sorry.
Yeah, just here's another quick story. So on that, so we got our charter on May the 12th, 2008.
Nice time to get started.
Yeah, and you know better what happened.
I'd say you got 7 more months before the bottom.
So we've come a long way. I got a call from the FDIC in March of '09 and said, I want you in my office tomorrow. We had raised $11 million worth of capital to start this bank, and I took the guy running the bank with me. And she said, Mr. Mahan, I want you to sell or liquidate this bank. And we had $150 million worth of commitments to veterinarians. And I said, ma'am, you have to do what you have to do, and we have to do what we have to do. And then my president got in the car with me and said, hey, Mahan, on a 1 to 10, how'd that meeting go? What are you talking about, right? It didn't go so well. Yesterday, I had my Fed exit interview. Lovely time. And I have told my, no, I mean, I enjoy it because they see everything with all these other banks. And I tell my folks really clearly, like, the regulators are undefeated, untied, and unscored upon. And you treat them as someone that can actually help you operate your business because of what they see. And I believe that in my heart of hearts.
Really?
I do.
Okay. Let me give you the flip side of why there are fewer banks. A bunch of us didn't feel, from Summit, New Jersey, a bunch of us, all ELK members, didn't feel that we had a good bank in town. There was no bank that would support the Little League, no bank that would support the Christmas. But look, I was the DARE officer. I mean, I was always the guy who had to go raise the money. So you knock on the door and you go to Wells, and well, we're not a bank. We're just, we're there. But you know what? We also wanted the cash out. We wanted the bid, and we got the bid. And then it went back to the way it was before we had a bank. I mean, it is true that some of us get into community banking because we want to flip it. That is, in some ways, the enemy to community banking, isn't it?
When I grew up in a small town, family-run bank in South Alabama, and people in town, important people, the lawyers, the doctors, the dentists, they wanted to be on the board of the bank. They wanted to buy stock and be on the board of the bank. And everybody out here, that doesn't exist anymore. The people in the community do not want to own stock in the local bank. For one thing, I remember you know, a few years ago, I was a meeting with the chair of the FDIC at the time, and I said, you know, the average bank in Alabama is going to make a 7% return on equity this year. And I said, you know, that's just not very good. Well, directors don't care about return on equity. They just want to be on the bank board and know what's going on. So mine kind of care. Mine really want to make a lot of money. So,
Well, I mean, when you have 5,000% return when as soon as you start, that's a lot of
so
money.
it's hard to have a community bank. We're not what I'm talking about. I'm not. But for people that run a smaller community bank, you know, if credit unions are exempt from taxation, why can't there be some threshold of size for smaller banks, minority banks, rural banks, you know, some criteria where you have a lower dividend, you know, a better dividend and a better tax policy for those people to keep community banks alive, because we're going to lose them.
No, that's very true.
They're all my customers, so I don't want to lose my customers.
No, the president is concerned, I think like many people in this room, about the housing industry, about how to get more homes. Look, I think that if you lower interest rates and you stop your tightening of the mortgage bonds, I think that we do a little better. But what I'm focused on is what is the real way to be able to get more homes built. I think that in each of your communities where you live, it's a pro-development, maybe not as much tight zoning, but who's the enemy to not having enough homes, and that we need, you know, that we're building the same number of homes as we did when we had half the people in this country. And I shouldn't use the word enemy, that's too subjective, but why isn't it happening?
You know, it is in Texas. We have a lack of housing in Texas, and so Texas is just booming on house building, and you just can't build enough. And, you know, I don't see really any negatives. I see a lot of things going on, and we're loaning a lot of money to home builders, and and we need it, and we need that housing, and because you can't bring them if you don't have some place to house them.
Right.
And so it's very important. Now, other economies may be different.
Yeah, but now your region, you've got, well, your region, some must be much harder than others to build homes.
Well, you know, for one thing, you know, the elephant in the room is if you didn't have, you know, illegal workers, we couldn't build a house. Okay. I mean, okay, nobody wants to talk about that. But
no, I know.
We need a guest worker program.
Yes, we do.
I mean, I think President Bush had a program. We need a program to have those people. You know, I know some of them, they own businesses, they pay taxes. They've been in business 20 years. They're illegal. Their wife's illegal. Their 3 kids are legal. So, I mean, so if everybody says, you know, one of our senators from Alabama, so those people need to leave, like, what are you going to do? You're going to kick those people out of our country. So,
although I did, my executive producers here, Regina Gilgan, I've got my list of third rail things I'm not supposed to talk about.
Yeah.
got it.
He just got him spanked.
Got it.
Look, I can go to crypto. That itself is third rail to some degree. But go ahead. I'm sorry, because you have a national view of things, and I know that you're lending to people like the cash pay veterinarians, but to lend to small home builders who are not Lennar and not Toll and not Pulte and not D.H. Horton is not easy. Those are not necessarily good credits.
Yeah, we're not really in that business.
Right, that is just a cyclical, tough business that you don't want to be in. Absolutely. Now, I do want to just talk a little bit about tech, and we did have a panel previously that talked about crypto and stablecoin and blockchain. My personal experience, I have a lot of businesses in Mexico, and the government, the Mexican government, which believe it or not, the Mexican IRS is far better and more efficient than the federal IRS because they're really good at what they do, that it's just a flag. It's a flag to be able to make it so that no one knows who you are. And so therefore, if you want to get in trouble, you set up an account like the gentleman we were talking about before. Now, in our country, it may be different, and maybe because of who I don't know, I got flagged because I got flagged. But what do you think about crypto, and what do you think about the need to do business in Ethereum, to do business in a currency that people are mostly buying because they think it's going to appreciate, not because they want to use it for commerce?
Well, I'll tell you what I think about crypto. That is where all our fraud is going, is through crypto.
Right.
You know, we can't facilitate fraud. We don't want to facilitate fraud, but every minute of every day, every every customer that I have defrauded pays through crypto. And that's got to be stopped. They have got to be under the same standards we are, and it's a real problem out there. Fraud is at an epidemic today.
Right. Anonymous wealth is the enemy of your bank.
No question.
Well, we have to find a way to police. I believe in it. And I have a lot
It's-
of theory and
yeah.
whatever, but I know that it's the way to hide.
When you have a little 90-year-old lady putting her money in a crypto ATM to send it because she's got defrauded, because they know if she comes to us, we'll stop it. But she goes to the crypto. And so something's got to happen there.
I agree with you.
And, I believe in blockchain. I believe in all we've heard today, that's coming and it's good. But I will tell you, they got to be under the same standards.
You agree? Because you're...
Drop the mic.
All right, now there's something that the Treasury Secretary said that bothered me. He talked about something that he regarded as quaint, and I think it's something that we can make not quaint again. I started mine at Western Savings in Philadelphia, a Christmas club, because my mom and dad said, this is what you do, and you get a passbook. And it was quite exciting. It was really exciting. Then I got my Macy's credit card. That was really exciting. How do we get people, I don't want to just talk credit and loans, but how do we get people to save in this country? How do we get Gen Z people to believe in the country enough that they do not start by saying, you know what, we're never going to be as wealthy as our parents? Because our generation, I like to think we're a similar generation, we all knew we were going to be wealthier than our parents. Why? Because that was God-given. That was the way our country was. How do we get people to believe to put some money away and stop it with the triple venti cappuccino with skim wet for $9.50 at Starbucks?
Put money in Live Oak Bank. We play top of the market on money market accounts.
You know what? That's a bet, compound is pretty darn good, but we do have to try to figure out how people can have, that we can inspire.
They're looking for a shortcut, Jim.
I know.
They're
I know.
going to buy some crypto, or they're going to...
No, they go to DraftKings,
They're
14
going to open a
parlay.
Robinhood account, and they're going to
I know.
leverage it. And so, they think coming to a bank like one of ours and opening a money market account and saving money every month, they just, they don't, but they'll figure it out.
Will
I
they?
believe those people will turn into us someday.
Jim, it's
they'll be baby
education.
boomers someday.
It's all education. But we got to get back into high schools and start teaching financial responsibility.
Yes, I
And
totally...
How to build that. Because you know what? I tell my youngins, when they're coming into the company, I do new employee orientation. I do a session in that, and I tell them, look at our profit sharing, look at the 401k, because that's what you got, and you're going to need to put as much in there, because you know what? Social Security's broke. What you're putting in today is going out to somebody else. It's not sitting there for you, and if you think it's going to be there to take you to, through retirement, it's not. So, novel thought. You got to take care of yourself. So start putting it back. And so, it's those type of lessons that we need to get down to that generation.
Well, this $1,000 Trump account, this could help. I think there's look, I want government smaller. I want our budget to be more balanced. This does not help that. But do you think that we can get people motivated with that $1,000? Do you think that can be explained to people what it could mean when you're born and you have $1,000?
It's a start.
Isn't it?
It's a start.
I thought it was smart. I mean, it was an intelligent, creative way. I wish we had more money as a government. I was glad to hear that the deficit would minuscule down. But you think it's an intelligent way to get people started?
I think it's ownership. If people have ownership, we want all our key bankers to be stockholders, because we want them to think just like I do, make the best decisions for the shareholders every day. And ownership is the greatest. Home ownership. We need home ownership in America. We need all those things that ownership gives you pride and it sense of purpose. So I think the Trump account, I think, is a...
Jim, 25% of our mortgage loans go to low-income areas. And we go into those low-income areas. We had a course this week that they went in. How do you prepare to buy a house? Just all,
right.
And we're going through, a lot of times we'll go through the churches. And the churches will have an event. We'll go serve dinner at the church and do, in these low-income areas, how do you buy a house? How do you get ready to buy a house? And then, but that's good business for us. And, I always tell the story when I do one of these, if you're going to rent, You're paying somebody else to own a house. If we can get you into a house and you use that same money for rent, you're buying your house. And there's a big difference.
No, very much so.
Yeah, so our chief technology officer told me to go see our guys that write code in NC State University in Raleigh the other day, and he said, you need to really sit down with this one really young guy he's a 10Xer, he's the best of the best. And I asked the young man, I said, we're trying to grow this bank 15% year over year, both EPS and the capital account. And historically, we took the bank public in 2015. It was an $800 million bank with $50 million of capital. Today, we're a $15 billion bank with $1.2 billion of capital. So I asked the guy, I said, so do you have $100,000? And he said, no, sir. I said, well, let's assume that you could go to your mom and dad and borrow $100,000. And you're 24 and I'm 70. That's a few years back. I said, if we could grow this business 15% year over year, by the time I got to the car, he had texted me, 100,000 turns into 41 million in that period of time. So the point there is financial education. If you understand what these things can do for you, pay attention. Pay attention.
Yeah, I think that in some ways we can go to what, Scott, you've done, lessons on service with Horst Schultz. I thought this was really important because if you have service, you'll know how to talk. You'll know how to present to each person what is service, correct?
That's right. Horst, those of you that don't know Horst Schultz, he's the founder of Ritz-Carlton. We hired Horst 6 years ago to upgrade our customer service first. We've had a customer service first program for about 15 years before that. So we're into it 20 years. I wanted our service to be consistent. I wanted it to be excellent in every branch, and so everybody's trained. Horst comes and trains them. And, to have the top customer service person in the world come and train about customer service. If you haven't read his book, it's Excellence Wins. Go get it, read it. It's an easy read, but it tells a story. He helped us design 21 non-negotiables, just like Ritz-Carlton. And Ritz had 20. We have 21, and we live by those. And what it is etiquette. What you say, how you treat the customer, how you treat each other. And it's an amazing, and every morning we have lineup. Every department in our bank across the whole footprint has lineup on one of those non-negotiables. And that way, every 21 days you're going through them. It's not the flavor of the month club. It is what we eat, sleep, and breathe and believe. And it's changed our whole, it has helped us grow tremendously. Luckily, he was in before the pandemic. That's one of the reasons we grew $4 billion during the pandemic, is that those customers came and they did not leave. And they're not going to leave when you give them that kind of service.
Now, Tom, you talk about disciplined growth, strong client relationships. Are the strong client relationships, do they start in a similar service mode?
We ask all of our bankers to touch their top 20 clients every month. I think, gosh, that's a lot. Well, that's just one a day, one a business
Right.
day. So we stay really close to the customer. And that's, if you're close to your customer, if you have a bad service, they'll let it go. They won't. They've got a good relationship, and we're their bank, and they're happy with us. So, staying close to the customer, I think, is the most important thing. And it drives me crazy when I talk to a customer and I said, when's the last time you heard from your banker? And I might not even remember who the banker is. And they said, well, it's been a few months. That just sets me off. I'm going straight to my
I got to open accounts with you guys. I never hear from my banker. And I got trying to run some businesses, and I don't even know their names.
I have a signature card for you this afternoon.
I like that. That's what we need. Now, Chip, you got the national footprint, but you still have been able to make it so that you have I'm sure with the veterinarians, you understood their concerns. I know that you also were in the family of someone with a horse veterinarian, but my experience with somebody like a veterinarian, they don't need you because they're cash business. How do you get their business?
So we're in 40 verticals in the SBA business, and we go to about 350 trade shows a year.
Oh,
And then when you
so
do that,
smart.
every business is small. I mean, whether you're going to the National Funeral Directors Association meeting or the NCP, the pharmacist meeting, I mean, all these businesses are small.
That is so brilliant. You figured out the verticals and where they are, as opposed to them hoping they come to you. That doesn't happen. Now, I'm conscious that we have, in a time of, I really do want to deal with some of the things that are the previous administration versus this administration and what can be done. The notion of risk-based versus capital, very important, right? I mean, we do risk-based. If all of you know and understand risk, I run a bank. I think I'm much more likely to get a loan from risk-based than someone who's just got some sort of table. True? I mean, is it looking better? Do you think that the regulators will frown on it?
I tell our regulators, they say, well, you need to do stress testing. I said, oh, we've done it. We had COVID, and then we had March of 2023. So those aren't the two best stress tests in my career. I mean, I've been doing this over 50 years, and I guess not full-time, but over 50. So I think we've all been down that road, haven't we? We've seen it.
Well, I have failed for 17 straight years to talk any regulator into what we affectionately call the Mahan ratio, because we are a $15 billion bank with $4 billion worth of government guaranteed loans. But that doesn't work. I mean, it's still 10%. So I can't get that exculpated from the risk-based capital ratio.
Well, I don't know which of the regulators in particular, because you have about 10 regulators that you have to deal with over and over and over again. We know how wrong that is.
I failed every time. They don't buy any of it. But it's fine.
Well, you're respectful. You know that does get you somewhere. To be respectful gets you somewhere. Do you think that we are any closer to the idea that perhaps there should be one or two regulators you have to talk to? Because I just don't know how much time you must spend each quarter just not helping people.
It's a lot.
It is a lot.
Basically, they never leave. Yeah, we finish one exam, the next exam starts, and somebody made the comment about that being a positive, that you do learn, and the regulators are a positive to us in the fact that they keep you down the straight and narrow road.
But I have to believe that many of them are still, look, they're directed. I think these people are in your community to some degree.
You're kind of touching the third rail here for us, Jim.
Yeah.
But let me say this.
I didn't even know I was on the second rail.
I want a choice because I have been told by, several people that the current administration wants just the OCC to be the only regulator.
Correct.
And I think that is not, because over time, I have found that the OCC can be politicized. And sometimes it's in my favor and sometimes it's not. So I think having a choice of regulators is in our best interest. Is that?
Oh, I don't think there's any question. I changed regulators. And there was a real reason I did, and it was politics. And so I'm at the Fed and very happy.
There you go. All right, when the secretary talks about too small to succeed, does that resonate?
It's hard.
It's hard.
And again, I go back to the smaller banks, it's harder. We've got to pull some of the regulations that have rolled down the hill to them, needs to be pulled back, because they don't need to be under the same regulations the bigger banks are.
If they have a simple business model and they're not trying to do anything esoteric, but the problem is some of these small banks will go buy 30-year CMO securities. They don't even know what they are.
No.
I sure as hell don't know what they are. And then all of a sudden their balance sheet's upside down because they did, things that were less than smart.
And I want to say something to that, because this is one of the courses I teach is a high-performance banking course. And when you look at banks, publicly traded banks, and you could look at family-owned banks, and it's very similar. You've got lower-performing banks, you got mediocre banks, but when you get out here in the high-performance banks, there are very few. Well, if we can take these banks, and this is what I want to do in my retirement years, is work on this and teach this course. If we can take those banks and move them to high-performing banks, we have a lot more vibrant banking system in this country, and we're a lot stronger. And so that is a real goal for me. Those banks that buy the wrong bonds, it's all in education, you know, and let's get that education out. You know, at our bank, I'm a firm believer in education. We've sent more students through Swigsby than any other bank in the country. And we do that I want my people as educated as they can be. The smarter we are, the better we are.
You know, my argument is I think most regulators think capital assets is the primary, you know, metric that they want to see.
Right.
To me, I think that's all wrong. I think it's profitability. If you have a strong,
Bottom line.
if you have a 15% return on equity, you're making money, and you've got some problems, you can handle them. But, you know, if you get in you know, we saw banks that had a good capital base when they got into 08, and they really had problems, and the banks, you know, some failed, some had to go away. So I think profitability is something that the regulators don't really care much about.
Well, that's ridiculous. I mean, profitability
is
your businesses. I want to look first at I want to see some profitable growth. All three of you have profitable growth. All three of your businesses look like businesses that I want to invest in. I do not want to invest in a bank where I have no idea what they own, because I know, therefore, they have no idea what they own.
But a little bit back to your business, right? So last week or 2 weeks ago, NVIDIA writes a check for $100 billion. So they traded, what, 50 times earnings?
No, 27 times next year's earnings.
And Apple's at
18 times 27 earnings. Apple's at 32 times earnings.
And Amazon trades at
Infinite. Well, 52 this year.
and the S&P's at 23,
Correct.
and we're at 9. And if you think about this business, it's a tough business, right? So leverage 10 to 1, you're buying into a blind pool of credit risk. You got a high fixed cost business, branches. I mean, we'll be a little bit different on this, but it's like, where is that going, right? And when you see these agents, I mean, I talked to our call center guy yesterday, right? So how's it going? Great. Right. What, we up? Yeah, we're up. We're up 10 or 15% year over year. Let me ask you a question. Are the questions the same, to Scott's point? They're the same. Will you send me the questions? 205 questions. So the average bank answers the phone in 6 minutes. We're at 2 minutes. Can it be 1 second, right? If there's that much efficiency and these agents can handle the calls that you talked about, Scott. But then where does that go, right? So everybody in this audience has a money market account at a bank, and that bank is paying you 50 bips. I'll pay $3.50. Why are you at 50? Because you opened that checking account when you were a kid, like you did, and whatever savings loan you talked about.
That's true.
So will an agent someday be able to move that, and all of a sudden we got to reprice the entire book of money market? It is, you know, again, basketball, you shoot 65%, you're in the Hall of Fame. Baseball, 400, you're in the Hall of Fame. In our business, if you don't bat about 99 plus, she's fussy, right? I mean, we got to go figure that out.
Well,
right?
you know, I look at your bank. The 9. This is a historically low PE multiple for your bank. So I go to try to research your bank with Ben Stoto, who's my research director, and I have to say, there's not enough. There's not enough research, because every piece of research is unbelievable, and I've got my file about what you've accomplished, and you know I got something in it, but it tends just to be the public filings, because where are the articles that I need? Where are the articles that tell me a lot? And there's 2 firms. Thank heavens for this Fortune magazine, Inside America's Top Small Business Bank, because you have 2 companies that write on you, and because you had a bad loan or something, they have a neutral. So to some degree, it's trying to get the story out. And thank you, Madam Vice Chair, for giving us a chance to tell the story out, because all of your banks, I find, I mean, look, I like NVIDIA and I like Jensen. I mean, look, I got to remember, in the end, I entertain and educate, but NVIDIA was a good one that I caught. But the only reason that worked is, you see, I named my dog NVIDIA, then America bought it. So maybe I got to name my dog Live Oak.
That would be good. That would be good.
But there is a problem. There's a dearth of information about all your you are all unbelievable banks with tremendous records. I did not, I knew Encino. I did not know your connection with Encino, other than I heard, well, it's connected to a bank. You generated more venture capital wealth than any banker. I didn't know it until I went to work on reverse. You talk about reverse vertical because I knew Encino, but these are stories that they don't get told. And I struggle over how to get more coverage for you guys and get more stories about you. And if I wish that maybe offline I can try to help, but there's just not enough coverage because all of your banks they're so much better than the average stock. And I wouldn't have known them if you haven't put this together. I'm pointing to the vice chair. It is. Why do you not have more coverage? Why do you think you don't have more coverage? What is the impediment?
We trade 200,000 shares a day. Nobody really cares.
It's liquidity.
Yeah. Yes.
Bank stocks are close to their, they're not far off our all-time lows.
No.
Right. March of 2023.
And I would tell you, we're performing better than a lot of businesses. And we're kind of the stepchild right now.
I think that's true. I mean, when I look at the non-performers, they're remarkably low. I don't want that to discourage the Fed from cutting because I think that's a different thing between the way the good discipline that you have in terms of your lending versus what we need to see, which is more lending, and that's part of the government's fault, and that's part of the curve, which the part that they could control. But I do think that when I look at your situation, if we could get your multiples up and get more capital to you, our country would be a lot stronger. And I struggle over how we can all do that. We need to tell the story of the bankers in this room who I know the liquidity is really only lends itself to the retail investor, but the retail investor is coming back in a very aggressive way. And we have to steer them not just to NVIDIA, but to something like your banks. I don't know you don't have the coverage right now.
No, we don't. No.
Well, look, I know we got to end on soon. I started with what's going well, and I'm not going to end on anything other than constructive. Tell me one thing the government could do right now after this meeting that would make things better. And I know I got to limit you to a very short period of time because I'm moving this thing over. One thing the government could do. Wow.
I can't think of anything.
I mean, less regulation. I've already said what I think they can do to help community
I just wish we knew which entities got to look different, change its style.
I think they need to hear what we heard this morning. And that's the most positive I've heard in any banking.
I thought so too. Funny you say that. I thought so too. Just positive.
It's just positive. We needed positive news. We needed, this country to have positive news, and we have positive news, and things can get better. And all of us want our banks to be better. We want the banking system to be better. And so let's talk about it.
Well, I'm from a different color state than you guys, and it doesn't seem to affect anything.
I'm more optimistic about community banking than I've ever been.
Me too.
Oh, that's
really
terrific.
And we could compete with the big banks. We absolutely can. The millennials have gone to the GSIB banks, and the lower end mass market retailers gone to fintechs. But there's a whole world of people left out there for us. Affluent.
Couldn't agree more. I got to get in one of your verticals. I'm in the alcohol business away from this job. I don't know if you're in that one, but oh, then we'll talk after. Anyway, I want to thank everyone for listening to our ramblings, because I hope they made sense to you, and to gentlemen, just fabulous, uplifting, constructive thinking, and Vice Chairwoman, thank you so much for what you did.
Thank you.
Good to know you, Jim. All the best. See.
Thank you so much.
to do this, so we'll give them a little taste of their own medicine. But Chuck Schumer proclaimed this morning that every day gets better for them. No, every day it's actually getting worse for them. And they're having a rebellion in the Democrat Party because they want to stop. And if you saw all of Schumer's, I watched last night like 10 different times over the years, he said, you can't shut down government, you can't shut down, and now he's the one that shut it down. So this is a confession that he's acting not to serve the people, but to serve the partisan interests of his party. And I don't think he's serving them well because they're way down. Look, they just lost an election in a landslide. You know, it was interesting. I watched Kamala. It was a sad figure. I watched her the other day saying the election was very close. I said, no, the election was a landslide. We won the popular vote by millions. We won the Electoral College by, I think, 312 or 315 to 220 something. But there's another one that we won that's probably, that's why when you see the maps are completely red. It's counties. The counties, we won at 2,505 to 525. So 2,500 to 525. That's called one of the greatest, biggest landslides in history. And that's one that people are using now as a primer. But literally, when you see it colored in, the entire country is red representing Republicans. So, you know, they go around, they just lie. They just lie. And everything's a big lie with them. Well, the other side, and the other thing I don't understand is, Christie, I looked at crime numbers in Chicago. They're through the roof. And I have a governor who stands up every day and tells us how wonderful Chicago is. It's just a lie. It's like a con job. It's like Gavin Newsom. He says how well he's doing in California, and they're doing terribly. Population's getting smaller. People are leaving. And other people are coming in. And, you know, I wouldn't say it's an even trade. While the other side is focused on playing games, the Trump administration is focused on creating jobs, bringing down prices, and we've really brought them down a lot. That's the other thing. We're bringing down prices a lot. We're bringing down grocery prices, but the big thing is energy. When you bring down energy, everything comes down, and the energy prices are way down. I see we're down to about $61 now a barrel, and what gasoline's going to be, I think gasoline's going to be below $2 at some point in the pretty near future. It's very low, much lower than it was under Sleepy Joe. And we're restoring law and order in our country. We're restoring it here, but we're restoring it right now. We're in Memphis. We're going to Chicago. We're going to other cities. Many governors are asking us to, including Democrats are trying to ask. I don't know what the big problem is. If I were a Democrat governor, I'd be saying, whatever you can do to get crime down, I'll take anybody. You can bring them in I don't care who it is. A lot of people said that. They interviewed women, these beautiful women in Chicago, black women with a MAGA hat, a red hat. They said, we don't care who he brings in here, but this place is really dangerous. We just want crime to stop. It's true. They don't care. You know, they don't differentiate between the National Guard and the Marines. They don't care. They'll take anybody. And that's the way it is. I mean, they want what we did in D.C., they want to happen to them. And it's happening in Memphis already. I see in less than a week, the numbers are really good. And it'll be great, and we'll fix that. We'll go to various other places, and we're going to be stopping crime in our cities. And that's a great thing, and we won't get credit for it, but it's a great thing. We've launched a historic campaign to take back our nation from the gangs and the street criminals, violent repeat offenders, illegal alien lawbreakers, domestic extremists, and savage, bloodthirsty cartels. And very little, by the way, is coming in by water, in case you haven't known. The drugs aren't coming in by water. In fact, we can't even find any boats in the water anymore. We had boats, we were like a subway train loaded up with drugs. Every single boat that you see getting taken out kills 25,000 Americans. Think of that. Because it's pretty tough stuff, but it kills 25,000 Americans. So when you hear that, it's no longer tough. But here in Washington, we've deployed federal law enforcement and National Guard to restore public safety, and we're working to replicate that in numerous places all over the country. And we have a very powerful military. We have a very powerful National Guard. I want to thank the governor of Texas, who has been, as usual, great. Governor Abbott, he gave us 400 troops without even a question. And we have other governors likewise doing what has to be done because they know we have to confront crime. We're directly confronting the sinister threat of left-wing domestic terrorism and violence, including the terrorist group Antifa. You saw that yesterday. We had a news conference. Antifa's out of control in Portland and other places, but mostly Portland in the case of Antifa. And we had people that were really badly affected by them. It was terrible. So one of those things, but we're knocking the hell out of them. And we're looking for the people that are funding them, and those people are going to be just as guilty as the people that smack people over the head with a baseball bat. And I'd like now to ask Attorney General Bondi and Secretary Noem to discuss this a little bit and tell where we are. And then we'll go around the room. We'll go quickly. We're going to go quickly if we can because we have a lot of things to do, including I won't be spending that much time here because I'll be leaving fairly soon for the Middle East. And I'm very honored to be involved with that, I'll tell you. It's a great thing for our country. People are so happy about it. I've never experienced anything quite like it. I've never seen such universal praise for being able to do something. No, it's something that nobody thought was possible, and we're going to end up having peace in the Middle East. Who would have thought? So, Pam, could you start, and then Christy, please.
Sure, President Trump, and despite the Democrat shutdown of our government, our law enforcement officers are out there working without paychecks, round the clock to keep and make America safe. Secretary Hegseth and I were recently in Memphis. We had 1,100 law enforcement officers in one room with us. The Memphis PD, they were the happiest to see us, don't you think, Secretary Hegseth, of anyone. We had ATF, DEA, FBI, U.S. Marshals. I'm not sure if our park police were there. We had Treasury, Secretary Bessent, and of course we had Secretary Noem's Homeland Security, all working together with the Guard. They were so happy to have us there. We've been making arrests left and right. So far, we made 562 arrests and seized 144 illegal guns just in the short time we've been in Memphis.
And many of these people are career criminals. And when you take them out of a place, your crime rate just goes down. These people commit crimes every single day. They're sick. And we're taking them out. In some cases, we're bringing them back to their countries where Biden allowed with the stupid open borders that we had in our country to come in. But they're being brought back to other places or they're being put in jail, but they're career criminals.
President Trump, last night alone, we made 91 arrests, 19 firearms off the streets, and one was a warrant for a homicide, and 4 sex offenders who had active warrants. One was a sex offender on a child. Everything we did in Memphis was worth it, in my opinion, for that one arrest. Think about that. We got a child rapist off the streets, but yet we've made 562 arrests and still going strong in Memphis. Just what we did in D.C. But it's because it's all of us. It's a team working for you to make America safe all together, round the clock.
Thank you, Pam.
Thank
You're
you,
doing a great
President
job.
Trump.
And it's amazing that we're not getting cooperation from Democrats. It's like, it's a new issue. You know, we have all the old issues of the wall and the border and all of the things, men playing in women's sports they still want that, transgender for everybody. All these issues are so crazy, but we have a new one. It's called crime. We stop crime and they allow crime. They want crime. It doesn't make sense. I think it's as ridiculous as the other things that we talk about all the time. But I've added it onto our list, a 5-letter word called crime. We stop it, and they actually incite it. It's crazy. You would think they'd want them. You'd think they'd want Christy and Pam and all of the people. If we needed the military, people will be there. We've got a massive military. We have the best numbers we've ever had for recruitment. We have a lot of people now. We have people that can't get into them. In a great economy, they want to be soldiers again. A year ago, they didn't want to even think about it. Same thing as with police and firemen, everything. They want to join. They're proud of our country again. Christy, go ahead, please.
Well, sir, thank you for your leadership and for deploying all of government to help us keep our country safe. You have talked extensively about how threatened our ICE officers are, but all of our law enforcement out there. And we saw the shooting in Dallas at that facility, so we're hardening all of our buildings and making sure that we have more security measures, snipers on the roof, people to protect our law enforcement while they're out there on the streets. But what I'm also doing, sir, is, and with your authority, is we're purchasing more buildings in Chicago to operate out of. We're going to not back off. In fact, we're doubling down, and we're going to be in more parts of Chicago in response to the people there. And then I was there a few days ago and looked at some facilities that we can deploy more law enforcement out of. Because what they're trying to do with these riots and violence is distract us and keep us from going after those murderers and rapists that are out in the streets. And then I was in Portland, went out and back on Tuesday, and met with the governor, met with the mayor, met with the chief of police and the superintendent of the highway patrol. They are all lying and disingenuous and dishonest people, because as soon as you leave the room, then they make the exact opposite response. So we're looking at new facilities to purchase. They're in Portland too, and we're going to double down. And I told them if they didn't meet our demands for safety and security on the streets and work with us, then we were going to bring in more federal law enforcement. So I want to thank Pete and the Department of War for all their help. They've been fantastic. But while we fight litigation and work with Pam on that, we're going to send more of our resources and men and women out there to keep everybody safe. So no worries. What we see in DC and what we see in Memphis for benefits for people in the safety and security, we'll see that in Chicago and Portland.
And the numbers in Memphis, it's only a week, but the numbers have been amazing, I understand.
That's exactly right.
The
They've
crime
been
numbers are way down.
fantastic, and it shows what a partnership can be between local law enforcement and the federal government. And if we have to do it the hard way in Portland and Chicago, we will. But the people demand.
And
the
President
safety.
Trump, my lawyers are in court right now as we speak for you, arguing in Chicago and Portland to keep them safe, to bring in the guard. The government doesn't want it there, but we do. We're going to keep their citizens safe, thanks to
The
you.
people want it. I don't understand the politics of it. I don't understand why a Pritzker is trying to protect people that are
They're more
really
scared of,
bad.
they're more scared of the anarchists that are on the street and the politics of it than they are of doing the right thing.
I think they're afraid.
Yeah,
I
yeah,
think
they're
they're
scared.
threatened. They don't tell us, but I think Pritzker's threatened by people. There's no other reason that this could be possible, that they don't want to have a safe Chicago. And we can solve the problem very quickly. And we're doing that anyway, regardless of if he doesn't want it or if he does want it, we're doing it anyway. So make sure.
I asked the mayor that himself. He said that Portland was perfectly safe, a beautiful city, no problems. And I said, well, why did you clear the streets for me today then and build out a 4-block radius to make sure I could get in and out of here? And these people on the street screaming death to ICE. There's graffiti that says Molotovs melt ice. We have the guillotines. We're going to use them.
Portland's almost different. It's like anarchists.
It is. It really
You know,
is.
it's really different than a lot
It's
of the
awful.
others. This is a sick situation, but those are anarchists. Those are people that want to overthrow government. They're really degenerates. And we're finding out who is supplying all of those beautiful signs and everything
Well,
else.
Scott's been fantastic. His team finding the financial networks is great. That's what
Okay,
gives
Scott,
everybody.
Scott will do that. That's easy for Scott.
We got a great team, sir.
That's good. How about we go to Marco? You can talk a little bit about what's going on and,
Well,
go ahead.
yeah, Mr. President, I don't know if one day perhaps the entire story will be told about the events of yesterday, but suffice it to say, it's not an exaggeration that none of it would have been possible without the President of the United States being involved. It really began with your trip to the Middle East, where these relationships were forged with partners in the region, personal relationships, close relationships that created the foundation where all this was possible. Where I think this really took a turn. Remember, a month ago, no one thought this was possible. Where it really took a turn about a month ago, less than a couple weeks ago, is when we were at the United Nations and you convened a historic meeting, not simply of Arab countries, but of Muslim majority countries from around the world, including Indonesia was there, Pakistan was there, and created this coalition behind this plan. Then on that following Monday, you met with the Prime Minister of Israel here, and that plan was presented. And then, of course, our great negotiating team followed up on it. In the interim, again, perhaps the stories will be told, perhaps they will never be told. The President had some extraordinary phone calls and meetings that required a high degree of intensity and commitment and made this happen. And I think what's important to understand is that yesterday what happened was really a human story. There's a geopolitical aspect to it, there's no doubt about it. It creates the conditions for Gaza to one day be a normal place again and people to have a better life and Israelis to be safe. But yesterday was a human story. And because of the work you put in, and honestly, not only is there no other leader in the world that could have put this together, Mr. President, but frankly, I don't know of any American president in the modern era that could have made this possible because of the actions you have taken unrelated to this and because of who you are and what you've done and how you're viewed. And this weekend, because of that, at some point very soon, we are going to see 20 living human beings emerge from the darkness into the light for the first time in 2 years. And that is because not only were you used the credibility and the power and the prestige of this office and the relationships you created, and you committed yourself to making it happen. And I think it will go down as a historic moment in the history of our country and something our country should be very proud of, that we have a president that's committed to not just peace, but to the human aspect of reuniting these families. My last point on this is just a couple of days ago, Secretary Lutnick hosted us all, many of us, at the Kennedy Center. And we have these families, we've interacted with them for so many years, for 2 years now. And the stories are heartbreaking, both whose families are alive and those who are deceased as well, who want their relatives back so that they can complete the process of grieving. And we had all hoped that perhaps that was the day that we would have an announcement for them on the anniversary of the 7th. But I know you were able to speak to some of those families last night. And I just hope the whole nation understands how incredibly proud they should be of their president and of their country for the role that they've played. And I don't want to let this moment pass, Mr. President, without also noting the incredible work of Steve Witkoff and Jared Kushner. They're an incredible team working together, facing some substantial impediments to even being there this weekend and doing it. Let me just leave it at that. And they've done a great job on your behalf, Mr. President, and they deserve a tremendous amount of credit. But thank you for what you've done for the world.
Thank you very much, Mark. I appreciate it. I think because we have a very busy day with all that's going on, what we'll do is maybe just a few of you raise your hand if you'd like to say something that don't talk too long. He's doing such a great job. So good that he could talk all day. That's the problem, right? But and what we'll do is just take a few hands and then we'll go back to getting peace done. Okay? We'll go a little bit quicker. We'll take a few questions from the press. Go ahead, please.
President Trump, I just want to double down on what Marco was sharing. It's such a remarkable accomplishment. Agree that no other president could have done this, but what set the groundwork for you able to do that? When you took office on January 20th, you made a 180-degree turn in our military strength with Pete's leadership. You were the master class in peace through strength. So militarily, we've completely turned around. We've demonstrated that through execution against Iran and others, that we have force. We want to end wars, but we'll use power if we have to. And then secondarily, peace through strength is also the prosperity, having the strongest economy and being willing to wield the power of a tariff in addition to the military power to reorder the globe. Those two things that you're standing on, both economic power and military power, allowed these negotiations to go forward. And I think as you've described the importance of these economic negotiations and all the trade deals, but that also begins with another 180-degree turn, and that was the 180-degree turn on energy. You have used energy diplomacy to bring prosperity to the American people, and you've used it to bring peace abroad. The combination of those three things have been remarkable, and now we're seeing the remarkable result. And we got one more that I know you want to end with Russia and Ukraine. Energy is going to play a key role in that. And now with this historic agreement, we're in a position working with the Middle East to also end the Russian-Ukraine conflict. So again, congratulations.
Thank you very much. I appreciate it. Maybe I'll go to you for a second. You can just cap out what he said about the military, how well we're doing and how big it is and how strong it is.
Mr. President, you're exactly right. At the War Department, you don't get peace without strength. And our job is to be the strength part of the equation and deliver that when necessary, as you demonstrated with your Order of Midnight Hammer, and the entire world saw. And I just want to echo what Marco said. It is a personal honor to be able to witness the way you lead and negotiate. I wish people had a full understanding of what that looks like, that historic nature. A lot of us vets, the Vice President, Tulsi, Lee, Doug, probably after decades of war and the chaos that was unleashed through reckless and foolish American policies, never thought this kind of peace would be possible. Yet, with your strength, with your ability to wield trade negotiations, personal relationships, to open up that opportunity is truly historic on the world stage. And it creates a whole number of other cascading effects. And watching Marco and the Vice President and Steve and Jared, the CIA Director, everybody come together to make it happen. You've formed a phenomenal team, Mr. President. And at the War Department, our job is to make sure if and when there's question about American commitment, the whole world knows we've got the biggest, strongest, most lethal, and most ready War Department in the world, which is true, which is why we saw record recruitment in 2025, Mr. President. The first 2 weeks of 2026 already blows that out. FY 2026 already blows it out of the water. In fact, re-enlistment has already met its year-long goal in the Marine Corps in 2026. Okay. You can't, there's no other way to create that kind of love and enthusiasm than with your leadership, sir. And it is an honor to work with Pam and with Christy and the cities across the country to make sure American citizens and law enforcement are protected with our National Guard. But that's a core mission. And last thing, Mr. President, on the southwest border, the first group that rotated in to lock down that border to 0 crossings is now rotating out. And with a new border medal, the Southwest Border Medal, or it's actually called the Mexican Border Medal, revived from 1918, that will be pinning on their chest. So thank you for renaming the department, and we're trying to live up to it every day. Thank you, sir.
I mean, think of this. We have record numbers of recruitment. 1 year ago, there were stories, front page stories, that we couldn't get anybody to join the Army, Navy, Air Force, Marines, Coast Guard. My beautiful, I call it our beautiful Space Force. I love our Space Force. It's turned out to be very important. But we couldn't get anybody to join. Nobody wanted to join, including our police and fire. They didn't want to join anything. Recruitment was embarrassing. We couldn't get anybody. And now we're brimming. Now it's, and they're getting in based on merit now. A soldier's a soldier. They come in now based on merit, not based on woke stuff that anybody can qualify. You have to qualify for jobs. You have to qualify for certain types of jobs. And it's amazing. So we were embarrassed a year ago. Think of it, a little bit more than a year ago. A year ago, I think it stopped on November 5th. I think it really started, this all started on November 5th, the election day. But now everybody wants to be, and we have an overabundance, and maybe we should raise it a little bit. I don't know.
I like that idea, sir.
But we could raise it. But we have so many people want to join, and they're proud of our country again. JD, could I ask you to say a few words?
Yes, sir. So just a couple of things. Mr. President, first of all, congratulations on yesterday. It was a big day. To Marco, to Susie, to the entire team, but in particular, viewing it from this perspective where for months the fake news media attacked you, attacked the entire team, attacked your approach. You know, the definition of insanity is to do the same thing again and again, expecting a different result. The reason we're here is because the president actually charted a different course with a different team. He vested a lot of authority in Steve Witkoff in particular, and that's why we're here. It's because you did something different, and I think it's important to recognize that. I also think the president, you know, Marco mentioned the president's personal touch being a big part of this. The one thing I would say is obviously the president of the United States, a New York real estate billionaire, one of the most famous New Yorkers in the world, has a lot of interaction with a lot of people who are very pro-Israel. I think that was an important set of experiences and life experiences that he brought to the table. He also, of course, knew one of the most famous Palestinians in the world, Chuck Schumer. And I think without that background of knowledge, it would have been impossible to get us to this point. Second thing I want to say, just on Chuck Schumer, the president mentioned this, that Chuck Schumer said this has been very good for us this morning about the shutdown. One of the things that we talked about before all the media came in, and that all of us are going to work on for the rest of the day, we've been working on for days, is how to make the shutdown as painless as possible on the American people. So while Chuck Schumer brags about this being good, and I think the president is right, it's not good for him politically as much as he might think that it is, it's causing real consequences for the American people. There's a low-income food program, the WIC program, that my mom actually used when I was a baby. That program is about to be underfunded and it's about to get cut off. because Chuck Schumer won't open the government. We have troops. Secretary of War mentioned how well we're doing on recruitment. We're trying to figure out how to pay our troops because Chuck Schumer is shutting down the U.S. government. There are veterans benefits that are going to suffer. There are Americans that are going to suffer because Chuck Schumer refuses to do his job. So while we're all celebrating this incredible success that we've had on the world stage, the country could be doing so much better if Chuck Schumer did his job and opened the government. Every single Republican, except for Rand Paul, has voted to open the government. A few moderate Democrats, to their credit, have voted with us to open the government. We just need 5 more Democrats to come to their senses and let the people's government serve the American people. I hope that they'll do that.
Thank you.
Thank you, sir.
Chris, please.
Yeah, to follow up on that point, Mr. President, the Democrat or Schumer shutdown did not begin 8 or 9 days ago. It began 8 or 9 months ago with your inauguration. For the first time in American history, every Senate confirmed appointee who are our deputies to run our department, every one of them has been filibustered. One of the critical parts of my department is the National Nuclear Security Administration. It maintains, manufactures our nuclear weapons and our engines for nuclear submarines and nuclear aircraft carriers. We are a key supplier to Secretary of War Pete Hegseth. They filibustered, the Democrats filibustered the leader, the administrator of the National Nuclear Security Administration, would not let him come into my department until the Republicans 2 weeks ago changed the Senate rules so they could confirm them and we could have a leader. They filibustered the leadership, now they're filibustering the funding. In the next 6-7 days, we're going to run out of funding, and the retooling of our nuclear stockpile, the ultimate guarantor of our sovereignty, is going to be underfunded, and we're going to have to slow down and creep to a crawl these efforts. Just incredibly irresponsible for Schumer to worry about his own reelection and not the 340 million Americans that count on the efforts of our military and all of our departments. It's truly offensive, and we need to bring it to an end as soon as possible. Let's open the government back up.
And you're doing a great job. Thank you very much. Bobby, did you want to say something? You got a lot of things happening.
A lot of things.
A lot of very positive things, actually.
Mr. President, I'm glad you're getting bipartisan accolades on the Mideast Peace Agreement. You should also get bipartisan accolades on the MFN agreement. It is an historic agreement that's going to benefit every hardworking American. It's going to lower the price of drugs for every American. By the time this administration is over, we will have 95% of the drugs in this country will be the lowest price in the world. It immediately begins to affect Medicaid, Medicare, Social Security, the other government programs. I remember when I went through the confirmation process, and the principal preoccupation of the Democrats during that process was whether I would continue the IRA negotiations on drugs. The Democrats negotiated 10 drugs. I'm supposed to negotiate every year 15. The 10 that they negotiated, they claimed to get a 22% reduction, but it was a lie. It was 22% under the list price, which was actually higher than the price we were getting. So Medicaid, Medicare ended up paying more for those drugs than they were getting beforehand. They only got a benefit on one drug. One was tied. 8 of them were lower. So they should be applauding what we're doing now. We're doing something that every administration, Democrat, Republican, has been saying that it was going to do for decades, and you got it done because you understood the power of the tariffs. We had leverage over these companies. And you did it in a way which you asked us to do, to negotiate in a way that was not going to stifle innovation, that was going to make sure that those companies could bring their production home, and they are doing that. And it was a profound success. It will affect every American for 100 years. And you should be getting bipartisan accolades on that. I'll say one other thing about Tylenol, only because of this. This morning before I came in here, somebody showed me a TikTok video of a pregnant woman at 8 months pregnant. She is an associate professor at the Columbia Medical School. And she is saying F Trump and gobbling Tylenol with her baby in her placenta. And the level of Trump derangement syndrome has now left
political landscapes, and it is now in the realm of pathology. And a mother could overwhelm millions of years of maternal instinct to put her baby at risk. And all you have to do is look at the studies which you and I talked about. It's not dispositive that causes autism. It is so suggestive that anybody who takes this stuff during pregnancy, unless they have to, is 15 rodent studies. Every one of them shows if you give it to the mother, the babies, and particularly the male babies, have profound neurological and behavioral changes. There is a study from Johns Hopkins on cord blood where they divided women into 3 categories: those who had the least acetaminophen in their cord blood, and those who had the most. The ones with the most had 3.6 times the rate of autism in their children. The middle category had 2.2 times, so it's a dose-related response. And there are dozens of studies that show the countries that use the most have the highest level of autism. Cuba has the lowest level in the world of acetaminophen use, and it has the lowest autism rate in the world. So this is not dispositive. It is not proof. We're doing the studies to make the proof. But in the meantime, the precautionary principle should apply. And any mother who is taking this stuff during pregnancy just to get back at Donald Trump is doing something that is pathological. And we're seeing that across the board. I got a lot of other stuff to talk about, but I know we got a short time here. But thank you, Mr. President. You're making our country healthier again.
Thank you, Bobby. Could you just say, for the record, state what the autism was, let's say, 20 years ago and what it is today?
In 1970, the largest epidemiological study in history was performed. 900,000 kids were looked at. They were looking for autism in Wisconsin children. They looked at every child in Wisconsin who was 8 years old. They found an autism rate of 0.7 per 10,000. So almost close to 1 in 20,000, less than 1 in 10,000. Today, the autism rates are nationally 1 in 31, but it's actually much worse than that because California, which has the best collection system, reports an autism rate of 1 in every 19 children, 1 in every 12.5 boys. This is a national security issue. There is nothing more important, and I'm grateful to you, Mr. President, because you know the flack that you take for talking about this issue. You've shown courage and you've shown leadership, and I can't thank you enough for letting me do this work.
Thank you. So think of that, 1 in 20,000, and now it's 1 in 12 for boys, 1 in 18, 19 for girls. So obviously there's something that's artificially, I think, induced, something, whether it's the vaccines in terms of these massive vaccines that are twice the size of a jar like that, of a glass of water like that, I mean, into a baby's body. And I've suggested get them in doses, get them in, maybe 20%, 30%, but smaller, not such a big. I think, that. And we had certain recommendations, the MMR, take them separately. The measles is already separate now, and it works out much better, but there doesn't seem to be any impact if you take it separately. If you take it as a combination, it's not so great. And some other things, but I would say don't take Tylenol if you're pregnant, and when the baby is born, don't give it Tylenol. You can avoid it at all, just don't give it Tylenol.
I'll say this.
Really, what do you have to lose? You really don't have much to lose. Yeah, go ahead.
There's also there's many other confirmation studies. There's 2 studies that show children who are circumcised early have double the rate of autism. It's highly likely because they're given Tylenol. So, none of this is dispositive, but all of it is stuff that we should be paying attention to.
Yeah. But, there's a tremendous amount of proof or evidence, I would say, as a non-doctor, but I've studied this a long time ago. I met Bobby in my office 20 years ago. We were talking about the same thing 20 years ago. And I was a real estate developer. It bothered me that it seemed to be getting worse, but it's so bad now when you hear these numbers. It's not even really sustainable. I don't know how people do it, but there is some very strong evidence on Tylenol. In fact, at one point, I guess the company gave a warning that gave.
They still don't recommend it during pregnancy. That's the weird thing.
They're not recommending it, and that's the company itself. So just don't take it. Don't take it. If you're a woman, don't take it, and don't give it to the baby when the baby's born, and I think that's going to have an impact. But I'd also get the shots in smaller doses. There are a few things, we gave a few things that just seem to be, and I think you'd get that number way back up. Think of it. You have 1 in 20,000, and now it's not even believable when you think that 20,000 drops to 12 children. So that's induced by something that's given or taken, and it should be able to be stopped. And you're
very much. We now have an excellent panel lined up for you, tailoring capital and liquidity standards for community banks. Thank you.
Thank you very much. My name is John Egemeyer. I am with Castle Creek Capital, and I will be moderating today's conversation. The comments we've heard earlier today cover so many of the capital issues that relate to the industry. What our goal is today is to try to put some specificity to things that can happen within the regulatory framework as well as the legislative framework. Let me begin with a few comments. And the story begins with interest rates, but I promise we're not the interest rates you think we might want to talk about. We want to look backwards over the last 5 years to what's happened because the industry has been impacted severely by COVID, by the stimulus that was put in place, and the various loan programs to stimulate the economy during COVID, followed by a flood of liquidity, and then a spike in interest rates. What that has done is to take us to where we are today at the tail end of an inverted yield curve that's been in place for 564 days, the longest in 48 years, and devastating in an industry that relies on spread income. It's hard to borrow at higher rates at which you're lending. So investors are not ill-informed. We've seen a response to that which has been serious as it relates to the availability of capital for community banks. And just to frame the universe here, since 2017, we've had a 45% decline in the number of banks in this country. Over that same time period, we've had a 35% increase in the number of banks, 500 million to 15 billion, which is in fact sort of the prime area of community banking. When we look at capital flows as an outgrowth of this time period, there's been negligible growth in capital flows into bank-focused ETFs, while the ETFs of the general market have almost doubled. You look at the IPO market, we've dropped from 7 to 8 IPOs, averaging $800 million each in the time period preceding the last 5 years. Now we're averaging below 2 a year, and the dollars being raised are only about 100 million. And as an anecdote, I would say there was one good year in the last 5 for raising capital, which was 2021, in which time there was $6.2 billion of new equity raised, but 80% of that went to just 4 banks: Silicon Valley Bank, Signature Bank, First Republic, and last but not least, Silvergate. As you all know, none of them are with us any longer today. So I'm not sure that's a model that we want to replicate here. What we'd like to do now is to dig into, if you will, the nuts and bolts of where capital can be created for community banks as we bridge to this period when public can again return to our sector, but we just don't know when that might be. So we're going to begin with the community bank leverage ratio. And I've asked Kathy Owen to lead us off. She is the CEO of Eagle Bank. I'll let her say a word about her bank. And she is a participant in that program. And give us your thoughts. Why was it attractive to you, and why is it not attractive to others?
Absolutely. Thank you. Yes, I'm the $490 million Eagle Bank and Trust out of Little Rock, Arkansas, not the massive one you see up here. And we are a privately held bank, and as was mentioned, we do participate in the CBLR ratio. And I've been asked a number of times as to why so many community banks have not chosen it. And I think we have to start with the very beginning, the timing of it. If you think about it, that simplified CBLR was published September 17th, 2019. What's the busiest quarter for banks? It's the final quarter of the year. It was effective 1/1 of 2020. What did the first quarter of 2020 bring us? COVID. Everybody was drinking out of a fire hose for an extended period of time. I feel certain for a number of community banks, it got shoved aside. It was optional. It wasn't important. I'm really excited to hear earlier today about the building of the framework of education, because so many of our smallest community banks are lacking in resources, and they need that education and could greatly benefit from the time savings of utilizing the CBLR. And it's not only the time savings, but the burdensome, cumbersome, a lot of adjectives there on calculating the accurate risk weighting that is necessary to really do it properly if you choose not to go with the CBLR. There's also community banks that haven't chosen it because their capital or their Tier 1 capital may be close to 9%. They're afraid they're going to drop down below it, maybe get out of the grace time frame, that period that's there. So they want to continue using the risk weighting calculations because they don't want to have to reinvent the wheel. And then I've also had bankers tell me that their regulators have asked for the risk weighting calculations even though they've chosen the CBLR, which if they've chosen the CBLR and they qualify, it should be acceptable, and there shouldn't be another question as to that. But I really think that one of the most important things for the smallest community banks that can benefit the most is the lack of resources and the need for education on how beneficial the CBLR would be to them.
Thank you. Turn to my other panelists. Anybody else want to weigh in on this subject?
Yeah, go ahead.
Yeah, hi, I'm Tom Fraser. I'm CEO of a $3.4 billion mutual holding company that has five mutual banks in Ohio, Kentucky, West Virginia, and Virginia. And we were initially elected to use CBLR, but we floated too close to that 9% ratio. And the consequence of going in and out and back and forth turned us away from the CBLR ratio ultimately. Some things too, especially with COVID, with it hitting in 20, we had an influx of liquidity and deposits. That put a lot of pressure on that 9%. So a quick fix, a quick idea would be to maybe exclude deposits that are held at the Federal Reserve or other low risk or hardly any risk weighted ones. And that, if that's excluded from the CBLR calculation, I think in our case it would have been about 60 or 70 basis points to capital. I know other institutions I've talked to, it's more. So that's a way to create a buffer even beyond what that 9% is.
Yeah, I think, taking off on Tom's comments, if you exclude that excess liquidity as defined by balances held at the Fed, in my case, my numbers go up by about 115 basis points, which is a big number. And if you think about CBLR at the 9% level or even at the 8% level versus a leverage ratio for well capitalized, which is 5%, there's a pretty big disconnect and a big buffer. And so, our thought process is that we need to better align those, or if not, figure out why in fact there's that big difference. Even at 7.5%, that's 150% of the Tier 1 capital ratio to be considered to be well capitalized. So I think it's a useful tool. We don't use it. I think something like 41% of the banks that are in the country that are eligible to use it. Only 26% of banks over $1 billion utilize the CBLR framework.
Yeah, I'm Mark Schifferdecker. I'm from GN Bank in Kansas, and we're a $1 billion privately held, family-owned bank, and we do also, like Kathy, use the CBLR. But we still go back and just test and see where we are against the risk-based capital. So I went back and looked in June 30th. Our CBLR minimum capital rate was $23 million more, or 35% more than total risk-based capital minimum requirement. And I think about that for a bank our size, that's 1/4 of our capital. So it's so punitive. I know Governor Bowman has said that, the CBLR is very underachieved, and I think that's exactly right because it's so punitive. If I could take that $23 million of capital, leverage that up 12.5 times and loan out 80% of it, that's about $200 million. Not that I would do that, but that's the kind of capacity that's holding back in a bank our size using the CBLR rules.
So a question for those who have adopted CBLR, has it reduced the paperwork involved with actually computing capital ratios to any material degree?
We did a quick study, and I apologize. My name is Jim Vaccaro. I'm the CEO of Manasquan Bank. It's a $3.4 billion mutual bank, born in 1874, so we've been around a while. I went to my accounting department and said, how long does it take on a quarterly basis to calculate the risk-based capital versus CBLR? Somewhere between 3 and 5 hours a quarter. So it's not punitive in any fashion.
Yeah, I'd echo that, using it. That's one of the reasons why we had a lot of capital, and I estimated originally it was taking 5 or 6 hours a quarter, which isn't a lot, but we're always looking for efficiency. But we still calculated, and I would say it's about 2 hours a quarter in our going through Schedule RCR. So
you're more efficient than we are.
Well, of course, yeah. But we have not achieved the efficiency. I mean, it's great. It's easy to complete that. And I would echo what Thomas said. Just some real, easy tweaks. I mean, number one, the 9% bright line is very, very punitive. And I know Governor Bowman and others have talked about lower, per statutory levels, it's between, I think, 8 and 10%. So you can lower that down, whether 8% is the right number or something less. But also these low-risk, non-risk assets, investments in Treasury securities, cash at the Fed, those would be quick. And even the smallest community bank, I mean, that wouldn't be a full-blown risk-based capital calculation, but you can do that on the back of an envelope pretty quickly, and that would not really substantially add to the complexity of calculating your CBLR.
Let me move this conversation in a slightly different direction and pass the mic down to Greg to talk about risk weightings, because I know it's a subject you've thought a great deal about.
Absolutely.
And not all risk is created the same.
Well, thank you. And I'll just comment quickly on the CBLR. So Greg Hayes, I'm the president and CEO of Kish Bank. We are a $1.8 billion community bank based in central Pennsylvania. I like to say we serve everyone from the Penn State student to the Amish, which is a broad dichotomy, especially based on some of the technology conversations we've been having today. For us, we are publicly traded, so we are traded on the OTCQX market, which means we have to look a little differently than my peer panelists here that are either mutuals or privately held. We've got to manage capital very efficiently to be able to produce the kind of return for our shareholders that's effective. There was some talk in the previous panel about earnings and how earnings can help a lot, and maybe earnings should be considered in how you look at capital ratios. For us, it's credit quality. Our earnings are pretty strong, but we manage a very high quality portfolio as a community bank, knowing our customers very well, knowing every deal, looking at every deal. There's only a certain amount of earnings you can get when your credit quality is that strong, and your earnings are what in a publicly traded bank, I've got to pay, a dividend, at least if I want to keep shareholders happy, and grow capital as well. And so to support the loan demand of our communities, when we look at CBLR, it is restrictive. I think leverage ratios are meant to be a backstop, and not necessarily that binding constraint that holds us back from growing. And I think the ability for us to manage capital efficiently through a high-quality loan portfolio is really what drives our capacity to support our communities. And so for us, we look at the ability to look at risk weightings and risk weight our entire balance sheet in a way that puts every ounce of capital to use in the best way possible. We recently took a portfolio of commercial real estate loans that we have, and we said, okay, you look at every nuance of the guidance and the regulation that's out there, and you say, these loans that have this debt service coverage ratio and perform or have a loan to value below this amount, we can drop those from 100% risk weighting to 50% risk weighting. Well, that freed up $1.5 million in capital or $15 million in lending capacity because we have the ability to look at those risk weightings in a very discrete way. That said, it's extremely complicated, and there are opportunities within risk weightings. When you think about loans to individuals who own their house, it is their primary residence, and you think about the 50% risk weighting, maybe there's opportunities to look at that differently. I understand construction, tract lending, how do you manage based on risk? As well as commercial real estate where it's owner occupied. I think there are opportunities for us to look at the risk weightings as well to help institutions who manage a very high quality loan portfolio put that capital to work in their communities in the form of lending.
Well, that really goes back to tailoring and indexing, that if we could get to the point of tailoring and indexing, then we would know where our capital ratios needed to be.
I think intuitively, we know where they should be. And so you don't manage necessarily to do that capital ratio. You manage to the market demands that you have for both your depositors and your borrowers. And then you look at your capital to make sure it's adequate and well capitalized in every single respect. But the driver should be the business opportunity and making sure that we have enough. And we talked a little bit about diversification and concentrations and the like, a lot of which came out of the 2008 banking crisis when the world ended. And are those kinds of guidance and concentrations still applicable, or did underwriting change dramatically from collateral-based to cash flow-based? And I think those changes have not yet been reflected in the capital regulatory guidance.
I think it's interesting. I've been in banking since 1968. I won't calculate how many years that is, but it's a couple. So I've seen pretty much every crisis that has occurred since that time. I don't believe that there has been a credit crisis over that time period that has ever repeated. So fixing what happened last cycle is no guarantee that we are prepared for the next cycle. And I think that's one of the challenges that we have as an industry. It's one of the challenges that the regulators have, and I think it is one of those question marks. As much as I am excited about the idea of tailoring regulation to understanding the nature of the business, the challenge will be there still has to be some quantitative standard against which you're still trying to equate the risk of the business with the amount of oversight and capital and liquidity that's required by institution. And I think the challenge I see sitting on 4 bank boards myself, that there is a great deal of difference between how examiners in one district look at something versus examiners in another district. And we were talking earlier that's true even within different exam teams. Greg?
I would just add to the complexity of it, but also to Kathy's comment about indexing. When we think about what a $500 million bank was 10 years ago versus what it is today, or us as a $1.8 billion bank 10 years ago versus where we are today, it's a different set. And indexing, getting to the right starting point today and then moving forward, inflation probably isn't the best way to index. And I know I appreciate Secretary Bessett's comments, but GDP growth really is when you think about the economy, how banks and the value of what we're providing to our communities expands. And our growth in GDP is, we think, an excellent way to consider indexing as we go forward.
Yeah, some of the last panel, I think they were asked if there was one thing you could change, and I think for our bank, as community bank, indexing would be very high on the list, because it's held us back, and it's just micromanaged the risks that we can take and the expansion we can have. And so if there's one single thing, and I know Governor Bowman and others have proposals for indexing. I think the ABA's been working on that as well. But I think that'd be a game changer for community banks.
Just to comment on how thinking has changed, the legislation for the Genius Act, and I know we're talking about capital, had a financial requirement level for the reporting of reporting financials was set at $50 billion. I crossed $1 billion and I had to comply with FDICA compliance, but yet a stablecoin issuer is looking at a $50 billion threshold. So that's the threshold mindset in new legislation today. There's got to be better parity.
I agree with that, Greg. I see it at the 10 billion threshold as banks queue up to go over that 10 billion threshold. And as a public company, about the only way you could successfully do that is to make an acquisition that carries you several $1 billion over that, because the expenses involved are extraordinary. And to do that without being able to absorb a lot of that expense through merger accounting is pretty difficult. So you have built in something to the structure of how we operate that requires consolidation of the industry, which is not exactly what our objective is. So
there's another dynamic, and that is the consolidated capital requirements at $3 billion and greater, which disadvantage the holding company level when you get to that number. And again, we're talking about thresholds and what are the appropriate applicable thresholds in today's environment. I think that's need to be relooked at. Tom has been a champion of the mutual banking industry and working very diligently with a lot of legislative effort also on the mutual capital certificate. So,
yeah, I'd be glad to talk about that briefly. And thinking about the small bank policy statement, something in excess of $3 billion for holding companies, whether they're mutual or not mutual, very, very important. So, Jim, I'm glad you brought that up. Just briefly on mutuals, we're a subset of the banking industry. We talked about the diverse and very banking system we have. Mutuals play a big role in it. We're about 10% of the charters, about 430 charters that remain, and we complement and fill in the gaps where other banks don't all the time. Conservatively managed generally and owned by the community. So we don't have outside shareholders. Traditionally, our only access to capital has been either retained earnings, and for those of us that have holding companies, subordinated debt. And subordinated debt can count as Tier 1 capital, but it's transient, fleeting, and not a sturdy foundation for long-term growth. So we have the same capital needs that all banks do for growth, for innovation, de novo formation. Very excited that 3 years ago we had the first de novo mutual form in the country in New Hampshire. Needed for capital planning, acquisition, and accounting, offsetting, taking the edge off of a fair value mark, and for general risk management purposes. But for 50 years, mutual banks got disconnected from the capital markets. It's legal, it's permissible, and it's not the blame of anyone. It's just the trends and different capital schemes as they formed and evolved. But I'm excited that in the last couple of years, we've dusted off provisions. It's legal, like I mentioned, it's legally permissible, and we've had 3 capital raises. So one of our 5 banks is a minority depository institution. It successfully completed a $5 million capital raise, but there was a consequence in doing it. And it took the entity in New Hampshire that formed, it took one of our subsidiaries and another one somewhere between 12 and 24 months to get approval to do it for something that's legal and permissible. And no complaining about it. We're in uncharted territory or territory that hadn't been visited in half a century. But there's a real opportunity here, and we appreciate some of the dialogue we've had with the Federal Reserve and other regulators for the 3 regulators to standardize and clarify what the pre-approval criteria are so that we can be pre-approved, that we can go to the market in 2 weeks, a month, without having to go through spending $500,000 on legal fees to raise $5 million in capital, and to generally have predictable outcomes. And I think in any capital solution we come up with today, or liquidity solution, standardization, clarity, pre-approval for low-risk actions, and predictable outcomes is an important outcome. And then finally, for the mutuals in the room, and there are several of us here today, to have that being part of our capital plan and accepted by regulators. I think if we can achieve those objectives of standardization, pre-approval, predictable outcomes, and it being regulatorily acceptable in a coordinated way among all agencies, that's a win. So
I want to now take a step back and look at how I think about capital adequacy. I think the numerical number of capital that a bank has, measured however it's measured, is certainly one indicator of stability in the bank and its ability to be safe and sound. But a comment was made earlier, which I agree completely on, which is the profitability of the bank and the source of that profitability is perhaps more important than the level of the capital. If you're earning 150 basis points on assets, you can replace a lot of capital that is lost through the deterioration in asset quality. And then I think the third leg to this stool is liquidity. And I'd like to now pivot to that discussion. The events of 2.5 years ago, to me, were absolutely frightening. Like I said, I've been in the business for 57 years. I do not recall ever having seen a deposit run. And you can ask yourself why. You know, why did this occur? I mean, if Silicon Valley actually raised $1 billion of equity the year before, was it really an equity issue? Having been very close to that with one of my banks that I'm involved with, social media played a huge role in that. And so as we think about liquidity and how should we be managing liquidity on a go-forward basis, I'll throw that out as an important regulatory issue which is the ability of the bank to monitor social media. I realize the run that we had were isolated to large banks on the east and west coast and not the middle part of the country. But that does not mean that it cannot occur in the middle part of the country. So to my colleagues who are here from the middle part of the country generally, central Pennsylvania is considered Midwest, I believe.
Yeah, you could consider, you know, as we get towards Pittsburgh, we get a change in colloquialisms that call you Midwest.
So did the events of 2.5 years ago change how you thought about liquidity? Greg?
Well, yeah, I'll start off. For us, we've been growing at a significant pace, and the competitiveness for deposits in the traditional community bank model has created the need for us to manage liquidity differently and manage our balance sheet differently and hedge interest rate risk with more complex balance sheet management. But liquidity, for us, it's the access to off-balance sheet liquidity that really is the tool we have. And it is a diverse set of products that are available to us that are very complementary. We and our friends from the Philadelphia Fed are here, use the Fed window every day, and we use it quite a bit, but we use it as part of our managing our duration risk. We will borrow from our FHLB friends. We will use brokered, both CDs and more liquid brokered deposits. We manage our Fed borrowings, other sources of borrowings, and it allows us to manage growth. It allows us to manage our liquidity, but we pledge all of our assets for immediate availability. It's not next day. If we had to sell a security, we'd have to wait a day or two to get that liquidity. This is immediate access to liquidity that is more than 50% of our total assets. And access to that kind of immediate liquidity allows us to manage the balance sheet. And when you think about the Fed window and the FHLB, they're very complementary, especially for us. And we're in and out of different positions because it allows us to manage interest rate risk. And if you look at our margin over the last 6 years, we have maintained a margin between 320 basis points and 340 basis points steady for 6 years in one of the most rapidly increasing rate environments we've ever seen, as well as now what we're seeing is a normalizing of that yield curve and rates, short-term rates coming down. And so we've got a great finance team. They do amazing work. We've got a great leadership team and board. We're involved, we're engaged, we're having conversations every day. We're settling sometimes twice a day because we know that liquidity is what creates the issues for banks. The answer to the question is always more capital, but it's really about liquidity. And the sophistication of how we manage that is critical.
Yeah, I think it's critically important. I also think the framework is really important to understand what happened pursuant to the 2023 events or crises or, as we heard this morning from the Secretary of Treasury, debacle. I think everybody in this room are relationship managers and relationship bankers versus transactional bankers. And what we saw in 2023 to a great degree was a function of large organizations built upon certain kinds of transactions that were subject to what I refer to as velocity risk. And community banks don't have that same kind of risk profile. And so do we look at liquidity differently? Yeah, I think there's been a redefinition of what liquidity is, not because it affected our business model, because the regulatory framework says we should look at it differently now. There was no such thing 3 years ago of a term called uninsured deposits because nobody cared, right? And now everybody says, well, I need to have either on or off balance sheet liquidity equal to some multiple of my uninsured deposits just in case. And I was reporting to our State Department of Banking twice a day in terms of liquidity. Not a great use of time in the finance area. It didn't really add any strategic value to our organization, but it's something that we need to do. Today, between on and off balance sheet liquidity, and we use Federal Home Loan Bank really as a balance sheet management tool as much as anything else, and we use the FRB discount window, we would use that really as a primary liquidity vehicle. But today, between the on and off balance sheet, it's about a third of my balance sheet, over $1 billion. And that's fine when you have an inverted yield curve and short-term rates are real high. But what happens when they start moving down and you start having margin compression because of the amount of liquidity, either on or off balance sheet, that you have to maintain? And the stress test, we just talked about how important earnings are. So I think that, again, there's got to be some kind of recalibration of who we are, what the business model is, and the risk profile versus the organizations that got subject to that velocity risk in 2023.
I think to respond to Jim, in the nature of the deposits of those banks, those 4 banks that failed, they were large commercial banks. And so they had customers that had some outsized deposits. And so from a regulatory standpoint, as we're looking at tailoring, it seems to me an important question, which would speak to, I think, what Jim was saying, is the granularity of the deposits at the bank. Because the runs that occurred were not the consumers for the most part. But it was the large customers where when the government came out and said, by the way, we have banks that are too big to fail, money started to flee to JP Morgan and Bank of America and the other banks that are too large to fail. That's a problem. Because it's too easy for a commercial customer to say, I can't take the risk, I'm just going to move the deposits to a bank that's too big to fail. And the only thing that began to stabilize that, and I saw it firsthand, was the Fed's term lending facility. It was made very clear that the administration had no interest in stepping in to try to stop the deposit run. But thanks to the Fed and the creation of the term lending facility, it provided enough support to stop the bleeding.
And John, I'll just add, and we didn't do it we didn't have any risk, and we didn't have a lot of deposit outflows during that period. The creation of the term funding program is really what opened the door for us to have a better relationship with the Federal Reserve, to have the window be something that was not only in place and tested, but was something that we began using on a more daily basis. And I know, Kathy, you had talked about how we can get more banks educated on CBLR, but also on the Fed window and how the Fed can help community banks realize it's more than a contingency tool. It can be a daily or even integrated tool to managing your liquidity.
I agree 100%. Most of the small community banks are well informed on the Federal Home Loan Bank, but the discount window, they're not, and they need that education and that understanding and how to set it up and to test it on a regular basis.
Yeah, and unfortunately, there's still a stigma, even though the Fed's tried to do that. But 20 years ago, I was thinking the Fed model was a little different. We all had Fed reps that came out to our banks, community banks, and called on us and helped explain the products and services and things like that. But the model's different now, so I still think there's, at least among small community banks, there's still a stigma about the discount window. And we're big believers in FHL Bank. They're game changers for us. But I still think the two windows are complementary to each other, as I think Greg or somebody said. And so if the Fed could do more to try to communicate, educate, and help particularly smaller community banks understand that that's not a stigma anymore. And make sure the banking regulators all understand that. I think that would be very helpful to us as community banks.
Yeah, one of the things is also, we have discrete sort of custodians of our collateral between Federal Reserve Bank and Federal Home Loan Bank. And if there's some way we can combine those and sort of create this toggle so that they can utilize that same collateral pool and communicate with each other operationally, for community banks, it would just create a lot more efficiencies.
Yeah, I need to compliment the Fed going back to the period 2.5 years ago, they were incredibly helpful. And they had people working well into the night to log in collateral so that banks could be in a position to borrow under the facility. And it did not go unnoticed by me at all. And I think, you know, we've touched on it here, but I think the idea of having sort of maximum availability at the Fed at all times, because their charter is to support the safety and soundness of the industry. That is not the charter of the Federal Home Loan Bank. Federal Home Loan Bank, at a time of crisis, needs to protect its own balance sheet. What you found 2.5 years ago with those banks that were under attack, the Federal Home Loan Bank shut down. And then collateral need to get moved from there to the Fed. And again, the Fed was incredibly helpful in doing that. But that is the Fed's mandate. It is not the Home Loan Bank's mandate. Home Loan Bank is there really for interest rate management and sort of normal liquidity management, which all banks use and should use.
Yeah, I think it's
But let's not confuse ultimately at the moment of great crisis whether they are there as a source of liquidity. And I would say they are not. And it's because not they're bad people, it's just not their charter.
Yeah, I think the complementary nature of both is important. Can't be emphasized. I had a different experience with the Federal Home Loan Bank during the crisis, and I think some of us did too, where actually they were reaching out to say, what do you need? Are you good? So they were proactive, and yes, their mandate's a bit different in terms of housing support, affordable housing support and liquidity, but it is liquidity and it's a source of liquidity. So as long as we're prepared going into a crisis, I think that is the big lesson in terms of our liquidity management discount window. Certainly, if we can get that level of participation up among community banks, removing the stigma, that's important, but also testing all those facilities and their availability and having ample sources of liquidity in a crisis, I think was the important takeaway and the important lesson.
Yeah, I would echo Tom's comments, knowing that the Federal Home Loan Bank was there in a time of crisis and they weren't going to back off. It's very similar to the business model that we have, right? And so if a crisis, we're not going to back off. There's continuity in the marketplace, and to have, I know in the case of Federal Home Loan Bank in New York, they did the same thing. They did very active outreach and said, whatever you need in order to get through this, if we can do something, and if we can help to create a vehicle that may be unique to you, let us know, and we're willing to talk about it.
We've also always found the Federal Home Loan Bank to be there, ready, willing to help us. And I also want to compliment the Fed on helping streamline the Fed discount borrowing process from the old wet signature, and how things have changed and been updated there has also been very helpful.
You know, I'd hate to, and don't want to change subjects too much, John, but when we're talking about liquidity, I really wanted to talk about deposit insurance reform just a little bit. There's been a lot said, a lot of things done. Of course, I heard that the Haggerty bill maybe got dropped today, perhaps, and so there's a lot of different things going on. This is a difficult subject, but I feel strongly, of course, going back to 2023, I mean, the world has changed with liquidity, and particularly for community banks and regional banks, having that deposit insurance reform. I feel so strongly personally that I'd like to see the cost. I'd really encourage the FDIC and the other regulators, but particularly FDIC, show the actuarial numbers of what does universal coverage actually really cost? What is 500 million, you know, or 500,000? What is 5 million? Whatever the number is. And I think it's hard to make a stand for deposit insurance reform until you know the cost and the benefits. And so I think that's crucial. I mean, you could make the comment, you could make the argument that Silicon Valley Bank doesn't fail if there was universal deposit insurance. And I know that's way out there, but so I would really encourage the regulators, particularly the FDIC, to crunch the numbers, and because we don't want to reform deposit insurance during the time of a crisis. We want to tackle that during a non-crisis period. So heaven forbid, if there is another crisis, we've got the mechanisms in place to help with liquidity for particularly community banks.
I would also say, when I was talking about liquidity, broker deposits, and really appreciate the work of Chairman Hill at the FDIC in kind of eliminating or working to eliminate the outdated legal construct around the perspective of the limits to liquidity management for a lot of organizations. Broker deposits are, you know exactly how much you can get, you know exactly what it costs, and you know exactly how long you're going to have it, and it's not going to run. It's a contract, and so that to go out and raise 20 million in my community means I'll probably have to spend a lot on marketing. I don't know exactly how much I'll get. I don't know when I'll get it, and it also, I'll probably end up repricing a lot of my market rate deposits by doing it. And so there are many tools out there banks have for managing liquidity, and I think we need to make sure that our regulatory agencies are aligned on the perspectives and those tools that are available to us. And not issuing guidance. There's a lot of regulations we have to follow. It comes down to the guidance sometimes that really get us caught up in regulatory examination conversations that take us far afield from the risks we have and are focused more on our process. We heard some of that this morning from Secretary Bessent, and I really appreciate it, and from Governor Bowman as well. But when the FHFA guidance that was issued in the past called into question the FHLB, that can be a big issue, and there's got to be stronger alignment and more clear direct guidance around safety and soundness risk as opposed to process. And I think there's a real opportunity as we look at whether it's CBLR or liquidity management. There's a lot we do, stress testing and model validation, significant costs. Community banks that are really the smaller community banks. I know 30 billion might be the new mark for what a community bank is, but that is a big bank compared to all of us. And so we've got to think differently about this idea of tailoring and how it is impacted through guidance that gets issued that really then sends regulators far afield in their process of examining us.
I totally agree. There's been a lot of talk about the 10 billion and going over that mark, but we can't forget the 500 million and the 1 billion mark. We're at the verge of the 500 million, and our regulators are already talking to us about when you hit $1 billion, so you need to start building those elements in between. So, I mean, there are just a number of things that need to be looked at, but all those levels of indexing and needed to be taken into consideration, and the tailoring process, and with a one-time adjustment now to get it right, and then the indexing after that, as Greg mentioned, based on GDP.
Yeah, and I want to give a shout out to the FDIC too for introducing changes to the fiducia model, which I think maybe even by the end of this year will take place. That's going to be, I mean, Kathy's at the 500, I'm at the $1 billion, and I know the others are, at the next level, 3 billion on up. And so, thank you to the FDIC for opening that up. We've been working on that for years, and it's really nice to see that moving.
I think one of the other issues that I'd like to talk on, which is not under the control of the Fed, but one where they can exercise influence, and that is CECL. I think it is incredibly bad accounting policy, and I think in terms of safety and soundness. So somebody agrees with me? I had given testimony on this, but I was not very persuasive on the subject. The thing that bothers me most about it, there are several things that bother me about it, but in terms of a safety and soundness thing, it is pro-cyclical. So as the economy starts to deteriorate, or you see some softening, required reserves go up. which means the loans that you're booking today are marginally profitable, if profitable at all. And so you slow down your lending, which exacerbates the cycle that you're in, and you have the opposite effect when times are good. So I think it's bad from that standpoint. I think the second piece to it is an attempt to put science into determining what an appropriate level of reserve is. And then there are all these Q factors that get added to it. So at the end of the day, it's completely subjective again. It's just very expensive to give it the appearance of objectivity that it does not have. So
John,
let me climb down off that horse.
Well, just to put a number to it, and I know we want to get to some questions and we've got to watch our time, but just to put a number to that, if unemployment goes up, the unemployment projections go up, it could result in us, and not a small amount, I mean, just marginally, if they go up, it could result in us putting up to $1 million more into our reserve. That's $10 million of lending we could be doing. That's, it's not generating capital because it goes into the reserve instead of, now it might be thought of as capital because it's sitting in reserves, but we cannot consider it capital and we cannot lend on it. And so there might be a thought that we look at reserves a little differently with regard to how we treat capital as well. So just a comment.
It's very interesting when you look at the level of the loan loss reserve over time. It ratcheted down a level after the passage of CECL. So we have fewer reserves, which makes no sense at all. So again, an issue that I wish the regulators would weigh in on, because the accountants are dug in on this position.
Well, that's because the unintended consequences of what it costs you now to validate the CECL model is ridiculous.
Yeah, exactly. We've got a couple minutes left here. I thought we might throw the floor open. I'm told only to bankers in here, not Fed staff, but I might let Fed staff get a question in. So would anybody like to pose a question to my panelists here?
Hey, Joe Cassim with First Capital Bank in Charleston, South Carolina.
A very good bank, by the way.
Thank you, Mr. Hagermeyer. We're kind of in a moment where we have a short window to make lots of changes. And I hear, I think everyone in the room probably has something very near and dear to their heart. But we also know we can't do everything at once. And so I know what one or two things that I really, really want to see go through as we're trying to reshape what this world looks like. But I would like to hear from the panel, if you can pick one or two things that you really want them focused in on. And I've heard it, I love the comment, I think that was Mark, about let's just see what it costs to increase the FDIC insurance. It's not like we're not paying today. All of my clients make me push them through ICS. That's anywhere from 5 to 12 bips. So I am a conservative. So this is going to sound weird, but if you need to charge me a little more on my FDIC insurance, this might wash out. So really just, we get a quick shot with our regulators and our industry to make some big changes. What are the one or two you're really thinking going to be impactful?
Great, thank you.
I'd start with an understanding of what's achievable right now, what's in the authority of our regulators to change that do not require statutory change. Focus on that. So I talked earlier about mutual capital, clearly within the control of the three federal regulators about how it would be implemented. And then I think also in terms of tone, right now, setting the right set of expectations on future issues that might come up. So we talked a little bit about discount window access and the Federal Home Loan Bank's role, making sure that one doesn't replace the other over time, and that there's distinctions between the two, the complementary nature of it, and also an understanding by policymakers that it's not just liquidity we're talking about here, it's also interest rate risk, and that liquidity access is tied to IRR as well. So I would encourage focus on what's in our control right now and what doesn't require statutory change.
I would agree. I absolutely agree with that. I think that the regulatory framework on capital is really extraordinarily important, and it's going to drive community banking success. The other thing that I hope to see, and it's a little early yet, is that the tone that we've heard through this entire session gets translated to the field. And so what we hear now is, this is the kind of regulatory framework, and I want to make sure that when the safety and soundness examiners come into the individual institutions, their actions are reflective of the kind of tone that we're hearing today.
We've talked a lot about it, but I think the regulatory thresholds, I think that goes along with some of that's low-hanging fruit. Of course, the Durbin Amendment at $10 billion that's difficult. I understand that's going to be hard to do that. But in terms of CTRs, there's all these bright lines that are not indexed, and we were just talking about how much of a difference that makes, that scope creep that's happened. And to me, that's pretty low-hanging fruit that we can get done. And then the second thing, we brought it up again, deposit insurance reform. That's a hard one. It's going to be a hard one, but I think we can make some, whether it's a tag-like type program or just the Haggerty bill and some things like that, make some dents. I think some of those things are doable in the shorter term.
And I would say the thresholds would be number one for me. And then the positive things that I've heard on building out a framework to help the smallest of community banks with education on whether it's CBLR or other things. And as new regulations, rules, guidelines, things roll out, that they're not having to deal with an 800-page guideline or however many, or pay somebody to have to come in. Or that they even know or realize the effective dates of it, that we've got to hold on to our community banks and we've got to educate them, since not all of them have the resources to be able to attend conferences and get the training that's necessary there.
I'm going to be a little provocative in the context of, we talk about bank regulators. I think they need to be activity regulators. The existential threat facing community banking is that, and we saw it with mortgage banking. We used to do 80% of the mortgages in the country. We now do 16% of the mortgages in the country because mortgage bankers or mortgage originators did not have the same level of regulation, CRA requirements, et cetera. We're going to see it with stablecoin, right? If the payments system moves outside of banking because there's a lack of regulation, and I know we're talking about deregulation, not more regulation, but if you're not regulating the activities of everyone that is moving money or issuing debt or the same way, if you're just focused on how you regulate banks, I think we're going to miss out on keeping community banks sustainable as a business model. And so same activity, same regulation is where I hope to see the most significant progress. I don't know if we can do that because I think we're focused on how can we help banks through the banking regulation that exists, and that's unfortunate. But legislatively, and I know we talked about staying within statutory opportunities, but legislatively, I think we've got to think about that bigger picture relative to banking and banking regulation. I agree with Jim. I think it comes down to how we examine banks, less subjectivity about how we examine process, and are you doing CTRs and BSA and AML the right way versus are you managing the risk? And I was in Washington last week and had the opportunity to meet with Chairman Hill and with folks from the Fed, and the messages sound like they're moving the right direction on really cleaning up the clarity of this is how you examine under these regulations. And if you're not talking to them about safety and soundness and true risk, why are you talking to them? So that's within banking, I think, the biggest opportunity, but we've got to think more broadly about the activity that non-banks are doing.
So I agree with that 100%. I think that if you think about it, that what we just talked about deregulation. What we need to do is lessen the delta between deregulation and unregulation, because that's our biggest risk as an industry.
So let me wrap up our conversation on capital and liquidity with my wish. And it's not that the camels that you're all familiar with don't measure these components, but they don't look into my way of thinking at integrating safety and soundness viewed from the lens of the level of capital, the level of liquidity, and the profitability of the institution. There are subsets to each of those that I recognize and I think are important, but I do think safety and soundness is the ability to keep your doors open during all market conditions, and that requires capital that give people comfort, and obviously a loan loss reserve is part of that capital. Having the liquidity to meet flows in and out on your deposits, and a level of profitability that allows you to restore capital in the face of loss. So thank you. Thank my panelists, Kathy, Jim, Mark, Tom, Greg. We've enjoyed it. Hopefully we have given our bankers and most importantly, our regulators something to think about today. So thank you.
Thank you very much. We have a 15-minute break, and we'll start again at 2:15. There's coffee and I believe desserts outside. Please, we're going to get started. All right. So we have a great discussion ahead of us, perspectives on the economy and evolving financial landscape. Thank you very much.
Thank you so much. I am honored today to be here at this incredible conference. Thank you so much, Vice Chair Bowman and team. and Federal Reserve Board for hosting this. My name is Jill Castilla. I'm the president and CEO of Citizens Bank of Edmond. I'm located in suburban Oklahoma City. We're one location, $400 million community bank, women-owned, and we were founded in 1901. We also launched 2 years ago the digital military bank Roger, which has taken off and is the fastest growing military bank in the nation. I'm so excited today to meet with Stephen Schwartzman and with Blackstone. What a difference here. I put into ChatGPT, I mentioned to Mr. Schwartzman where we have overlap in our lives, and it was saying like technically not a lot of overlap, but some of the fundamentals were very, very similar as far as commitment to the community, entrepreneurship, and the mindful growth of assets. And we were talking about discipline right before we came into here. So we're just going to jump right into it because you have such extraordinary thoughts, both at a macro level as well as how community banks operate in the environment. So welcome to the Fed and welcome to our conference.
I think it'll work now. Well, it's a pleasure to be here.
It's so wonderful to be here. So I'd love to just jump right in. You are managing the largest portfolio in real estate. You have these incredible investments in AI. There's so much to talk about. But can you give us a view just overall in the economy, how things are looking for you?
I'd say with the overall economy, we have a very good look at it at Blackstone. We own 250 companies and 13,000 pieces of real estate and an enormous amount of assets, and we have about 250 billion of revenue and 700,000 people working at all these different businesses. So we're like our own database, and it makes life really easy for us because we have a real sense of what's going on. So, you saw that the last quarter was reported for the economy at 3.8%, which is really robust for a big, mature economy like the United States. A little bit of it was, I think, some pre-stocking on the tariff issue. So it'll be probably less this quarter without having any inside information about it. But our company CEOs, 90% of them think will be around this kind of growth level or better. That's pretty amazing. They're finding that probably 3 years ago, their number one concern was getting labor. Now, out of the 9 things that we survey our companies, labor is the last. It's number 9 because most of them can hire people now. We're finding that the cost of labor has gone down from about 5% a year to 3% a year. So you can feel the economy settling. Our margins, profit margins in the companies are about as good as they've ever been. So the economy is feeling pretty good, for sure. And that's reflected in the fact that stock markets are at record levels. The bond markets have gotten much better. The ability to finance things generally in the marketplaces has gotten way better. So it looks like things are lined up pretty well. And the most remarkable thing about the economy now is it's a little bit of a two-tiered economy. There's the AI economy, and then there's the real world economy. The amount of money that's being put into the full panoply of things for AI, which are basically data centers, which are around 35% of the cost of a data center, actually building it. And the rest are the semiconductor chips and some other equipment. So these things are going at sort of 1 gigawatt, which is like a really big one. That's like $30 billion. And the amount of money that's going into these individual things is so stunning, it's powering the U.S. economy. So when people say, well, you know, we're really going to have a slowdown, if they say things like that, on top of the economy you would recognize is this engine that's consuming more electricity, semiconductors, and you know the scale of it is like another 1% of GDP, just in the capex that wasn't there 2 years ago. So that's going to continue for a while, and it marks the U.S. economy out as a lot different than other places in the world, except maybe for China. So we are the locus in the developed world of this technology, and it should not be underestimated.
So with the normalization of labor cost, construction costs coming down, can you give us your insight on inflation kind of overall? I know during over the last few years from COVID on, whenever rents were really important to be thinking about what inflation was doing, a lot of the information was kind of muddled and lagging. You have such a pulse on housing cost and other inputs into inflation. Could you talk about that a bit?
Yeah, about a year and a half ago, we started talking publicly about inflation really coming down, and we were a bit odd at that time, and the reason isn't that we're smarter than other people. We just had access to other data, and the data from being a large real estate investor is we could see what was actually happening with rents, and rents were coming down much faster than people would see, and rent is 35% of the consumer price index. So if you get rents wrong, because it's so big, that it really makes a difference. And we saw that happening about a year and a half ago. And to give you some idea, today, the way inflation is reported, I think it's something like 3.6%, 3.8%, something like that, in the numbers that is used by the Fed, and we think it's 2.1. And the reason we think that is that we see it. It is 2.1. And that 150 basis point difference leads to roughly a 50 basis point difference in the reported CPI. And so having contemporary data as opposed to the way data is conventionally put together now by the government allows you to adjust for what's actually happening in the real market. And to give you some idea of how pro-cyclical this could end up in 2021, when inflation, we thought, was really ripping. We thought it was over 8%. The numbers that were produced by the government were somewhere around 3.6, I think it was. It's like huge difference, absolutely huge, which stopped the Fed from raising interest rates because they believed, because that was the numbers, that this all wasn't happening. But of course it was. So this can be easily corrected with just more contemporary data and a different type of formula. The numbers that the Fed were using actually become right, usually a year later. It's the way the formula works. They do get the numbers right, but in that year period, it really is a sort of handicap for decision making. The way I knew this was happening is my partner, when I started Blackstone, was for a while chairman of the Federal Reserve Bank in New York. And we could see that all of our companies at that time were getting really weak. And it was clear to me we were going into recession. And he was a good friend with Alan Greenspan. They used to play tennis together in New York. And I guess they have a meeting 4 times a year or something with the regional bank chairman. So Pete was going down for a meeting. I said, listen, tell Alan that we're in a recession and he should do something. So Pete was a good partner, so he talked to Alan, and Alan told him we're absolutely not having a recession. And that's what Pete told me when he came back. I said, Pete, that's completely wrong. I could see it in every one of our companies. He said, well, that's what he tells me. So it took 9 months before the Fed did something. So this isn't about any group of people. It's just the preparation of that information. And once we get that changed, which I think, the Fed's very open to taking a hard look at that, it'll be an easier ride in economic cycles.
So I have to ask, did you ever get to talk to Chairman Greenspan and tell him I told you so, or?
That's not good manners.
That's great. Thank you for sharing that story. Could you talk more about where you think the direction of monetary policy should go based upon your insight into where the market is?
Well, I don't have that level of intellectual arrogance to tell the people who are doing this what they should be doing. I think we're going into a period where labor is not going to be growing very much, so there'll be some softness there, which does provide an opportunity if our numbers that I just mentioned were in the right zone, that you could be cutting interest rates further. The only offsetting factor is that there'll probably be some small inflationary impact from the tariffs on a one-time adjustment basis, which I think everybody expects. But because it's one time, you could look through that and continue a rate lowering cycle.
You talked about labor softening, and you've talked about AI. As AI matures, could you discuss how you see labor changing over time?
Well, I think with AI, it's not just labor that's going to be changing. There are going to be lots of things changing. And when we met before, which was a fun meeting, that I was saying that human intelligence for geniuses is 180 to 200, and within 5 or 6 years, most of the experts in the AI field think that AI will have the intelligence of 12,000. So 12,000 compared to 180, you're dealing with something that's so powerful that as it gets harnessed and people figure out what to do with it, is going to have enormous consequences for human beings, for the economy, for efficiency, for government deficits potentially. Because if machines can start doing things that humans were doing, and in some cases more accurately, and way, way faster, that it'll have an impact on a variety of different parts of the economy. And ultimately, when AI is able to basically train intelligent robots, you'll have a different manufacturing base. That's not for the next 5 years, but it's probably for the next 10 to 15. And it'll take, sort of developed world economies and make them much more competitive for manufacturing, because assuming you can have enough money to buy that technology, you'll be able to do things at about the same cost as other places in the world, and you won't have transportation costs. You can make it all here. So if you look at how the world's going to evolve, whether it's with drug trials, and most people in this field believe that you'll be able to double or triple the amount of new drugs that get invented through the use of AI. Education is going to really change. Imagine you could individually program education for people all over the world. So you could get, theoretically, areas that are having real economic problems, and all of a sudden there people can have the ability to get absolutely first-class education just tailored to them. What's going to happen in that kind of world? The answer is something profound. So we're going to be living through some very interesting times in not just America, but around the world.
Could you talk a little bit? I'm interested to know how you're using AI, both at Blackstone as well as if you're personally using it. Is it matured enough to be of use to you right now?
In Blackstone, we're using it in a number of ways. We started off a few years ago, screening resumes using AI, and we found that for certain tasks, jobs rather, that just hiring the smartest person from the best school turned out to be a losing strategy. That the talent you needed for that particular job was different. And so we would screen for that, and that works. Because you don't need the same talent for every, type of jobs. We're using it in our investment committee memos because we can keep a file of all the old ones. We can create our own databases, and it can help you write that kind of thing a lot faster. And AI we're using in our companies. We have, besides those 250 companies, we have minority interests in other ones, and we're finding that every company faces the challenge of somebody else using AI, and you're not doing it. Because if it lowers their cost and makes them more efficient, that competitor will be able to take share or have more money to invest in new products. And so there's a requirement for all of our companies to be engaged with AI because you can't afford to make pretend you're an ostrich. That's the ostrich strategy is not successful. And even though it's early days, there are certain applications that work, but the adoption curve for AI will be sort of looking like this. And when you control assets and control companies, it's really important that if you know something's going to happen, that you make sure that the companies where you're the custodian is alert. We have the person who is handling that part of our business was the senior partner at McKinsey that was advising all these other companies how to adopt AI. So that's a part of today's business.
So, you have so many community banks that are watching online and are here in the room. Our community bank, we are a commercial real estate concentrated bank. So we're, sitting in downtown, we're lending to, in our same geography, we know it very, very well. And we see you all in the market and private credit and the way that you are investing in real estate. Can we talk a little more specifically about the real estate market, where you see that going? Do you feel optimistic or concerned about what the status of it is currently?
This is real estate.
Real estate, yes.
About a year and a quarter ago, we sort of called the bottom of real estate. That turned out to be a correct judgment. We said it would be a U-shaped recovery, not a V. I would have liked a V better, but apparently I wasn't going to get one. And so what's happening that's fascinating about real estate is it's very much just a simple supply and demand business, and certain categories were overbuilt, like some of the apartments. What's happened is that new construction, as you would all know in your local communities, has just dried up. For commercial buildings and new units. And so they're probably down somewhere in the 65-70% range. Now, when people don't build new things and the economy continues growing, it's only a matter of time before those things go into shortage. They were in surplus, they'll go into shortage, and that's when rents really start trending up, and that's going to happen. It always happens, and before it always happens, people deep in their heart believes it's not going to happen. But it does always happen, and so it's just a question of when the lines cross. It's not necessarily going to be tomorrow, but it is going to happen. And we're already seeing some very good signs in real estate. The number of transactions is going up. The amount of financing in real estate is really going up. And the spreads are coming down. The market's valuing real estate better, in effect, as a lender than they were before. So these are the precursors of when you're going to get a turn. The only area that's really in distress was office. It's hard for me to imagine that people wanted to work from home. If I saw one more person in a sweatsuit or pajamas, or usually they were hanging their bathrobe in back of the Zoom place. I don't know why people did that. I mean, what kind of signal was that? You want to see my bathrobe, and now people have very much returned. Some places not 5 days a week like us. We were about the first back, but that's tightening the office market a bit more. Where I come from, which is New York City, we now have more people in office buildings than we did in 2019. We're the only city of scale in the United States where that's the case. So we started a year and a half ago actually buying office buildings. And things of that type will will slowly happen. Some places won't come back, and the equity will be lost in those buildings. But if you pick your spots, even San Francisco, which was almost abandoned, is now got a new mayor. They're doing a bunch of reforms, and their offices are doing better after really being in very bad shape. So that's what's happening in the office world.
That's great. Thank you so much for sharing your expertise and perspective on that. So I've been in this role at this bank for 16 years, and during that time period, I've seen an explosion of private credit, very sophisticated private credit, and some kind of smaller boutiques. But in some statistics I've seen is that it's actually tipped over 50% of all the credit that's being out there has been on the private credit side. You are an expert in that field, and it'd be wonderful to hear your perspective on private credit. Is that a risk to the system? And as we think about having a regulated environment in banking and more of an unregulated environment with private credit, how does that work together?
Well, apparently, private credit has become really fascinating to people. It's not actually that fascinating. Lending money isn't that fascinating. You just have to make sure you lend it to good people.
You're talking to a bunch of bankers, so.
Good people with good businesses. So what we do, we have about closing in on $500 billion of private credit. So that's, we're no longer community bankers. We keep it really simple. We keep loan to total enterprise value, senior debt, senior secured, around 40%. You have to be a really bad assessor of risks of significant size companies if you can manage to lose money on senior secured debt with 40%. I mean, you have to be really creative to lose money doing that. We do something different than you all do. We don't get our money from deposits. We have people like insurance companies who are looking for longer term holds, and we'll raise a pool of capital. And so when we make a loan, we can make it for quite some time, and we don't syndicate the loan. We are the owner of the loan, and so we're easy to deal with, because if you just talk to one of our people, and we take it to committees, and we have a very orderly, complex process that we say yes. There's no variability on the interest rate. We tell you, here's what we'll do. We'll hold it, no roadshow, you're done. So that makes us very user-friendly. We're leveraged no more than 1-to-1. Sometimes we don't leverage that loan at all, whereas, the banking community tends to leverage through deposits, whether it's 10-to-1 or 11-to-1, or, if you're really conservative, 9-to-1. So we have low leverage to no leverage. We have matched funding, so nobody can get their money back. And we're senior secured. So what can go wrong? Not much except fraud. And I've been defrauded, I guess, 3 times in my career. I've been doing this 50 years. I haven't been doing private credit for 50 years, but every once in a while you have some unpredictable weirdo who slimes you, and you get left holding the bag. Some of these people are unbelievably clever. I mean, if you've ever been defrauded, and probably most of you someplace have, these are slick operators who who are credible, and that's how you get it in a situation like that. But, other than that, we have, sort of non-performing loans of like 50 basis points. Almost every bank is higher than that. So we view this as a non-controversial activity, which for some reason, some people in the media thinks that this should be an area of massive concern. We basically like to partner with banks. We're not that interested in generating our own stuff. If somebody like yourselves has a portfolio where you'd like to sell it, we love buying these things because then you can keep servicing, keep your customer, offer them more money, and we'll put up the money. It's almost like a dream, right? So it's a good thing. And sometimes with some of the regional banks, we do what's called flow agreements, where basically as they produce, we'll just regularly take it. And that's good for us because the people who give us money want that for longer periods of time.
What type of tranches, like size-wise, are you buying from community banks? Is it 20 million and up, or is that too small?
Mike, what's the answer to that?
We can be really big or really small. We're user-friendly.
All right, that's great. Well, that's good to know. Thank you. It's been wonderful seeing the news that the collaboration with the community banks and how that they can then manage their exposure to commercial real estate by partnering with Blackstone. I think some of the discussion around private credit is you're not the only player in that sandbox, and that others who are trying to capitalize maybe don't have as much discipline. I love your discussion about discipline and how you decide to do a deal versus, at scale, you would think there maybe wouldn't be as much discipline as what you described.
I just want to say, just as background, when I joined the financial industry for the second time, I was there for 6 months before I went to in the Army in business school. But when I finished business school, I joined Lehman Brothers, and somebody looked at me and said, "You're going to cover banking." So all I knew about a bank was that I put some money as a kid, and I got interested in, I could take the money out of the bank. That was my level of sophistication. But I ended up, starting out with savings and loans and savings banks. And so I visited them all around the country. And then I graduated to commercial banks. And when I started, there were, I started learning about the industry. There were 14,000 commercial banks. And I was 24, and I was going, that sounds like a lot of banks. And then I learned there were, banks in every town in the United States. And sometimes, there were 2 banks or 3 banks, competing, and, First Federal Bank or whatever. And it was very interesting to me. And I always thought that was probably a few more banks than were needed, and that there'd be a consolidation. So I found out now that there are like 4,500 banks, in one working lifetime. So I don't know what the critical mass is, but I learned it's good to have local banks, because local banks can assess providing local credit. And the people, you socialize with the people, who are good people that you want to bank, want to support. And so that's like for those of us who hang around the JP Morgans and Bank Americas and Wells Fargos and the monster size institutions, which for us now are like normal size. It's really good that you all do what you do, because I think you have a better way of reaching the customer. And so you provide a very valuable function, for the country.
Well, with that introduction, I'd like to have a challenge for you. And so if tomorrow we wake up and we've switched places and now you're the CEO of a $400 million community bank in Oklahoma City, I get to be the CEO of Blackstone for a minute. What are you thinking when you wake up and that you're now sitting in the lobby, you're interacting face-to-face with these customers and kind of responsible for a community and its prosperity?
Well, if we switch places, I'd have a better deal than you would. And what I'd do is I'd go out and I'd start merging with all these other banks, and I would build like a monster. That's what I would do if we switched places.
So, wow, that's a challenge. Now I feel like I can't see you like a couple of years from now, and I'm going to be like, well, we're 450 million. That's a great. And so, what does that excite whenever you're building something that's so big in scale, like you built Blackstone, and then whenever you're thinking about leading a community bank, it's about scaling. That's invigorating and exciting for you. Can you talk about kind of the why behind that?
Well, I still think we're running a small company. I mean, I started this. I know all the people at the firm who, have important positions. I meet with each one of our businesses, which are large, but we have everybody in the world in each of our businesses, whether it's private equity or real estate or credit or infrastructure or numerous businesses, but I meet with everyone every week. So I can look at everybody around the world. There I am. I'm at the table with the rest of you. I can tell who's alert. Nobody's allowed to drift. We keep the meetings moving. And I could tell if somebody's off, something, they just don't look right. And I'll say something to the person running that group, and they'll say, well, they had a family problem or something. And so the key to running a successful business, at least in finance, is having really firm core values that everybody understands. Openness, honesty, excellence, meritocracy, no glass ceilings. I could go on with basic principles that you would want if you were working at some place. I talk to every group of new employees, and I tell them how to be successful and that they were hired because we want them to be successful. Apparently, that's not normal in Wall Street. I don't know, I can't believe it, but people who join us say, you're so different. You want me to be successful. And you say, well, why else would we hire you? We don't want to have turnover. We want you to be great. And so you can run a business with very tight control, and very human scale. You need a great team of people who are well-trained, who believe the same things. You can't have different core values. You can have different books you read, different TV shows, different politics. None of that stuff matters. On business stuff, everybody's got to sign up for the same hard work. If you work harder, you win more, right? It's the same with sports. Teams that don't practice, they don't do so well. But you need the basic talent. I think we can, you asked me what excites me. I love doing new things. I love learning new facts because finance is a lot about paradigm recognition. So I've found in my career, there's always new facts that come up. And if the world's going well, people tend not to look at the one new fact that doesn't make sense in the context of everything working well. But that fact actually exists. And humans won't pay attention to it because why bother? Things are working well. Doesn't make sense. That's what interests me. So I keep thinking about those things and say, what does that mean? That's telling us something. What's it telling us? And I sort of keep that going, and I'm always looking for a second piece of discordant information if I can't figure it out on one. And once you get 2 points, it tends to make a straight line. And meanwhile, everybody else is doing the same thing. And then you could build a big business around that. And I get a real kick out of that. It's like seeing the open person in a basketball court, and you just get the ball to them, it goes right in. Like nobody's guarding them. It's a simple concept, but we do it with data, with information. I used to call it information. And you can't get too much information. So as long as we can keep doing that and keep the scale of our individual funds, we now have 85 different strategies, and we started with one. So it sounds like a lot, but it's basically 1.5 a year, maybe 2 a year. So we don't look at that as like pushing ourselves. And you only do things that are great for customers. If a customer doesn't have a wonderful experience, it's like going to a bad restaurant where they poison you. And all of us have probably gone in our life to one really bad restaurant where we spent most of the next night not in bed. And you tend not to visit that restaurant again for at least a year or two. If you try it out the second time and the same thing happens to you, you will never, ever go back. And it's the same thing in finance. You always have to give people a good experience. And if you give them a bad one, they never forgive you. People are like elephants. They have lifetime memories for somebody who did something disappointing to them. They don't forget. And so that's why you have to be unbelievably careful when you commit capital or do anything when you're using, other people's money because they trust you. It's a lifetime of trust that can be destroyed, with one stupid decision. So it's you have to be a bit of a on your toes type of person and recognize that every time there's a capital commitment, you're betting your whole institution's reputation. And if everybody at the business, at the firm, shares that view, then people are super careful. And that's why we're the biggest in the world. We see things earlier. We have great data feeds, and we have wonderful people. When I started, nobody wanted to join us. For those of you who lend to entrepreneurs, it's not so great to be an entrepreneur unless you're really successful. And nobody's successful at the beginning. It's just always harder. You never forget those lessons. And when you can finally attract amazing people, it's like the most wonderful gift you can have. So I have a fun life. I'm very happy. And I came here because, all of my experiences in banking over the years, because I graduated to the big ones, and I've gone through all of these crises with the financial institutions and the GFC. I was helping Hank, and the people, everybody was like making it up. Nobody knew exactly what to do. and there would be a group of us that would talk on a regular basis to say, well, why don't we try this? Why don't we try that? And so Washington, people do really important work, because in those rare occasions where the system is at risk, the people here who know what to do, what the right instincts are, it guarantees the system. That's the real guarantee, those people in those seats. So with that, you've had more than enough of me. I may want more of you, but I'm getting the hook. So thank you very much.
That was amazing. Thank you.
Thank you very much. We actually do not have a break, so if you'll just bear with us very quickly, we'll invite our next set of speakers up, and we'll get started in just a second. We are going to move on to our next set of speakers. We're going to talk about the evolution of consumer demands and how community banks are responding. Thank you very much.
Well, thank you, guys, and Governor Bowman, thank you so much for having us, and thank you for the audience. We got a bunch of friends out in the audience as well, and everybody watching. Excited today that I get to introduce a friend and a partner of ours, somebody that supports community banks and is very focused on the consumer. With that, if you wouldn't mind saying hi.
Hey, and thank you to interviewing me. Vlad Tenev, co-founder, CEO of Robinhood, financial super app, started in brokerage, but has expanded into a whole bunch of financial services, and also proud Coastal Community Bank partner. So thank you for that as well.
Funny story, I was watching Vlad on CNBC News about a month ago, and at the 31st minute, he said, well, I don't need to be a bank, I've got Coastal. I was like, okay, we're about partnership. So I'm obviously Eric Sprink, Coastal Community Bank up in Everett, Washington. Been with the company for about 20 years now, president and CEO, and happy that I'm here, right? We've all been through a lot. So we've been through a distinct journey, which we'll talk about today. But really, this is about Robinhood and Vlad. And then, of course, we'll open it up for Q&A and insights from you guys as well. So with that said, you briefly touched on the company, where you're at today. Why did you start it? Give them a background, and how did you get into it?
Yeah, it's a long story. I actually never really intended to be an entrepreneur. I grew up here in Washington, D.C., actually, and you know, I was an immigrant to this country. We immigrated from Bulgaria. My dad, right after the fall of the Berlin Wall and kind of the fall of communism in Bulgaria, had a unique opportunity to come to the University of Delaware. So back then, the family didn't have very much money, so he could only come by himself. So I still remember one of my earliest memories. People ask me all the time, do you remember when you were 3 years old, 4 years old? And for me, it was very, very simple because, you know, there was a big change in my life, obviously, when I moved to the U.S., but also a big one when my dad moved to the U.S. because I had just turned 4 years old, and it was like my first time to the airport. Yeah, big experience kind of seeing him go off into this new world, like a conquistador or a nomad, I'm not sure. My mom immigrated about a year later, and then I moved with my aunt, who was like a 15-year-old punk rock teenager. She loved Nirvana and Soundgarden, your local bands, yeah. So she brought me, and then, you know, growing up, it was sort of like my family took this big risk by moving across the world, and then ever since then, it was sort of like risk mitigation. Let's, you know, have a stable life, encourage our child to like have a great career. So my parents' dream for me was that I would work at a big bank. Yeah, and it was like, you know, if I had gotten a job at JP Morgan or Goldman, that would have been the pinnacle. Both of them were working at the World Bank here in Washington, D.C. for pretty much their entire career, like 20 plus years from moving here, graduating grad school to retirement. And when I graduated from college in 2008, I was a math major. I didn't really know what to do, so I went through the default path of grad school to become a math professor. And I was interested in that because I was always sort of like interested in big questions and kind of figuring things out. So I thought my biggest contribution would be to come up with a theory that maybe a kid would be learning in school in 20 to 50 years. So that was the dream. And then I got hit with the realities of what it meant to be an academic career, which in some ways is not very attractive. My first month in grad school, Lehman Brothers went under. You had the global financial crisis. And yeah, it was interesting because I'm sure many of you in this room remember that very acutely. There was a huge amount of pessimism about the world in the wake of the global financial crisis, particularly from millennials. You know, my classmates, many of them actually lost their jobs. I still remember my classmates that got jobs at Barclays, right? And they were very, very confident because back then, computer science wasn't the most common major. The most attractive job was to go into the financial industry and, you know, go into banking. Some went into consulting, but banking and hedge funds were very attractive. So the folks that were most confident in their careers graduating from college suddenly became like, you know, their whole career plan just got turned upside down. So in the wake of that, my good friend from college convinced me to drop out of grad school and start a financial company. So that was the origins of it. And then I enjoyed being an entrepreneur and building for myself so much. It kind of reminded me a little bit of solving a difficult math problem in kind of a funny way, in the sense that if you're an entrepreneur, at the end of the day, it's like your effort, the code that you write, that determines success or failure. In much the same way that if you're studying math, it's sort of like your brain, the couch, and the chalkboard. And so it's in a way, a very efficient way of taking what's in your mind and creating value. So that's what appealed to me initially.
And we're going to come back to that math topic, but that's interesting. I didn't know that. So there was panelists up earlier today, and the bankers are fantastic and well regarded in our community. They really were trying to articulate that they have a personal relationship with their customers and they're trusted by their customers. And they do that through their branches and lenders. how have you been able to do that using digital delivery and other ways? And how do you build that trust and service your consumers?
Yeah, I think that's a really good question, and I think actually that points to one of the big advantages community banks have. I think that it's inherently a little bit more challenging for a digital-only platform to have that type of deep relationship with customers. And at first, our assumption was that we could do everything digitally. We won't do, if you require anything other than simple processing of your trade or transaction, we won't get in there. But as we found, as we've gotten more advanced, as our customers have grown, their needs have gotten more complex, that I think at this point it's hard to replicate the personal relationship. I think you guys shouldn't be too worried about AI. I mean, I think that in many ways, if you're a financial advisor, the product is less the advice and more the relationship. I mean, you feel like if you're a financial advisor or a personal banker, private banker, in some ways these folks are people that you have relationships with, and I think the information and the advice itself can often be commoditized, but I think it'll be very hard to replace that feeling. And I think that's an advantage community banks have. We try as much as possible to replicate that digitally. For example, a couple months ago, we rolled out Robinhood Concierge because we noticed, at a certain point, when a customer gets so involved with Robinhood, they're using maybe 5 to 10 of our products, they have a significant amount of money with us. We want them to have a representative that they can text, they can communicate with. And when we launched that, the results were really amazing. So I think, of course, we try to do as much as we can digitally, but I think there's something that actually can't be replicated where, Coastal and many companies in this room are actually quite strong. I do think in terms of trust, there is one opportunity that we're trying to seize aggressively as a digital platform, but I think it's accessible to many of the folks in this room, and that's the family relationship. I think that if you think about trust, particularly with banking, a lot of people find out about banking through their parents, maybe grandparents. A lot of your first relationship with a bank is because, at least for me, my mom and dad came into the local branch in my neighborhood and opened up an account for me, and they got me a debit card, which was very, very cool at the time. Every kid wants a debit card. But my impression, both as a customer and kind of as a entrepreneur in this space, is that I think the young people are kind of undervalued by a lot of the banks. It's hard to get a credit card if you're not 25 and already making a lot of money. A lot of the communication between the child, even once they turn 18, goes through the parent. And if you think about it, when someone goes to college, when they turn 18 and go to college, even if they're a community banking customer, they leave home and they go to a place where they're around other people. Those people are talking about finances all the time. I mean, we've seen a lot of growth happens with us in the college market, and I think that's an opportunity. And I don't think a lot of fintechs or banks are taking that seriously, because I think the family network is such an important one, and it's low-hanging fruit for growth as well as building trust.
I love that, and it does remind me, selfish plug, but it's tech-enabled trust, tech-enabled relationship for our community bankers, that we can do both, and it actually could help us. We run a venture fund called Bank Tech Ventures that helps banks see those technologies that can meet in the middle with the consumer and what they're asking. So you mentioned it. We work with you. Can you tell them what banking products that you have? And maybe selfishly, again, why did you choose Coastal?
Yeah.
And we're extremely grateful, by the way.
Yeah. So we announced Robinhood Banking in Q1 of this year. We did an event in San Francisco where we demoed and unveiled the features. And then recently, last week, we actually did our first external rollout. So for the first time, people outside of our company, outside of our employees, were able to open accounts. And we've actually been, so stepping back, I mentioned at the beginning the goal of Robinhood was to be a financial super app, to not just be the place where you trade, but actually all of your finances should be handled by our software, our technology. And banking's a big part of that because your paycheck goes into your bank account, and it's sort of like the funnel through which all of your other accounts and services get funded. And we've had a few different attempts at this. We launched a Robinhood spending account, which was a money transmission product state by state. We had Robinhood Cash Management, which was like our take on spending and using your brokerage account as kind of a bank account replacement. And then those didn't really hit the spot. And the reason those didn't work was primarily two reasons. One, our customer base is contrary to kind of a lot of sort of like the impressions of a lot of people. Our customers are a little bit wealthier. They're not the paycheck to paycheck customer, because by the time you are thinking about investing, your basic financial needs are typically met. Those customers tend to be credit card primary. And we kind of see that it's a one-way flow. Once you go from being a debit card primary to a credit card primary customer, you're not really going backwards. So a debit card product didn't really resonate with the vast majority of our customers. They wanted credit. The other thing is they like to have their money in different buckets. And even though sometimes we can argue it's less financially optimal to separate your money into different buckets, you should just like have them all in one place, because then you don't have to worry about moving it. You can make sure it earns the highest interest, that sort of thing. But yeah, people don't like the money that they use for core day-to-day spending to be intermixed with their retirement savings or their long-term investments. And so having it be part of your brokerage account just like is suboptimal from that standpoint. So that led us to Robinhood Banking, and the inspiration for Robinhood Banking was private banking accessible to everyone. So what are the things that a high net worth individual would get from a private bank? And can we actually replicate that experience, both in terms of products and product quality and service, with a digital form factor? And when we started thinking about this, we got excited because it's something we would use and our customers would use. It's also quite differentiated. Like, I don't think any of the fintechs are taking this angle in quite the same way. You know, most of them are targeting paycheck to paycheck customer because they, from a business strategy standpoint, they view that customer as underserved, and it's sort of like the canonical strategy would be it's easier to handle the underserved customers and kind of go up market from there. And you could argue the high net worth individual is a highly served customer, the most in demand. And so this is like a high degree of difficulty path. But I think that's what makes it interesting. And so banking, if you look at all the features, they have this thing in common, which is differentiation is things that you would expect a high net worth individual to get. And then the challenge we have is, how do we make this available to the mass market? And I'm pulling out, I actually have something to demonstrate here. This is the first product we launched in partnership with Coastal Community Bank, the Robinhood Gold credit card. So this one is actually solid gold. when I came into this building a couple hours ago, the first question was, where's the gold? I was told there is none, so I brought some. This might be the most gold in the building. But anyway, it's not just the appearance of the card. 3% cash back on all categories with very few caveats. We had to add some caveats because we saw abuse. For example, people were paying their taxes with it and all that sort of thing. But yeah, we recently announced a couple weeks ago crossing 400,000 card holders. The wait list for this card was north of 3 million, which I think is among the highest, if not the highest for any credit card product. But you can see the idea, hopefully. It's just a card that would be very, very difficult to get unless you're a high net worth individual and sort of like the cream of the crop at a normal bank. And that extends to the retail banking offering too. We have cash delivery, which is a controversial feature. Nobody has really done that before. But I'm a high net worth individual. I had access to this feature. I had First Republic Bank, and there was a big truck that would bring cash to my house. And it was a very nice feature. You don't have to go to the ATM. And then we asked ourselves, what would that look like if we just democratized it? And obviously not everyone needs the big truck, but you get your food delivered by DoorDash. The cars take you on demand to your friend's house. So why can't the cash come to you? And so early results are good, but yeah, we'll see. We'll have lots of challenges scaling it, but it's sort of that thread of how can we make it with no compromises, make it as efficient as possible, digitally delivered. And I think when we pulled on that string, we pretty much got the product roadmap for it.
And what you'll start to see more and more from Vlad and Robinhood is the discipline and the math, the engineer in him, in how they run their company. They're constantly testing, rolling out, getting feedback. I forget the term you use for that interactive session, but you're always asking your customers and you're looking at the data to say, okay, who's using it, why are they using it, and how can we be better? It's something we can all learn to do, is talk with our customers more. How often do you actually sit down and listen to your customers, and how much does that kind of point you in the right direction for new product services, deliveries, et cetera?
I try to do that regularly. So there's a couple of things that I think you probably feel this as well, I'm sure. As the organization gets bigger, it can be, if you're not careful, you can get separated as the CEO from the people that are actually doing the work. I mean, there's a tendency to be talking to the SVPs or the C-suite and get all of your information that way. But I think there's no substitute from going to the other end of the org chart and either talking to the individual contributors on the engineering side or to customers directly. So I try to do user research myself. So and we have structured UX research. We have a team that does a great job with that. And I try to do that at least once a quarter. And I try to do customer support as well, like actually sitting down, taking tickets on the phone or on chat, competing with our AI, because we also have AI that's doing these things. And I try to do that whenever I visit our support offices, which is at least once per year per office. So, and actually we try to innovate there too. I mean, there's all kinds of AI tools that make these things easier, even user research, like new tools where you can have a chat bot having a live interactive conversation with your customers while they're using the product. So we try to stay at the frontier of that as well. And I think like how we make these products is probably a little bit more differentiated than the product itself. Like it's in some ways easy to come up with these ideas, but the factory, the machine that like makes these products at high velocity and high quality multiple times per year, I think that's what's actually hard. And we try to refine that constantly.
I'm sure you're going to get an AI question in the end, but let's go to crypto and blockchain. What are you guys working on right now? And then we can segue into tokenization, if at all, but go ahead.
Yeah, I think that the criticism that a lot of people have had about crypto for a long time, and I think it's a fair criticism, is that it's not, perhaps it's not as real as it should be. And you're trading these tokens, and most of them are memes that aren't backed by anything with fundamental utility. That's the criticism that we hear. And I think part of that is downstream of the regulatory posture that the US has taken over the past few years. Like, we have perfect, well, I shouldn't say perfect, close to perfect regulatory clarity that meme coins are not securities. But if you have something that resembles a security, it's basically disallowed, right? So you can't connect it to crypto technology. So to some extent, the market that's developed in the US is downstream of that regulatory posture, which is now changing. And our solution, I think the technology is super valuable, and we think Robinhood can play a role in bringing the technology to assets that have fundamental utility. And that's why our big efforts here are around tokenization. So tokenization refers to taking a real asset and making it divisible and tradable using blockchain technology. And this is not yet possible in the US, or at least for assets that retail investors want to trade, but it's possible in Europe. So in Europe, a few months ago, we launched stock tokens, which are tokenized versions of US stocks, where we had now up to about 500 of the most popular liquid names available to retail investors in tokenized form. And we're going to build that up and keep advancing it. I mean, what we announced was phase 1, and it culminates in these stocks being freely transferable on DeFi, on blockchains, where the possibilities really start to multiply. We also demonstrated the power of the technology in trading normally illiquid assets, and that was through a giveaway of OpenAI and SpaceX stock tokens. So to my knowledge, we were the first to do that. We were the first to tokenize OpenAI and SpaceX. And I'm not sure there's a Guinness Book of World Records for that, but I think there should be. And that just demonstrates the actual power of the technology. You can actually tap into the gigantic global liquidity of the crypto markets and make any real world asset, even something as challenging as a private stock, instantly tradable 24/7 around the world. And I think that's a very powerful thing.
So we have my peers here, bank CEOs from all over the country that bleed the blood of this country, and they love their communities. This is hard.
Yep.
Can you give them 2 cents on how to get started? What should they be looking at? What is the first step for a community bank?
For crypto.
Crypto tokenization,
Yeah.
Maybe start basics.
How
for
many,
me in particular.
Okay, how many of you guys have heard or are interested in stablecoin? Okay, stablecoin, I'm guessing, is like the big topic. How many of you are nervous about stablecoin? And okay, so we have a couple of people. How many see no value in stablecoins and are at least questioning the value for your customers?
All right, good talk. You're okay. You're allowed to say it. What's the use case is what I hear. What's the use case?
Yeah, so this is interesting. I have many thoughts, and I'm curious actually to hear your thoughts because you're probably living and breathing this. And you guys heard from Chad from Paxos earlier, who I think was the interviewer, but actually Chad is our partner on USDG, the Dollar Global Network, which is a stablecoin that we're working on. So use case for stablecoins. Robinhood actually uses stablecoins in our business as a business customer. And for us, the big thing is being able to move money on weekends, round the clock. So we have this product, crypto trading, that we offer to our customers. And in order to facilitate a crypto trade, we have to actually settle with market makers and other counterparties that provide the liquidity to us. Now, what happens when that trade, there's trading activity on a weekend, right? And there's been lots of times where crypto markets can be super volatile and the volume can dramatically increase up to 10x in a single week. And if that falls on a weekend, we have a couple of options for how to settle with counterparties because we can't move money the traditional way over weekends. There's no ACHs or wires, right? We either have to have huge lines of credit with our counterparties, which are expensive. We have to store our corporate cash there. And the more counterparties you have, they all use different banks. It becomes challenging, right? Because you have to give yourself a buffer and that can add to quite a high cash need. So this becomes expensive. Or you can shut down counterparties and worst case scenario, you run out of buffer, run out of money at these banks. You have to shut down trading, which customers really don't like. So stablecoin, great solution because it doesn't matter what bank they have. If you settle in stablecoins 24/7, real time, on weekends, and if you can convince your counterparties, most of which are fairly technology savvy to take stablecoins, it sort of like solves the problem. And so over time, we've been building up a larger and larger stablecoin position just to do these types of settlements. So there is real value in the 24/7 aspect of this, which gets to my prediction. I think that right now, at least, the value proposition for a retail customer to hold dollars in stablecoin form is not really quite there in the US. You guys are providing FDIC insurance to customers. That's a high value proposition. You can get interest. So like money sitting in stablecoin form, not super attractive or differentiated. But as a funding rail, as a way to send money back and forth, there is a ton of value. So I think stablecoin could compete more with RTP, RFP, and these instant payment rails, more so than an actual deposit sink. And I think that's the domestic opportunity. Internationally, it's a different story. And I think maybe you guys should think about it a little bit differently internationally, because a lot of folks have difficulty getting access to US dollars outside the US. And that's why you see stablecoin adoption skyrocketing, typically in countries where the population is hungry to get access to US dollars. Maybe they already have crypto accounts, and where the local currency might be inflating at a high rate. So you've seen huge adoption in places like Turkey, El Salvador, right? And I think that's interesting because those people have no other options. A lot of the banks aren't serving those markets, and it's sort of replaced the American Express traveler's check, which up until fairly recently was kind of the next best alternative. So yeah, I think there's an opportunity to embrace this business and get net new international customers as a result of it, for those that can figure out how to navigate it.
I love it. I want to switch topics just ever so slightly. There are a lot of myths or preconceived notions about who uses Robinhood, and you briefly touched on it earlier. Is there a generational difference? Because we heard earlier, younger people are going to be the first to adopt it, and you got to get in now because 10 years from now, that wealth transfer that you were alluding to earlier, or are you banking all of the generations?
Yeah, man, that's a great question. And one thing we're really trying hard to avoid is being a generational company. Because in some sense, our predecessors, the discount brokers, are generational companies. You think about Schwab and how they cut their teeth serving the baby boomers, or E-Trade, which is very much like Gen X, right? And Robinhood, when we got started, we were considered a millennial company, right? Because the millennials were the youngest at the time. And I think we have to be really careful to make sure we're always paying attention to the younger generation, because you don't want to eventually be stuck servicing customers that are getting older and might not be around forever. So we're thinking really hard about how to do that. It starts with talking to your customers, but I think it's also how do we make your brokerage account and your bank account work better when your whole family is on it. I think the family, again, is a very, very important vector that nobody's really paying much close attention to. And hopefully you've seen with our credit card and our banking product, it's very much family first. Like, we want to make it really easy to get your spouse, your partner, your nannies, if you have them, and your children on the platform. And of course, I think there's differences in how young people think about technology. Like, younger people are more digitally savvy. They're more comfortable doing everything on the smartphone. They view bank branch office access as a luxury and a nice to have rather than a necessity. But I think at the end of the day, so I think we have to be abreast of those trends. But at the end of the day, everyone wants the best possible experience at the lowest cost. And so it's extremely competitive to deliver that. And I think community banks, such as many in this room, have inherent advantages, right? And if you partner with technology firms who care about user experience and are digital first, you can create something where the customer basically doesn't have to make any compromises. And I think that's a really interesting opportunity.
Well, I'm going to ask one more question, then we'll open Q&A as we get closer. I mentioned the math thing earlier. I was fascinated by this. What is this harmonic mathematical superintelligence company you're building?
Oh, yeah.
That's
a fun one. So I started another company that I'm chairman of, so not in an operating role. And going back a little bit to my roots as a mathematics PhD student, we made this observation that AI models can make mistakes even solving basic math problems, right? I don't know how many times maybe you guys have seen these examples of, like, they can't really subtract properly. They make mistakes with subtraction. And yet, they have access to all of this knowledge. They can synthesize information really, really well. And conceptually, they can be quite creative, which are qualities that are really good for mathematics. So the idea with Harmonic is, can we actually put these two things together and build something that verifies all pieces of output, can still be creative, but you can trust the mathematics it produces. And of course, we're also extending it. Mathematics is so foundational that it's not just about solving geometry problems, although that's very cool. Computer software is based on mathematics. So if we figure this out, and we've recently started productionizing it and offering this as an API to companies and mathematicians, once you have this foundation of reliable, hallucination-free output, you can write computer software that's verified and doesn't make mistakes. And that's a huge opportunity. And particularly in financial services, where the consequences of your accounting system getting something wrong or our trading system making errant trades can be catastrophic. So we think in the future, all software will be verified, particularly because more and more software is going to be generated by AI, and it's impossible for humans to be. It's impossible and also not very much fun if you're a top software engineer to be poring over thousands of pages of AI-generated computer code and verifying its correctness.
I love it. I do want to sneak in one more topic, predictive markets.
Yes.
And because Polymarket came out today with a big capital raise and a very big value. I know you are an industry leader in this, and first one over the wall sometimes gets an error or two, but how are you in that, and why did you get into that, and where are you at with it?
Yeah, we've been interested in...
Explain it, too, for everybody.
Yeah, so many people, actually, one of the criticisms I get is, it's just gambling. Why don't you call it gambling? It's just people are betting on things. So I'm not going to try to refute that. But what I'll tell you is prediction markets, I think is an interesting new innovation. So what it is you can trade on the outcome of a real event. Our first prediction market that we rolled out almost exactly a year ago was the presidential election. So you could trade on the outcome of the presidential election. And you might have first heard prediction markets in the news because they were being juxtaposed against polls. Like the polls were pretty far off, but the prediction markets gave you a real-time view of what was likely going to happen. And they basically called the election with high confidence long before the news networks actually called the election. So traders can speculate on the outcome of events, and it started with politics, but now sports and economics. So we have prediction markets on Fed rate decisions and inflation numbers, which are actually quite popular. In addition to being a useful asset for traders to trade 24/7, it's a good source of information. So we have all of these people that don't necessarily want to trade it, but they want to know, what's the Fed likely to do? Oh, 75% chance of a 25 basis point rate cut. That's useful. And for the traders, I think it lets you very precisely take a point of view that you have about what might drive the market or a stock and execute that point of view. So for example, on the election's a great example. If you had a point of view that Trump was going to win the election, in the past, you would have had to execute that in the form of a trade by maybe buying SPY or buying crypto. But the effect can be unpredictable. It's sort of like the connection between company earnings and stock price. Sometimes you have a company that beats earnings, the stock goes down. So if you had a point of view that the company will beat earnings, the stock might not be the best mechanism. But this allows you to very surgically, as a trader, trade your point of view, which I think has made it exciting for traders. Yeah, and me personally, I think I call them truth machines. There's so much misinformation out there, you don't know what to trust. Markets tend to be quite trustworthy in most cases. So yeah, we're excited to be a leader. We've really increased the diversity of the prediction markets that we offer. Just yesterday, we launched How Long Will the Government Shutdown Last, which a lot of traders care about.
What's the over-under?
20 days. 20 days. Actually, yeah, that's right. About 20 days more.
Well, this is fascinating, and I do want to honor our time commitment. So do we have time for one question? Or we're going to sneak in one question.
Oh.
Sorry.
That's a big question.
She's nice, though. I met her. It's Wyoming. It's all good.
Well, and it's tied to Wyoming. So I appreciate that there are so many people in the room way smarter than
me, yes.
Than us, and maybe what we do every day. And you've showed that there is a use case. No one disputes there's a use case internationally for real-time trading, stable token, doesn't matter how that function is. There's an international use case. There's a Wall Street use case. But come to Wyoming and think about my bank in Wyoming. $570 million bank. I bank lots of businesses. Is there a use case for domestic, regular business trade from the people on Main Street? I mean, really, that's what I think every banker in this room wants to ask that doesn't operate on a Wall Street model. We don't trade. We don't mess in the commodities market. Do you see use case for what we do every day?
Yeah. Go ahead.
Well, I was going to answer it a little differently. He probably has a smart answer. So disregard mine by 50%.
Well, no, you should answer because I also wanted to hear your thoughts on stablecoin.
We often don't see the use case, but we want to be ready when it presents itself. And that's, I think, sometimes the hardest leap. And I'm very proud of our board that they're entrepreneurial and they're willing to spend some money to prepare for an ultimate outcome that may or may not happen, right? And that takes capital and that takes earnings. But we always need to be thinking about what could come. versus what is here today or looking worse backwards. Because if we're building for what was 5 years ago and it's proven out it's too late, he's already moved. So I would just challenge you to keep that innovative spirit, the entrepreneurial spirit, keep your options open, start researching, start investigating, learn is step one, my humble opinion.
Yeah, my take is honestly, from your position, you probably have more compelling opportunities. I think there's a lot of misinformation and hype out there. For example, a lot of people are saying, okay, this is going to be the new way people pay for stuff. I think in the US, it's going to be very, very hard to compete with the credit cards. I mean, we have a great credit card offering 3% cash back on all of your spend. It's hard to do that with a stable coin. And I don't think a lot of people are even, a lot of companies are seriously trying to disrupt that piece. Interest, even if we figure out how to pay interest in stable coins, that doesn't mean that suddenly consumers are going to rush to keep their money in stablecoin form. You don't have the FDIC insurance protection, but it's also not a dramatically better product. You know, the interest isn't going to be higher. It's because under the hood, the assets are going to be kept in Treasury bills or in some kind of bank account anyway. So, yeah, I would probably not be overly terrified and looking for consumer use cases where there are none and where you're not seeing demand. And I think there will be time. I don't think there's like a land rush opportunity in most markets. And we offer support for stable coins on our platform. You know, we have USDC as well as a big collection. Right now, it's pretty niche. I mean, most people are still moving money in through ACH, even though it's a little bit slower and perhaps not 24/7, but we can get very, very close to the ideal experience using traditional rails.
Well, that is all the time we have. We appreciate you guys very much, and thank you for your time. And Governor Bowman will now come up. You are.
Wow. Well, hopefully we've provided you with a little bit of food for thought today. I know I've learned a lot, and I thought your questions were really fantastic. I know everyone's sort of struggling with this idea of what's next and how do we engage. Are we ready to engage, or do we have some more time? So hopefully you've at least thought a little bit more about that, and as we're thinking about how we're approaching things in the future as regulators and supervisors, we'll have an opportunity to talk with you more about what you're thinking you want to do in the future and how we can empower you to do that, or we can help you understand how to be safe and sound in engaging some of those activities. But as we wrap up today's conference, I want to thank all of our moderators and our presenters on today's panels. And of course, I want to thank our Treasury Secretary, Scott Bessent, for sharing his perspectives on our nation's community banks. So many of you have told me throughout the day how invigorating it has been and how it's really increasing your enthusiasm and sort of changing your outlook to see such engagement on these issues across the government. So it's exciting to be a part of this sort of change and approach. And all of the community bankers and state regulators around the country who have attended today's event, I see Arkansas and Mississippi are with us here in the room, but those of you joining us virtually, we're grateful to have you as well. I want to recognize our staff here at the Federal Reserve whose hard work have made today's conference possible. So if you don't mind, I'm just going to give a shout out to each one of them. But generally, I want to thank our community bank portfolio that's led by Karen Kaplan. But her team, Amanda Roberts, who's fantastic, who is our MC today. I mentioned Karen, Josh Smolovitz, Andrea Knorr, Greg Jackson, Dedrick Jeffries, Joe Timpone, Trevor Gaskins, Olawale Makunda, Hetvi Patel, Virginia Gibbs, Brianna Curran, and Amal Vida. Thank you so much to all of you. And of course, I want to thank Alexandra Wells, who really helped us put this event together today. And I'm sure all of you have had a chance to meet her or communicate with her as you've been attending the conference and participating. So thanks to all of you. But I just want to share some thoughts because I don't often get, because of my new role, I don't often get to talk about the things that we're doing on the community bank level here from the supervisory and regulatory perspective. So I just want to go over a couple of things with you that you might find interesting. Of course, we know that community banks drive local and regional economic growth. And you all play a central role in the financial health of the customers in the communities that you serve. Your banks often pursue unique business models, some more unique than others. Eric, I think, is a good example of that, our last moderator. But your models are ones that are not easily replaced by larger banks, especially through that relationship banking model, which is a central tenet of community banking. But in today's environment, many community banks are embracing innovation, and they're continuing to evolve to better serve their customers in the current and the future financial system, which was what today was really about, the future financial system. Our focus today has been on community banks, how you continue to innovate, how you continue to rise to the challenge to support your customers as the financial landscape continues to evolve. Our legislators and regulators, and we had a legislator in the room today, a member of Congress was with us, and he asked a great question about KYC and BSA and how they're thinking about that going forward and fraud. So they're also thinking deeply about how we can all rise to the challenge to ensure that the community banking system continues to thrive through the critical task of ensuring that supervision and regulation are appropriately tailored. Our support for community banks cannot just be lip service. It must translate into specific actions that right-size regulation and apply appropriate supervisory standards, specifically in identifying the appropriate definition of a community bank, in establishing appropriately tailored regulatory thresholds, and in approaching supervision that's focused on material financial risk. So what is a community bank for this purpose? Generally, the regulatory framework uses the blunt tool of fixed asset thresholds. We know that relying solely on fixed asset thresholds is imperfect at best. They fail to account for economic growth and inflation over time, resulting in stable firms with stable growth, consistent business models, and no change in their risk profile crossing asset thresholds and becoming subject to increasingly complex and burdensome regulatory requirements and supervisory expectations. This is clearly not the intended or the desired outcome, in that crossing these fixed thresholds has the unintended consequence of pushing down standards that are designed for larger and more complex banks to the smaller and less complex ones. Compounding this problem is the overlapping and inconsistent thresholds that are used to define banks of different sizes and engaged in different activities. We should question whether this additional complexity is necessary or helpful, and whether it's detrimental to economic growth. A simple fix would be for policymakers to adjust the community bank and other thresholds based on growth, as one of you mentioned today on your liquidity and capital panel. And we could apply that adjusted threshold consistently, indexed against, to adjust for future growth. This approach would preserve the policy choice established when the threshold was initially set. Defining a community bank is an important first step, but it's really just that, a first step. The next question is how to appropriately tailor our regulations for those firms. Over the years, I've supported an approach to regulation grounded in asking some simple but critical threshold questions. What problem does each new and existing regulation solve? What are the costs of that approach? And importantly, what alternative approaches are available? When we look back at existing regulations, we can clearly identify areas that could be improved. For example, we've also talked today about the community bank leverage ratio as an optional alternative framework to risk-based capital requirements for community banks. A community bank that opts into the CBLR framework and complies with the established ratio is deemed to comply with risk-based capital requirements. But if we look back at the history of the CBLR, the agencies approached the task of calibration primarily by evaluating how many banks would be eligible to opt in and calibrating the requirement to maintain the same high level of capital in this population of banks. In my view, this approach failed to achieve the relief that Congress intended. And more fundamentally, it failed to answer the critical questions we must consider in the rulemaking process. Let me turn to another prominent area that needs to be addressed. Even the regulatory applications process can have a negative impact on community banks. This process requires banks to seek approval from the Federal Reserve and other state and federal regulators for regulatory permission to engage in a transaction or an activity. The process can be unpredictable in terms of timing and information necessary to be ripe for consideration and approval. The costs of delay can be significant, as I don't need to remind all of you, which can damage the value of the target bank, creating uncertainty for bank staff and for their customers, and resulting in costly delays for critical systems integration contracts and service agreements, potentially damaging the reputation of both firms. The remedy is simple. Regulatory application review should be effective, timely, and efficient. Banks should have a clear understanding of the information they must provide to complete that application well in advance. The standards for approval must be clearly defined and available to the public. And regulators should be prepared to act to complete the application within the statutory timeframes. We've had an opportunity to take a new approach, or we have now an opportunity to take a new approach, and we are doing so. We cannot accept the opacity of the status quo, especially when the fix is as simple as clear standards, clear forms, and the prompt attention to and action on applications. One area where we have improved transparency relates to mutual bank capital. And I did notice that several of you are mutual banks that served on our panels today, so thank you for participating. And I've spoken about mutual bank capital a number of times. Yesterday, the board issued a series of frequently asked questions and 2 templates for mutual banks to use as they consider engaging and raising capital. These provide options for mutual banks to issue capital instruments that could qualify as Tier 1 common equity or as additional Tier 1 equity. These approaches are just a start. We've had a number of conversations about several different approaches, and we want to make sure that once you've had a chance to review these processes, that we are open to further refinement and improvement once you have an opportunity to think about how effective these are with implementing the desired outcome. So I want to conclude with the discussion about how we ensure that the supervisory process is appropriate for community banks. Regulators are once again working to incorporate tailoring to more effectively allocate supervisory and bank staffing resources. This allows the calibration of supervisory activities that are appropriate to a bank's size, risk, complexity, and business model. The approach is not new. We've talked a lot about it today, but it's simply been ignored in recent years. Regulators have significant leeway in designing supervisory approaches, which may include issuing guidance that is technically non-binding, but often plays a role similar to a regulatory requirement. So how do we address this problem? First, through greater transparency. Supervisory practices often escape public and internal scrutiny. They're developed with little public input, and they're not subject to public notice and comment requirements under the Administrative Procedures Act. Supervisory practices are not scrutinized after an exam because of the activity's designation as confidential supervisory information. CSI includes a broad array of bank and supervisory materials and actions that are taken within the exam context. The Fed continues to revise and redirect our supervisory practices, including the shift in focus toward material financial risk. And these efforts would be most effective if accompanied by revisions to the definition and scope of CSI, which would promote greater public transparency and accountability. Second is the calibration of our supervisory standards. Supervisory findings inform our bank ratings, which can have follow-on effects like limiting options for mergers and acquisitions activity, raising the cost of liquidity, or diverting resources away from other more important bank management priorities. We need to ensure that supervisory practices are appropriately calibrated so that a bank's supervisory ratings reflect its financial condition and material financial risks. But before we close out today's conference, I'd like to, again, thank all of you for being with us today, both those of you who are here in person in Washington and those of you who've joined us online. We appreciate your continued support for community banks across the United States. And I would especially like to thank the community bankers who work tirelessly to support your customers, your local businesses, and your local economies. Thank you for joining us today and taking time out of your schedules to be here in person. In my role as Vice Chair for Supervision, my responsibilities extend across banks of all sizes, from the largest GSIBs to a single branch community bank operating in an underserved rural market. The Fed's regulatory and supervisory approaches to this wide range of firms must be tailored to address the unique characteristics of each type and size of institution. A one-size-fits-all approach that pushes down requirements from the larger banks to the smallest ones results in over-regulation and excessive supervision that is not appropriate for the bank's size, risk, complexity, and business model, especially for community banks. Today, we have the opportunity to right-size the frameworks of each size of institutions, and I look forward to working together with my colleagues at the FDIC and the OCC to accomplish this goal through sensible reforms and more appropriate supervisory approaches. So thanks again for joining us today, and I look forward to keeping in touch.